Before we start this video, do like and subscribe to our channel and not miss on any updates.
So we are going to next take up case study 34. Okay, 359. So we have got 3 questions in this. So first is, but this is super simple. So simple that we don't even have to read the provision. Okay, let's read. We don't even have to read the question. It's so simple. Okay, question number 2. If Mr. H, an individual chartered accountant, is appointed as auditor of Stable and Efficient Limited, for how many terms of 5 consecutive years it can be so appointed? Vapas padhe. Let's read this again. What's some answers? So it is saying that we have an individual chartered accountant. He's being appointed as the statutory auditor. Now, what is the maximum term? The maximum term is already given, 5 consecutive years. But how many terms? For how many terms he can be appointed? Individual auditor, how many terms of 5 consecutive years? Someone saying 2. Okay, so what is the relevant provision? So see, section 139 talks about this. Section 139 talks about rotation of the auditor, which says that for prescribed companies, for certain prescribed companies, if they appoint individual auditor, he can be an auditor for maximum 1 term of 5 consecutive years. And if it is an audit firm, then it can be appointed for maximum 2 terms of 5 consecutive years. Remember, did you recall? If it is an individual, then 1 term of 5 consecutive years, and then there is a cooling period of 5 years. If it is an audit firm, then 2 consecutive terms of 5 consecutive years, and after that, there's going to be a cooling period of 5 years for certain prescribed companies. Remember? Okay. Now, based on this, we have to solve the question. Let's read the question again, and you have to answer, okay? So, MCQ 2, it says individual chartered accountant Mr. H is being appointed. For how many terms of 5 consecutive years can he be appointed? For how many terms? So we have to tell the terms of an individual auditor. 1 or 2? 1 or 2? 1. Perfect. 1 is the correct answer here. Why? Because this is an individual auditor. If it was a firm of auditors, then the terms would have been 2. Okay, and that is exactly our next question also. Next question is also based on this provision only. It says if WY an associate, a partnership firm, is appointed as the auditor for this company, for how many number of terms of 5 consecutive years can he be appointed? Now, if it's a partnership firm, for how many terms it can be appointed of 5 consecutive years? 1 or 2? It's a firm. Dheeraj says 2. Others will also have to answer. If it is a firm of partners, how many terms of 5 consecutive years? 2. Correct. 2. So your correct answer is 2, which is B. Perfect. Okay. Now, based on this only, there is a descriptive question also. Let's quickly read this. See, we didn't even need to read the question for this. Okay. Let's read descriptive question 7. With respect to application of rotation of auditors, answer the questions that follow. Okay, I'm reading question number 7, part A. Okay. Assume that Mr. H, an individual chartered accountant, is appointed as the auditor of this company. After completion of the term as an auditor, as mentioned, for how many years he cannot be appointed? Here we are talking about cooling period. Again, we don't even need to read the question here. The question reads, there's an individual auditor. He has completed his term of 5 years. For how many years there is cooling period? For how many years he cannot be appointed? 5 years, 5 years, perfect, 5 years. So here the correct answer, section is 139 and 5 years is the answer. 5 years is the cooling period. He cannot be reappointed. After 5 years, he can be reappointed. Let's read the next question. Again, super simple. Suppose WY and Associates, a partnership firm, is appointed as the auditor of this company. After completion of the term, as mentioned above, for how many years they cannot be reappointed. That means they're asking what is the cooling period for the firm after they complete 2 terms of 5 years. Again, 5 years, 5 years, perfect, perfect. So this is 5 years again. 5 years is the cooling period for both individual auditor and also firm, partnership firm. Okay, perfect.
So we'll have a look at the next case study number 34. Stable and Efficient Limited is an industrial undertaking situated in the urban area of State H of India. Company is a registered person under CGST Act and into manufacturing business of various types. So this is about the company. Then they have mentioned shifted and all of that. Stable and Efficient is an unlisted public limited company having a paid up share capital of 56 crores during the financial year. Individual chartered accountant named Mr. H or a part of a partnership firm of chartered accountants named WY was to be appointed as auditor. Okay. During 2023, they were planning regarding acquiring the business of one of its competitor by the name Competent and Cable Limited. So they want to acquire another company. Okay. Then they carried out due diligence. Due diligence was performed, and some issues are there. In order to understand what would be the advantage or disadvantage from the point of view of tax, business after the business of Competent was acquired, another due diligence was performed. Audio problem. Anybody else? Just give me a moment. Mic would be clear. Sometimes we have network issue or the laptop getting heated up. Okay, so that could be the issue. Is it better now? So sometimes what happens is summers, right? So even with a lot of fan and AC and all of that, the computer gets heated up, especially when we're streaming. So that could be a problem. Okay, I hope it is better now. So they have done different types of due diligence. Then certain transactions have happened. They have mentioned that. Okay. So here you can see, received in form of cash from trade receivable, equipment was purchased, trade payable, respective aspect. Mr. T was of the opinion that the company was required to develop and maintain production records and accounts on a half-yearly basis. Another director was of the opinion that the company was not required to develop a production record showing quantitative details of various types of carrybacks. So that is not required. So more from the costing requirement point of view. So first question, capital gains. Second question, on appointment of auditor. Third question, WY associate. So appointment of auditor is for, I think, 1 term of 5 years. Firm is 2 terms of 5 years. This is the guess I'm doing. What type of due diligence was performed regarding Competent and Cable Limited for analyzing its financial information and books? So now they have done 3 different types of due diligence, what they mentioned. A due diligence was performed to analyze the financial information. Okay. Then, in order to understand what would be the advantage or disadvantage from the point of view of tax after the business is acquired, another due diligence was performed. Then, a third type of due diligence was performed to understand the complete working environment of Competent. So 3 different types of due diligence was performed. Now, what is the question asking? The question is asking us that What type of due diligence was performed regarding Competent and Cable Private Limited for analyzing its financial information and accounts book? Now, whether it is financial due diligence, environment, operational tax, very simple. If it is something to do with finance, it has to be financial due diligence. There is no rocket science, right? And I don't expect this kind of a very, very simple question to come in the examination. Okay. Then, in order to understand the complete working environment of Competent and Cable Limited, a type of due diligence was performed. This type of due diligence, now what they are doing, a working environment of Competent. So you can say environmental due diligence. Okay, so that is done. Then there was a shifting of industrial undertaking. So this is your 54 series capital gains related part. Applicability of rotation of auditor, law part. Explain in words the below mentioned transactions represent in relation to cash flow statement of stable and efficient for the financial year ended 31st March. Now, the third question is on cash flow. Okay, so here you don't need any specific notes. You should be able to directly answer the notes. What would be the part? Okay, so explain in words what the below mentioned transactions represent in relation to cash flow statement of stable and efficient. So what is the nature of transaction? Okay, you have to explain. Amount of 15,300 was received from a trade receivable. So when you receive any amount from the trade receivable, as per Ind AS 7, you will classify it under operating activities. It is an operating cash inflow. So please write that operating cash inflow or cash inflow from operating activities. Straightforward. Okay. Then when a payment of 14,600 was made in cash for purchases of equipment 22. Now, when we are purchasing, so always remember in the balance sheet, if it is something to do with non-current asset or investment, this will come under investing cash flow. Something to do with P&L, that will come under operating cash flow. And something to do with equity and debt will come under financing cash flow. Very, very simplified version. Okay, so this is a straightforward investing cash flow. When equipment was given to settle the whole amount of 13,700 of a trade payable. Now here, we are giving an equipment to settle the amount of what? Of a trade payable. There is no cash involved, so there is no cash flow. When equity shares were issued and an amount of 272,000 was received, this is a cash flow from financing activity, cash inflow. Right? So very, very simple and straightforward. Again, now if you look at this descriptive question, you would wonder, sir, why do we need to even refer to the case study to answer this question? Because these are independent, irrespective of what is there in the case study, you can directly answer these and score marks, right? So that is why reading and understanding the requirement of the question is very, very important. Okay. Right. So that is case study number 34 for us.
Hello, my dear friends. Very good evening. I believe that I am visible and audible. Kindly please confirm that I am visible and audible both. Done? Audible and visible. Very good. So friends, it's time to talk about some interesting case studies today. In the previous session also, we have covered some good amount of case studies where we have discussed some very brilliant points. So in this session also, we'll try to cover some more interesting case studies where we'll talk about some interesting elements. So without any delay, let's proceed to further discussion, my dear friends. Let me start the discussion. Is the screen visible for you? Please confirm. Yes, thank you very much. Come on. So we are looking at something called case study number 34. An interesting case study, my dear friends. Please look at that. Stable and Efficient Limited is an industrial undertaking situated in the urban area of State H of India. The company is a registered person under CGST Act and is into manufacturing business of various types of carry bags and storage bags. So what business they are into, my dear friends? They are into business of manufacturing business of various types of carry bags and storage bags. And that is basically an industrial undertaking which is there in the urban area of State H. During financial year 22-23, the manufacturing business of the said undertaking was shifted from urban area of State H to rural area of State H. Friends, let me tell you one point here. Whenever there is a shifting of industrial undertaking from urban area to rural area, we can take capital gain exemption under one brilliant section known as section 54G, my dear friends. Somebody is telling 54D. My dear friend, it's not 54D, 54G actually. 54D will come only in case of compulsory acquisition of industrial undertaking. But in this case, 54D will not come, 54G will come. Getting my point? 54G is in case of shifting of industry undertaking to any area other than urban area. 54D is only in case of compulsory acquisition of industrial undertaking. So in this particular question, 54D will not come, but 54G will come. I'm happy that you made a thought, but the answer is not 54D, it is 54G. I'm sure you are clear? Good, fair enough. Next. Land of the company was sold for 2.25 crores on 4th July 2022 because of shifting. Then, the said land was purchased on 13 November 2021 for 1.75 crores. We purchased on November 2021 and we sold in July 2022. So without any second thought, it is short term because it is held for a period less than 24 months. And I'm sure you know that in case of land and building, if it is held for less than 24 months, we'll call it as short term. More than 24 months, we call it as long term. Since it is less than 24 months, we'll call it as short term. But let me tell you, my dear friends, section 54G exemption is available both for long term as well as short term. So here, even though it is short term, still we can take exemption. Next. The new land that was purchased, not an agriculture land, for 1.3 crores on 7/11/22. Very good. For the purpose of manufacturing business of various types of carry bags and storage bags in the rural area of state edge of India. Very, very interesting point. So ultimately, my dear friends, in this particular question, we have to apply 54G. Which section would apply? 54G, my dear friends. I believe that we are getting clarity on this point, everyone. 54G is coming into picture because it is a case where an industrial undertaking which is situated in urban area, it is being transferred to any area other than urban area. Then we can take exemption under section 54G. Good. Coming back to discussion. Stable and Efficient Limited is an unlisted public limited company having a paid up share capital of 56 crores during financial year 22-23. An individual chartered accountant named Mr. H or a partnership firm of advocates named WY and Associates was to be appointed as auditors of the company. So what are the options you have got? Number one, individual chartered accountant named as H, or other option is partnership firm of chartered accountants named WY and Associates was to be appointed as auditor of the company. And during financial year 22-23, the management of Stable and Efficient Limited was planning regarding reacquiring the business of one of its competitors by the name of Competent and Cable Limited. What a name, my dear friends. Stable and Efficient is planning to acquire Competent and Capable Limited. The management of Stable and Efficient thought of undertaking the process of due diligence. Very good. And they have done 3 due diligence. Due diligence is not concerned with your taxation as such. But what transactions have identified, please see that. Certain transaction of Stable and Efficient happened during financial year 22-23. Information was provided as below. An amount of 15,300 was received in the form of cash from one of the trade receivables of the company. So that means this amount is recovered from debtors. Very good. Next point. Equipment named Equipment 22 was purchased for an amount of 14,600, which was paid in cash. So the point is very clear, my dear friends. Whenever an equipment is procured in cash, for that equipment, we cannot take depreciation. If the cost of equipment, if the expenditure is more than 10,000 and it is incurred by way of other than account pay check or account pay draft or online transfer, in that case, on that expenditure, we cannot take any kind of, what, my dear friends, depreciation. Good, very good. Next point. A trade payable of 13,700 was not paid in the form of cash. Rather, equipment named 94 was given to settle the whole amount. So to some creditor, instead of paying the amount in cash, they have paid by way of giving some equipment to the creditor. Next slide. An amount of 2,72,000 was received for equity shares issued during the beginning of the financial year. Mr. T, one of the directors, was of the opinion that the company was required to develop and maintain production records and accounts on a half-yearly basis. Another director named N was of the opinion that company was required to develop and maintain production records and accounts showing quantitative details of various types of bags, carry bags and storage bags manufactured, and also quantitative details of raw material used in manufacture of carry bags and storage bags. See, just 2 lines of the case, 2 pages case study this is. And immediately multiple choice questions were starting. That's why yesterday I clearly told you one hint that whenever a case study is only for just 5 to 6 pages, including the questions, it is just 5 to 6 pages. Let me put it this way. Other than questions, if it is just 3-4 pages, then better read the case study first and then proceed to the multiple choice question. And if it is more than 4 pages, then I advise directly see the question and then go to relevant paragraph, what is relevant for you, and then decide. I hope our yesterday's discussion, what we have done, you remember that, my dear friends, in terms of a hint, what I gave as to which one to focus more upon. First, whether to read the case study or whether to see the questions. That depends upon how much is the quantum and size of the case study. Are we clear? Can I proceed? Good. Thank you very much. The amount of capital gain before exemption arising from transfer of land for a stable and efficient will be how much? Come on, my dear friends. First of all, we discussed that the land when they sold, what they got is not long-term capital gain. It is very clearly short-term capital gain. And what is the sale price, my dear friends? Sale price is very clearly 2.25 crores. And the purchase cost is 1.75 crores. So definitely that will become what, my dear friends? Short-term. There is no doubt about it, my dear friends. First of all, since period of holding of land and building is less than 24 months, it is regarded as short term. It is regarded as what, my dear friends? Short term. If it is short term, how is that we are going to do the computation, my dear friends? First, we'll start with something called full value of consideration, which is nothing but 2 crore 25 lakhs plus expenses on transfer other than STT. I hope you know that we'll reduce something called expense on transfer other than STT. STT, we can't take it as deduction. And in the question, expense on transfer is not given at all, my dear friends. So balance figure, what I get is called net sale consideration. This net sale consideration will be 2 crore 25 lakhs. From that, I'll reduce cost of acquisition. Now, why do I reduce cost of acquisition? I'm going to reduce cost of acquisition because it is short term in nature. My dear friends, please tell me if it is long term, what is that we are going to reduce? If it is long term, then definitely we reduce something called indexed cost of acquisition. And I strongly believe that you guys know very clearly that indexed cost of acquisition is an indexation benefit, which is only in case of long term. But indexation benefit is only for long term except bonds and debentures. So if it is bonds and debentures, indexation benefit is not allowed at all. Or else for long term, definitely indexation benefit is allowed. And the cost of acquisition is 1 crore 75 lakhs, my dear friends. So the balance figure will be short-term capital gains. And of course, in the question they asked, what is the taxable short-term capital gain before the exemption? Before the exemption. So the answer is what, my dear friends? We have got long-term capital gain 50 lakh, short-term capital gain 50 lakh, short-term capital gain 40 lakh, long-term capital gain 40 lakhs. So answer is very clearly short-term capital gains 50 lakhs. So answer is, my dear friends, option B. That's it. That's the story of this interesting case study, my dear friends. I strongly believe that you got clarity on this point, my dear friends. Good. Next point. Second bit. Appointed as auditor, how many terms? Auditing related question. Appointed auditors, how many terms? Again, auditing. What type of due diligence is performed? It's not related to tax. In order to understand the complete working environment of competent and capable, a due diligence was performed. What is the type of due diligence? That is also not related to your taxation, my dear friends. Getting the point, everybody? All of us. Anyways, you learn that more in your other than taxation, my dear friends, more in your strategic management and other subjects, you will learn about this due diligence aspect. In fact, for working environment, we look at something called environment due diligence and all. And for financial purpose, we look at financial due diligence. Anyways, that's not related to taxation. Let me look at the descriptive question. Question number 6. In 22-23, there was a shifting of industry undertaking of Stable and Efficient Limited from urban area of state H to rural area of state H. In this regard, answer the questions that follow. Number 1. In respect of land sold, what is the amount of exemption available to Stable and Efficient Limited for the assessment year? Correct, my dear friends? Come on, let me calculate that. First of all, my dear friends, in descriptive questions, if I have to talk, very clearly we discussed that short-term capital gain is how much, my dear friends? 50 lakhs. That is what the figure already we are having with us. Now, new land and building is procured for what value they gave in the question, my dear friends? Let me again look at the question. The new land and building is again procured for 1.3 crores. I repeat once again, my dear friends, the new land and building is procured for 1.3 crores, my dear friends. Accordingly, exemption under section 54G will be capital gains or cost of new land and building. Cost of new land and building, whichever is lower. Hence, the amount exempt would be 50 lakhs because, my dear friends, at any given point of time, you cannot take exemption more than capital gains, my dear friends. Good. Let me look at the another part in the question. What else they asked in the question? Second bit, what they asked is, consider that stamp duty paid with respect to purchase of the land was 11,50,000. In this situation, what is the amount of exemption available to stable for land sold on 4/7/2021? Obviously, my difference very clearly, if there is a stamp duty also, then it will become, total cost will become, instead of 130, total cost will become 141,50,000. An entire amount of 50 lakhs, we can take it as exemption. Getting what I'm saying, my dear friends? So second bit, if there is stamp duty of 11.5 lakhs on purchase of property, then the total cost of purchase of property shall be how much, my dear friends? 130 plus 11.5 lakhs, which will be 1,41 lakhs 50,000. Hence, the exemption would be 50 lakhs only. Since, very clearly, my dear friends, exemption cannot exceed the amount of capital gains. So at any given point of time, exemption cannot go beyond the capital gain, my dear friends. I hope we are getting clarity on this point, everybody. A very, very interesting question. Good. Next point. What else they asked in the question? If during 23-24, the new land purchased on 7/11/23 is sold, then in that situation, what is going to happen? Sir, very clearly, let me tell you the answer, my dear friends. For the C bit, this is B bit. Now let me talk about C bit. The answer is very clear. If new land and building is sold within 3 years, come on, my dear friends, what is the line? If the new land and building is sold within 3 years, then the exemption taken earlier shall be reduced from cost of acquisition on subsequent sale. Whatever exemption is taken, my dear friends, that exemption is reduced from cost of acquisition. And what is the cost of acquisition actually? The cost of acquisition is 1 crore 30 lakhs. So from that 1 crore 30 lakhs, we'll reduce this 50 lakhs and we will reduce that from the cost. Student is asking, sir, it is only for 54, it is taxable separately. No, sir. No, sir. Same logic like 54. Here also, whatever exemption is taken, that is reduced from cost. Separately taxable, that concept is only in case of 54F. In case of 54F section, law clearly told if the new land, if the 54F basically will apply when the asset sold is any long-term capital asset other than residential house property. Investment is made in residential house property. Then in that case, in 54F, they told in the law, if the new residential property is sold within a period of 3 years, whatever exemption is taken will directly become taxable. But in section like 54, 54B, 54G and all, these sections, they clearly tell if the new land and building is sold, if the new property is sold within 3 years, whatever exemption is taken, that is reduced from cost of acquisition on subsequent sale. I hope you are fully clear, my dear friend. Good, very good. That's it. That's the end of story for question number 6. And question number 7, my dear friends, that's related purely towards auditing. And question number 8, they're talking about cash flow statement. So no way it's related to your taxation. Question number 8 is clearly related to what, my dear friends? Cash flow statement. Next, finally, what is question number 9? Identify whether opinions formed by T and N with respect to maintenance of production records and accounts are correct or incorrect in the context of CGST rules. Also give a reason in order to explain your answer. Friends, let me tell you one point very clearly. We have got one brilliant section called section 35, which deals with accounts and records, which clearly says that every person who is engaged in manufacturing of goods, they have to maintain production records and accounts, which is a mandatory thing, my dear friends. So in this particular case, since they are engaged in manufacturing, they have to develop and maintain production records and accounts on monthly basis. On monthly basis, my dear friends, they have to develop and maintain production and accounting records. And that records should very clearly show the quantitative details of goods which are manufactured, the raw material which is used, all that records have to be maintained. Getting my point, everybody? Friends, come on, please reply. Are you clear with this interesting case study, my dear friends? Simple terms. For question number 9. Since the registered person is engaged in manufacturing business, they have to maintain records related to, come on my dear friends, what is the line I wrote? They have definitely have to maintain records related to, what records they have to maintain? Come on, please tell me the answer. What did I say? Friends, come on, they have to maintain records related to what, my dear friends? They definitely have to maintain records related to what? Production and manufacturing. Related to production on monthly basis as per section 35. Further, records must provide quantitative details of goods manufactured, raw material, etc. So they clearly have to maintain quantitative details, my dear friends, of the goods which are manufactured. And they also have to maintain quantitative details of raw material which is used in manufacturing. Since this is very clearly a case where the assessee is into manufacturing business, they definitely have to maintain that records. There is no doubt about it, my dear friends. Very good, very good. That's it, my dear friends. That's the end of this very, very, very interesting case study. And I strongly believe that you got very good clarity on this case study, my dear friends. Can I proceed further? Please confirm. Definitely. Very good. Thank you so much. I'm so impressed by the participation, what you are doing. So happy to see that because your participation gives more energy to us. Done.
Let's move on to the next question. We are seeing case study number 35 now. Okay, 65. So we've got two MCQs here. One is MCQ 5. So are you guys tired? Are you guys tired? Yes or no? Can we go on? No? Very good. Okay, Dheeraj is tired. Oh my God, Mohak is also tired. No. Are you tired or can we move on? Come on, guys. You can't be tired so soon. We've just done like how many? 5 case studies. We need to do 5 more or at least 4 more. The upcoming case studies are very simple. Super simple. Voting. Sikandar is saying do voting. We'll do voting after 2 cases. We'll do voting after 8 o'clock. Like how much time we can extend. Okay. Okay. So case study number 35. And we are doing MCQ 5. Okay. So now come back everybody. One person saying tomorrow, do class tomorrow. Are tomorrow, Sunday you guys like a class or what? Because if you want a class, I can take on Sunday also. Because I have got a deadline, I have to finish all these cases very fast. Okay, some students are saying take on Sunday also. Okay, I'll check. If it's possible for the team, no, I'll try. We are free. Perfect. Okay, I'll check. If possible, I'll take a class tomorrow. If that is the thing, I'll update you. Okay. Otherwise, our next class is definitely on Monday. Monday, I am coming again and we are completing some more case studies. Okay. So let's move on. So case study number 35. Let's do MCQ 5. Okay, let's read this MCQ now. I'm reading MCQ 5. Assume that Talk Time Private Limited, okay, some Talk Time Private Limited is here, has complied with the depreciation requirements. Comment upon the decision of the board of directors with respect to dividend. Okay. It's saying that board of directors have taken some decision on dividend and they have complied with depreciation requirement. You have to comment whether board of directors decision is correct or not. So we'll have to read what decision they have made. So we'll have to read the facts of the case. Okay. So point number D is related to this. The board of directors of Talk Time Telecom Private Limited have decided to declare interim dividend of 10% and did not consider to transfer any amount of profits to the reserves. Only this much is given. So what has happened throughout the year? The board of directors of this company, they have declared an interim dividend of 10%. Now, when they were declaring interim dividend of 10%, they did not transfer any amount to the reserves. Is it compulsory? Is it compulsory to transfer any amount to the reserves before you decide to give the dividend? Is it compulsory? No, not compulsory. Perfect. Perfect. That's the answer. That's the answer. Okay, so relevant section here is section 123. Section 123 talks about declaration of dividend. It simply says that, dividend can be paid. It is a decision of the board of directors to pay the dividend. Now, dividend includes interim dividend also, and it is not necessary to transfer any amount to the reserves. It is up to the company. If it thinks it's feasible, the board of directors can put any amount to the reserves. Otherwise, there is no need to put any amount to the reserves. They can simply pay dividend. Okay. So accordingly, we'll have to select the correct option. Let's read the options. A says decision of the board of director is appropriate. Now it seems appropriate to me. It seems, what do you think? It's appropriate? This seems like the right answer, but let's read the other 3 options also. The company should transfer an amount out of profits to reserve equivalent to dividend declared. No, there is no such provision. So this is incorrect. The board of directors should ratify such decision of declaration of dividend by taking approval of the shareholders of the company in the subsequent general meeting. Here we are talking about the decision relating to not transferring any amount to the reserves and all. So again, this is also incorrect. The company should transfer an amount out of profit to the reserve as it may consider as it may consider appropriate, but such transfer is mandatory. Such transfer is not mandatory. Okay, so what is the correct answer here? A. Okay, it's not compulsory to transfer any amount to the reserves. Okay, let's move on to descriptive question number 8, which is relevant for us. Now, this question looks big, but it's so easy. So easy. We have already studied the provision for this. Here also, we are talking about the ceiling. Okay, just now we had discussed, section 141. We discussed that and a statutory auditor can be maximum statutory auditor in 20 companies. It does not include one-person companies, dormant companies, small companies, or any private company which has got paid up share capital of less than 100 crores. These are not included. Just now only we discussed, right? Exactly that provision is applicable here also. Okay. So provide the maximum number of audits remaining in the name of PQRST and company. So we have to see PQRST. We have to calculate the maximum number of audits that are remaining. So for that, we'll have to refer to the question. What is this PQRST and company? How many partners does it have? See, this 20 limit is applicable for individual statutory auditors, right? But what about the firm? If suppose we have a firm A, B, Mrs. ABC, it has got 3 partners, A, B, C. Then each of these partners will have 20 maximum limit, right? 20. They can sign on 20 audit reports. So combined total of these, this firm will be 60. Okay. So that is how we have to calculate the maximum number of audits which are remaining for PQRST and company. For that, we have to find out PQRST and company has got how many partners. And we'll multiply that by 20, we'll know, and we'll do some calculation. So let's look at the case study to understand. Okay, so this is the part which is related to us. Okay, let's read this part. Okay, now at last, Mr. T has, this is not so relevant. We'll start from here. They discuss that before appointment is given to any auditor, the company must obtain a certificate from him to the effect that the appointment, if made, will not result in excess holding of company audits by the auditor concerned over the limit laid down under 141(3). So here section is also given. Now, Mr. P, Mr. Q, Mr. R, Mr. S, and Mr. T are holding appointments as auditor in 3, 6, 6, 10, and 15 companies. And if we read a little bit more of this question, the first line says PQRST and company is a CA firm having partners P, Q, R, S, and T. So this firm has got 5 partners P, Q, R, and S, and T. And individually, their number of audits is also given to us. P is holding 6, Q is holding 6, R is holding 6, S is holding 10, and T is holding 15 audits. So can we calculate the total number of audits that they already hold? Accordingly, we'll have to calculate if they can take up any, what is the maximum number of audits remaining for them. Okay. Maybe we are getting the answers. Yes, we're getting good answers. Okay. So if you calculate the total, no, they already hold, if you calculate 3 plus 6 plus 6 plus 10 plus 15, it will be a total of 40. So they already have 40 audits. What is the maximum audits they can have? 20 per person. So that means 20 into 5 partners we have. That means 100 total audits they can have. They have already taken 40. So they can take how many more? They can take 60 more. Perfect. All, Dheeraj, you can check again. Rest everybody is correct. 60 more audits. Okay. Let's read second question now. Okay. Now we're reading second question. Provide the maximum number of audits remaining in the name of individual partners P, Q, R, S, and T. Can you calculate individual maximum audits that are available? See, already their individual audits are given. If we minus it by 20, 20 is the maximum that can one individual auditor can take 20 maximum audits. So P can take maximum 20 audits, right? He has already taken 3 audits. So remaining are 17. Okay. Same way Q has already taken 6 audits, remaining are 14. So same thing, R can take maximum 20. It has already taken 6, so 14 are left. You can do the calculation, easy. Individual audits also we can calculate. Perfect. Let's read the next question. Question 3. Can PQRST and company accept the appointment as auditor of 80 private companies having paid up share capital less than 100 crores, which have not committed any default in the financial statements and annual return, etc. Right? So they are asking us, see, we have already discussed that PQRST can have maximum 100 audits. They have already taken 40 audits. They can take 60 more audits. Now, this 60 more audits does not include one-person company, dormant company, small company, or any private company less than 100 crore rupees, whose paid up share capital is less than 100 crore rupees. Now, here we are being asked, can they take the appointment of 80 private companies whose paid up share capital is less than 100 crores? Can it? Yes or no? Yes. Perfect. Yes, it can take. Why? Because this is not even considered in the limit as per section 141. So it can take 80 such private companies, it can take 200 such private companies, it doesn't matter. It is not to be counted in 141's limit. Now please note, such companies, this section 141, the provision of section 141, subsection 3 clause G, it says that such private companies having paid up share capital less than 100 crores, such companies should have not failed in the compliance, like they should not have defaulted in filing financial statement under section 137 or annual return under section 92. So this has to be complied with such private companies. If they have made any such default, then they will not be included in this provision. Then in that case, we'll have to add them. So this exemption is only available to private companies having less than 100 crores paid up share capital if they have not defaulted in financial statements and annual return provisions. All right. Okay. Okay. We have one more question, part of the question which is remaining. Let's read the 4th question. Would your answer be different if out of 80 private companies, okay, these 80 private companies, 65 companies are having paid up share capital of 125 crores? In this 3rd question, no, we said 80 private companies having 100 crore paid up share capital. Now they're saying, let's say out of these 80, 65 of them have got more than 125 crores paid up share capital. Can the company take their audit? Can the company? See, we have just calculated PQRST and company can take 100 audits, minus 40 it has already done. 60 maximum it can take, no? Here it's saying 65 companies having more than 125 crore paid up share capital. So that means out of these 65, 60 companies it can take. Perfect. Perfect. You guys are already answering. I'm very happy. And you guys are correct. 100% correct. So 65 audits cannot be taken because these private companies having paid up share capital of 125 crores, this is falling in the ceiling of section 141. Therefore, we have to consider them. Only 60 more such companies can be taken, not 65. Got it? We'll move on now. Okay. So this case study is also done. It's 8-6 now. Can we take some more case studies, please? What is your energy level right now? Can we go for a couple of more? We'll take voting now. Okay. No more case studies. Can. Tomorrow. Oh my God. Oh my God. You guys are tired already. Okay, what? Let's take one last. IPL? Come on, Dheeraj. Okay, we'll take one last case study. Okay, we'll not. I was thinking of taking 3 more case studies, and I was supposed to be stretching your class to 8:30. Okay, but because you guys are tired, kids, I'm going to be taking just one case study, okay? Just one last. It's very simple, super simple. Okay, let's quickly do it. 375, because you got limited time, you have to complete these also, na?
Then moving on to the next one, I think we'll be able to do one more case study number 35. Let's have a look at it. PQRST and a company is a CA firm having partners PQRST. Okay, so this is about a partnership firm. This time, so I again, for those of you who didn't join earlier, the reason to read the first two lines and the last two lines is to know what is there in the para. This time, when they met three major issues: accounting and taxation issues of Hamba manufacturers, accounting taxation issues of top 10, eligibility as partners to carry out various audits. Okay, so they have given something about Hamba. Okay, a lot of information about Hamba, and there are subsequent issue, ceiling applicable and related aspects. Okay, so where the services rendered by Punya Bhumi to Hamba, so you will find this information in Hamba when GST is discussed. How should revenue be measured in the case of Top Time Telecom Private Limited's contract with Company B Limited in the books of Top Time Telecom Private Limited? So here it is a specific question on revenue recognition. Okay, so revenue recognition in the case of Top Time Telecom Private Limited. So let us go back and see where we can figure out top time. So here it is Hamba, company's manufacturing, is currently having a query with one of the suppliers affected by Hamba. Company determines it acts as principal, it will not be there also. R, who is working on Hamba, again Hamba manufacturers. Now Mr. P comes with the case of Top Time Telecom Private Limited and tells him that this company has entered into an agreement with B Limited, which is engaged in generation and supply of power. The agreement provided that Top Time Private Limited will provide 202 lakhs minute of talk time to the employees of B Limited in exchange of getting power equivalent to 40,000 units. So what will happen? Talk time, power, B. You will give 2 lakh minutes, and what you will get back is 40,000 units. Now, if you remember, similar question. If you remember, we have similar question of exchange in Ind AS 115 of when we discuss. Similar question is given there, right? Now, Talk Time Private Limited normally charges 0.5 per minute, and B Limited charges 2.5 per unit. Mr. P is unable to account for recognition. It should be recognition of revenue from this transaction, and Mr. T helps to resolve this issue. So when there is an exchange transaction, how should we recognize revenue? That is the question, right? Now, one thing that you have to understand is, if the business of both the parties are same, for example, if I am supplying, let us say, a particular type of commodity, copper, another party is also supplying copper. If you are exchanging copper, then revenue recognition part is not covered under Ind AS 115. Whereas if we are if we are exchanging different categories or different types of product, then we will recognize revenue for those categories, right? Now, how will we recognize revenue? Okay, now how will we recognize revenue? We will recognize revenue based on consideration received. So, what is the consideration received by Talk Time Limited? Talk Time Limited has received 40,000 units. Which is 2.5. So always remember, consideration received is 40,000 into 2.5, 1 lakh. So here, what is the question? How should revenue be measured in case of Talk Time Telecom contract with Company B Limited in the books of Talk Time? So in the books of Talk Time Limited, you have to measure 1 lakh because we are receiving goods worth 1 lakh. Okay. Then, how much will the other party recognize? So other party will recognize, the other party, that is B Limited, B Limited has got 2 lakh minutes of talk time. So other party will also recognize 2 lakhs into 0.5, 1 lakh rupees worth of revenue. Okay, so that is how it will be done. Then this is the income tax, GST law, and company law related part. Then whether Hamba Manufacture Limited should include cost of air conditioners in measure of its progress performance obligation, how should revenue be recognized? Now this, we have not even read the case, okay? I have also not read the case, okay? I'm directly solving this case in front of you. This air conditioner installation, if you remember, there is a lift related case, lift and delivery of materials and other aspects at site. So in that case, I think that is what it inclines to. Should we include the cost of air conditioner to measure the progress? So now we have discussed already under Ind AS 115 that if certain specific conditions are met, and if you are just supplying the materials as it is, if you are not doing any modification, right? In such situations, what do we do is we do not consider them as a part of progress. Okay, so we will not, because we have purchased AC. So if we come back to the question, this is which company? Hamba manufactures cost of AC. Hamba is in the business of manufacturing and trading in electronics. It enters into contract for different. Okay, then here the company has manufacturing unit, and this is from GST perspective. Supply is affected. The company determines that it acts as a principal because, okay, so here is the part. Mr. Q tells that he is currently having query with one of the suppliers affected by Hamba as to how to account for it in the books of account for revenue recognition. He tells that company has entered into an agreement on 1st of January with the customer for renovation of hospital and installation of new AC. Similar case, renovation of building, installation of lift. Here, renovation of hospital, installation of new AC for total consideration of 1 lakh. Promised renovation service includes installation of new AC, is a single PO satisfied over time. Total expected cost is 80 lakhs, including 20 lakhs for air conditioner. The company determines that it acts as a principal because it obtains the control of AC before they are transferred to the customer. Customer obtains the control of AC when they are delivered to the hospital premises. Company uses an input method of cost to measure the progress. As on 31st March, other costs incurred excluding AC were 12 lakhs. Now this problem has to be solved, right? Now here what you have to do is, wherever we have such kind of contract where they are just acting as principal, they are procuring equipment, delivering it to the site. The moment it is delivered, if the customer obtains the control, okay. So I'll just for those of you who joined in later. So, and it's covered in this. I'll share it with you separately. We discussed in the previous question as well, right? So, what happens is if you are carrying out, for example, this is the question which is identical to the lift question which you have discussed earlier. So here, if you just put the number, expected cost is 80 lakhs plus 20 lakhs, 1 crore. So AC 20 lakhs, others 80 lakhs, total is 100 crores. Okay. Now, if you look at the cost, is total cost of 80 lakhs. No, so just a second. I think I missed that part. I'll represent the data. So here what has happened is total consideration is given to be 100. AC cost is given to be 20 and other cost expected is given to be 60. So total cost is 80. Now the thing that you have to understand here is if this AC is delivered to the site, and if I say I've completed this cost or I've incurred this cost, what will happen? Completion will be 20 divided by 80, which is 25%. Whereas just by delivering the AC, I have not carried out any significant activity, or I have not carried out the major part of the activity. Just by buying the AC from one party and delivering the AC to the location, what happens is we should not consider this as something which is completed in terms of input or progress, because otherwise what will happen is 20 out of 80 if I consider it is 25%, but whereas if you look at the other cost, 12 lakhs out of 60 lakhs, this is only 20%, right? 12 lakhs out of 60 lakhs, what is completed? Only 20% is completed. So what the standard says is, for standalone items where we are acquiring them on a principal to principal basis, that is, we have acquired something on a principal basis. We have purchased the air conditioners and we have delivered the air conditioners to the site. We have not designed the AC, we have not modified the AC, we have not manufactured the AC. So in that case, what we need to do is, we will exclude the AC cost to calculate this progress. So we will say progress is only 20% and accordingly we will recognize the revenue. So then, sir, how will we recognize revenue for other parts or AC? AC, we will recognize revenue only to the extent of cost incurred. Okay, so how we will recognize revenue is 20% of other revenue, 20% of other revenue, and AC, whatever is the cost incurred, that part we will recognize as revenue. So, which means total is 100, right? Out of this total of 100, I will remove AC cost, 20. So I am left with 80. This is my revenue without AC. Of this, I will recognize 20%, that is 16. AC 20, as it is, I will recognize revenue. So 20 plus 16 makes it 36. Okay, so what I'll do after the class, I'll share with you an illustration where, not today, tomorrow maybe, I'll upload this on YouTube, where you will understand. For those of you who have the conceptual doubt as to why we are doing this, for them it will be helpful. Okay, so 16 and 20, 36. Cost of goods sold is 12 plus 20, 32. So 36 minus 32, 4 lakhs will be the profit that will be recognized. Okay, so let's just look at the presentation of the solution. Yeah. Revenue, we'll take the total transaction price and remove the cost of AC, we'll get 80 lakhs. This is the total revenue. Of this, my completion is how much? My completion is 12 lakhs out of 60 lakhs, that is 20%. So why 12 lakhs? 12 lakhs is the cost. Why 60 lakhs? Without the AC, whatever is the cost. So my completion is 20%. So I will take 20% of your 80 lakhs other revenue, that works out to 16 lakhs plus AC 20 lakhs. Cost of goods sold 12 given plus 20 AC. Profit is 4 lakhs. The reason is, just by including this AC or just by delivering the AC, we have not carried out significant portion of the contract, and hence we are not recognizing that revenue to that extent. Right? So we'll halt here, and tomorrow we'll see. I think most likely we'll have a taxation class. We'll confirm in the group tomorrow. Okay. Thank you. And yes, notes almost done. Last few standards are left. It will be uploaded by tomorrow. Okay. Thank you.
Next case study, my dear friends. Please see that PQRST is a CA firm having partner Mr. PQRST, Chartered Accountants. The firm was established 10 years ago. How many years back it established, my dear friends? 10 years ago by these partners who were friends since college days, and has made remarkable success in auditing and taxation work till now. They have clients ranging from small traders to big multinational company. So 5 friends together started a CA practice 10 years back, and they have got clients from small traders to big multinational companies. They have practice of meeting and sitting together once a month to discuss and sort out various issues of their clients with each other, as well as any issues related to their profession. Very good. This time when they met three major issues were scheduled to be discussed as follows. Number one, accounting and taxation issues with respect to Hamba Manufacturers Limited, one of their old clients. Accounting and taxation issues with respect to Talk Time Telecom Private Limited, one of their prime clients. Previous point, one of their old clients. This point, one of their prime clients. Their eligibility as partners to carry out various audits and ceiling limits. Very good. Hamba Manufacturers Limited is in business of manufacturing and trading in electronics and is at its own sale depots as well apart from being a part of wholesale and distribution channel. So apart from wholesale distribution channel and manufacturing, they have got their own sale depots also. It also enters into contract with different customers for overhauling and renovation services. And has also set up a separate unit in its factory for research related to biotechnology. Wow, so many things they are doing, my dear friends. One of the issues being discussed at the meeting is that company has its manufacturing unit in the state of Maharashtra. It stores the finished goods manufactured by it at the depot located in the state of Gujarat. The depot is owned by Punya Bhumi Limited, a related person of Hamba Manufacturers. Punya Bhumi has not charged any consideration from it for usage of depot for storage purpose. There is a doubt raised by Q regarding such transaction as if they form supply or not under GST law. They discussed about the term supply under GST law and has helped to resolve this issue. My dear friends, can you guys please tell me whether this transaction is supply or not? Very clearly, answer is yes, my dear friends. Because in the question only they told they are regarded as related person. So there is service provided by Punya Bhumi Limited to Hamba Manufacturers Limited. And this service is provided in the course or furtherance of business. And I am sure you guys know very clearly that as per section 7.1c, read with schedule 1. Sir, here some students are telling the answer as different GST registration. But you have to understand that there is service which is given by Punya Bhumi Limited to Hamba Manufacturers Limited. Both are actually related person. Please don't bring the language of distinct person in the question, my dear friends. They are not talking about distinct person at all. They are clearly telling related person. And Punya Bhumi is giving storage service to Hamba Manufacturer. So with any transaction where there is a supply between distinct person in the course of furtherance of business, that is regarded as supply, even though there is no consideration. So in this particular question, even though there is no consideration, still it is regarded as supply. More particularly because of section 7.1c, read with schedule 1. And moreover, it is different state also. But I am talking from the point of view of Punya Bhumi. Punya Bhumi to Hamba, that is also a supply. And I got your logic, what you're trying to say. That is, Hamba Manufacturer from factory to warehouse, that is also a supply. That is from distinct person point of view. And Punya Bhumi to Hamba is from related person point of view. But in both the scenarios, the answer is supply only. Because of section 7.1c, read with schedule 1. Transaction regarded as supply, even though there is no consideration. Are you clear with this, my dear friends? Yes, very good. Thank you so much. Next point. Mr. Q further tells them that he is currently having query with one of the suppliers affected by Hamba Manufacturers Limited as to how to account for it in books of accounts for revenue recognition purpose. So that's nowhere related to taxation. I'll ignore that paragraph completely. Company determines that it acts as a principal because it obtains control of AC. That's all your performance obligation, Ind AS and all. Done. Next. Yeah. Moving on. R, who's working on the case of Hamba Manufacturers Limited with Mr. Q jointly, is struggling with certain issues to be handled while calculating profits from business for 22-23 for the company for a taxation purpose. That's our lookout. And puts forward the relevant information for discussing among them. Mr. S, who is an expert in income tax matters, offers help in this case. Will offer the help, no problem. He tells them that Hamba Manufacturer disclosed a net profit of 10 lakhs for the year ended 31st March 2023. and some information is being given. What is that information? Let's see that first point. Advertisement expenditure debited to P&L account includes the sum of 60,000 paid in cash to sister concern, and the market value is 52,000. What a brilliant point. Here, first point you have to observe very clearly is that 52,000 is market value, but he paid 60,000. So technically what is going to happen is 8,000 will be disallowed as per section 40 capital A2. And moreover, you have to understand that 52,000 is also disallowed because it is paid in cash. Because it is paid in cash. Are we getting clarity, everybody, sir? That is because of 40A2 and 40A3, my dear friends. Very, very interesting provision. Student is telling take it to P&L. What is take it to P&L? I didn't get your point. It is 40A3 plus 40A2, my dear friends. We have to add that 60,000 to the profit. It's already debited to P&L. So we are going to add it back. Third point you are talking. Oh, hold on. Let us see. Next point. Second point. Repairs of plant and machinery debited to P&L include 1,50,000 towards replacement of worn out parts of machine. Such expenditure does not increase the future benefit from the asset beyond its previous class's standard of performance. So if that is the case, my dear friends, we will not treat it as capital expenditure. We will treat it as revenue expenditure only. Because whenever there is a replacement of part, my dear friends, there must be a situation where it should bring into an existence a new asset. And there must be some future benefit which is coming from the asset beyond its existing standard of performance. In fact, even ICDS, Income Computation Disclosure Standard, we have got ICDS 5 on tangible fixed asset, which clearly says that an expenditure which increases the benefit from the asset, which is beyond its current capacity, that is only capital in nature. If not, it is very clearly revenue in nature, my dear friends. In fact, there is one case law also for this. I'm not able to recollect the case law name, but there is actually a case law also for this. There is one case law. You want to, I'll just check and tell you what is the case law name. Yeah. So the case law name is, my dear friends, there is a case law called Darbhanga Sugar Company Limited. In that case law, long back, they clearly told that, my dear friends, it is a case where it is only replacement of one. It is not a substantive replacement and all. So it is very clearly a revenue in nature. It is not capital in nature. Got it? Next, third point. A sum of 8,000 on account of liability foregone by creditor has been taken to general reserve. Why to take it general reserve? Please bring that to P&L account. Any liability foregone by creditor is an income for the assessee. So that should be added to the P&L. So we have to add that to the profit, my dear friends. Next point. Sale proceeds of import entitlements amounting to 1.1 lakh has been credited to P&L account, which the company claims as capital receipt not chargeable to tax. Company's logic is nonsense. Whatever they have done in P&L account, that is only correct. Because section 28 chargeability section of PGBP clearly says profit on sale of import entitlements, profit on sale of import licenses, they are all very clearly taxable in PGBP only. And in this case, they have already taken that to P&L account. So there is no further treatment at all. Next point. Being also engaged in biotechnology business, company incurred following expenditure on in-house research and development. So that is covered in section 35. Section 35 talks about deduction in case of expenditure incurred on scientific research, provided it is an approved expenditure, where we can take deduction at the rate of 100% for both revenue and capital expenditure, except for land. If it is land, then we can't take deduction. See here, research equipment purchase 1,50,000, remuneration paid is 50,000, and total amount is debited to P&L. Very good, already debited to P&L. When it is already debited to P&L account, there is no further treatment that is required because it's already debited to P&L. Next slide. Now, Mr. P comes up with the issue of Talk Time Telecom Private Limited. He tells them that, come on guys, what is the issue we're talking about? He tells them that this company, friends, are you focusing? See that. Enter into agreement with B Limited, which is engaged in generation and supply of power. Agreement provided that Talk time will provide 2 lakh minutes of talk time to employees of B Limited in exchange for getting power equivalent of 40,000 units. So instead of monetary consideration, they are covered getting talk time. Student is telling this is already covered in accounts, sir. Very good. Good. Then I'll go to next point. Anyways, accounting only because they're talking about recognizing the revenue. Companies to provide telecom services in Mumbai obtained a license on 1/4/2020 for a period of 10 years, ending on 31st March 2020, against the fees of 54 lakh to be paid in 3 installments, each by April 20, April 21, and April 22. And the company commenced business on 1st April 21. When they commence business on 1st April 21, deduction will start coming from 21-22 only. Deduction will start coming from 21-22 only, my dear friends. Accordingly, we'll calculate. He is struggling with the treatment of the transaction under income tax and has comes forward to help. We'll solve, no problem. Company has entered into contract with an actor, Chandragupta, to act as their brand ambassador. Duration of contract is 5 years and the contract fee payable is 10 lakh per annum. And as per the terms of the contract, in case the contract is terminated by Chandragupta before the end of contract period, he will have to repay to the company 50% of the contract fee received by him till the time of termination of contract. Fine. Board of Directors decided to declare interim dividend, did not consider to transfer any amount to reserves. Now at last, TAS is issued discussed among ceiling limit of audits. Fine. That's not related to tax. First bit. Whether the services, come on guys, what the first bit? Whether the services rendered by Punya Bhumi Limited to Amba Manufacturers Limited, does it qualify as supply? Already I told you, my dear friends, it is very clearly a supply, my dear friends. As per section 7(1)(c), read with schedule 1, my dear friends. Certain transactions are regarded as supply. Are regarded as what, my dear friends? Supply, even though there is no consideration. And one such point in that is, my dear friends, supply between distinct or related persons in the course or furtherance of business. And in the question, my dear friends, it is given that they are related persons and transaction is done in the course or furtherance of business. Accordingly, it is regarded as supply. And once it is supply, my dear friends, without any second thought, GST will apply, my dear friends. And what is the answer, my dear friends? Very clearly, the answer is option C, my dear friends. That's it. That's the story of this first MCQ. I believe that you got clarity on this point, everyone. Yes? Good. Next. How should revenue be measured? That's your accounting. What amount of payment made for license fees shall be deductible at income tax for assessment year 23-24? So we are talking very clearly about assessment year 23-24 is what we are talking, my dear friends. Let me solve that. We're talking about assessment year 23-24. But the point is very clearly telecom license fee. Is allowed as deduction based on payment made and based on number of years license is in force. And this concept is given by section 35 ABB, my dear friends. Come on, my dear friends, which section talks about this concept? This concept is given by section 35 ABB, my dear friends. And let me tell you an interesting point. If payment is made before commencement of business, then deduction is allowed from the year of commencement. And if payment is made after commencement of business, then deduction is allowed from the year of payment till license is in force. Very, very interesting question, my dear friends. Come on. First of all, previous year 2021, you paid. Correct, my dear friends? How much you paid in previous year 2021? In the question, they clearly told previous year 2021, you paid 18 lakh rupees. Correct? Previous year 2021, the amount paid is 18 lakh rupees. Then in that case, the deduction what you will get is, my dear, 18 lakh divided by 9 years. 9 years only I will take because I will start from 21-22. I will start from 21-22 for next 9 years because the license as business has been commenced from 1/4/2021. In the question only, they clearly told that the business is commenced on 1/4/2021. That's the reason why I divided that by 9 years. So are you getting clarity why I have taken 9 years? And again, previous year 21-22, again we paid 18 lakhs. This also I'll take divided by 9 years only. Divided by 9 years only because 9 years is still left. Then previous year 22-23, again I paid 18 lakhs. But this time I'll do 18 lakh divided by 8 years. I repeat once again, this time I'll do 18 lakh divided by 8 years. 8 years is because I will take based on number of years license is in force. Therefore, total deduction for assessment year 23-24 as per section 35 ABB is equal to 6,25,000, my dear friends. Very, very interesting point. So what will be the answer, my dear friends? $6,25,000 means the answer is option C, guys. Student is asking, so previous year 21-22, why 9 years? Previous year 21-22 because that is when 21-22 we paid 18 lakh rupees. From 21-22, the balance period of license is only 9 years. Balance period of license is only 9 years. 20-30, the license will get expired. That's the reason why I divided it by 9. You got the answer, my dear friend? Okay, thank you. Next. Fourth question. At the end of third year, Chandragupta terminates the contract with Talk Time and he received the contract fee of 3 years at the time of termination of the contract. You are requested to determine whether the given transaction qualifies as supply. 100% answer is supply only, my dear friends. Because originally we agreed for a 5 years contract and that 5 years contract is now being cancelled. So we are tolerating the non-performance of contracts. And let me tell you, tolerating non-performance of contract is also a supply, my dear friends. So answer is option D, my dear friends. Service of brand ambassador and also service of tolerating non-performance of contract by the company. Both will qualify as 2 different supplies. Are we getting clarity, everybody? All of us, please confirm you are clear with this point. Good, very good. Thank you very much. Next point. Directors, dividend, okay. Cost of revenue recognition. You are required to compute income from business or profession of Hamba manufacturer. Already we have discussed all the adjustments. Duly explain reason for each item of adjustment. We'll do that. Next. Maximum number of audits. Maximum number of audits. Appointment of auditor. Appointment of auditor. So the last question in this case study is only about computation of income from business or profession. descriptive question, question number 7. Come on, guys. What is the net profit as per P&L account? Net profit as a P&L account, what they gave is, my dear friends, 10 lakh rupees. Correct, no? Then, to that, I will add payment for advertisement. And this will be payment for advertisement. And this is disallowed as per section 40A2 and section 40A3. Correct, my dear friends? So come on, please reply. I'm sure you got this logic why this answer has come like this. Yeah? And what is that figure, my dear friends? That figure is 60,000 rupees. Then what else is there in the question? Repairs. No treatment. Since it is already debited to PL and it is not capital in nature. So I'm not going to do any treatment there. Next point. Liability foregone by creditor, my dear friends. The figure they gave in the question is 8,000 rupees. In the question, they missed out taking that. Student is asking, do we need to separate that 40A3 and 40A2? Always advised to separate. It is always advised to separately show in the question. I mean, when you're writing the solution, it is always advised to separately show. No problem. Sale proceeds of import license. And this is already credited to PL. So my figure will be 0, my dear friends. Then expenditure on in-house research. And this is also already debited to PL, my dear friends. So my figure is 0 because already debited to PL, my dear friends. Therefore, profit as per income tax provisions. $10,68,000 is the answer, my dear friends. That's the story of this very, very interesting descriptive question. And I'm pretty sure that you got clarity on this point. Pretty simple point, but pretty interesting point. Are we clear with this point, everybody? Friends, come on, please reply that you are clear with this point. I'm waiting for your answer, please. Good. Thank you so very much. So that's the end of story of this very, very, very interesting case study, my dear friends.
Okay, case study number 36. It's just one simple MCQ, MCQ 3. Let's quickly take it. So what should be CA Amit's reply to his appointment for other miscellaneous services apart from appointment as a statutory auditor? Okay, so here what is happening? This Mr. Amit is a CA. He's already a statutory auditor of this company, and probably the company is asking this person to take other miscellaneous services also. Okay, now what are these miscellaneous services? Miscellaneous services, further the company offered him if he could also provide services of actuary, investment advisory, investment banking. Now please tell me, can a statutory auditor of the company give additional services to the company like investment advisory, investment banking, actuarial services? Or is Can it give it? Can it give? Or is it a disqualification? We have a section 144 in the chapter relating to audit and auditors. Sikandar is correct. Now, this section 144 lays down certain services which cannot be given by the statutory auditor. Now, see, statutory auditor is auditing the financial statement. How can he be giving such big services that will make him, biased towards the company? There are certain services that cannot be given by the statutory auditor, like internal audit he cannot do. He cannot design financial information system, or he cannot do actuarial services, cannot give investment advisory service, cannot give investment banking services, cannot give management services, cannot be outsourced finance, cannot render outsourced financial services. These cannot be given by statutory auditor. Otherwise, section 141 says that he will be disqualified. He'll have to vacate the office. Got it? So accordingly, we'll have to select the correct answer. Okay, he can. So let's read the options. Accept his appointment as would be approved by the board of directors. Should not accept the appointment, and resign as statutory auditor. Should ask for approval in the AGM. What is the correct option? Correct option is B. Okay, there is no need to resign. There is no need to ask in the AGM. There is no need to ask board of directors. He should simply not accept such appointment. He should be a statutory auditor. He should not do these extra services. Okay. Okay. So that is the last case study for today. All right. Next, I'll be updating you. I'll be taking your case study class tomorrow. I'll update you by maybe morning or afternoon tomorrow. And Monday, we are definitely having a class. I'll be coming. Okay. Tomorrow I will try. I'll check with the team and most likely I'll try. Tomorrow, how many of you are okay? Just say yes if you are okay with tomorrow. Yes, yes. We got 3 votes. Before 6, okay, no, 7 o'clock is the fixed time. Okay, chalo, ठीक है. So I'll update you by tomorrow. Please share the last case study number. Last case study, this one was case study 36 from case study digest of November 23. Okay, so I'll check and let you know in the group, okay? Okay, so this was the last case. Let's meet tomorrow or day after and study well, okay? I'm signing off now. Good night. Good night, everybody. Good night, everybody.
Good evening, everyone. So we'll continue with our case study digest. Let me just share the screen. So we'll start with case study number 36. Again, there is a background that there is someone who is a postgraduate from IIM Guwahati, set up a business and so on and so forth, right? C. Amit Garg, her friend, she wants to consult for accounting and taxation related issues. C. Amit has set up his own proprietorship, that is about C. Amit, and Varsha tells him that her company, Varsha Private Limited, specializes in something. So unless question asks specifically about the business, that information is not relevant to us. Then the balance sheet has been presented. How they present various matters. So they have given equity liabilities, non-current liabilities, current liabilities, then non-current assets, and so on. Now here, as we read the balance sheet, 2 things you have to keep in mind. If it is an India's balance sheet, what comes first? Assets or liabilities, or assets or equity and liabilities? What comes first? What comes first? We show with assets. So if at all this is, see, we don't know whether this is an Indies or not, but because we are in final, we'll assume this is Indies. So first thing itself, it is, incorrect. Then once you start presenting India's balance sheet, you don't show reserves and surplus on the face of the balance sheet. This is shown under equity. If money is refundable, this is my liability, right? Then current liabilities, we don't directly show trade payables. We will classify that as financial liabilities and all of those things. As you read the balance sheet, you will be able to figure out. Right. Then one important thing here is if you see deferred tax asset shown under current asset, arising from Indian income tax. Here also arising from Indian income tax. So deferred tax liability and deferred tax asset, we have to show it as on a net basis, right? And debit balance of statement in P&L, this one has to be adjusted in reserves and surplus and shown under equity. even if it is a negative item, you will not show it separately. So these are a few things you have to keep in mind. Then there are some issues. Presenting inventory related issue. They have entered into a contract with customer E, and depending on when the asset is completed, there are two outcomes given. So here we'll again see depending on the position what comes. But one thing is, because there are two outcomes, we will take most likely outcome as per Ind AS 115. Right? That is very clear. If there are multiple outcomes possible, then we will take the expected value. If there are two outcomes possible, we'll take the most likely outcome, means the one which has more chance of happening. In this case, it is 260. Okay. Then this is GST will be taken care separately, and income tax return. Now, first, with respect to presentation of inventories, there was one specific issue. What would be the presentation requirement as per Schedule 3? Right. So what you can do is you can actually carry a printout of Schedule 3 for with the detailed working. If at all you tend to forget things, right? Now, with respect to inventories, what should be the presentation requirement? Now, what they have given to us here? Inventories amounting to 1 lakh, they have spare parts, finished goods, work in progress, tools. So all of these items are there. Now the question is, how will we present this part? The question is, how will we present this part as a part of our inventory? Okay, so that is the first thing. Now all of these items, we need to present them as a part of our inventory as required by Schedule 3. That is the first question. Then spare parts and work in progress items be clubbed together. We don't club these two. Finished goods and tools, we don't club these two. No separate presentation, that is also not there, because in the balance sheet we have to show what are the different breakup of inventories that has to be disclosed. So first option is right one. I hope we get such kind of some easy questions which we can solve, because this we have been doing from CA inter level, right? So if we get these kind of questions, 2 out of 2 should be in our pocket. Okay. Let's look at the next one. What shall be the transaction price with respect to contract entered into with the customer? So we will take the most likely outcome. And the most likely outcome we have seen is 260. So 260 is the correct answer. That is also a straightforward, simple question. Nothing complicated as far as the question is concerned, right? Then so appointment CA, then taxability and allowability of payment. Then comment on the presentation of the balance sheet as laid before CA accountant with respect to Varsha Private Limited in terms of Division 2 of Schedule 3. Now, Division 2 of Schedule 3 is about Ind AS. And when we present Ind AS balance sheet, we must ensure that the balance sheet has to start with assets, then equity and liabilities. Correct. So, and also look at the specific heading. So if you see what all mistakes are here, first you have to show assets. You do not show what do you call equity and liability first. Then fixed asset, we no longer use this term. We use the term property, plant and equipment. Then capital advances. Capital advances are not classified as capital work in progress. Capital advances are separately shown under advances. Then trade receivables are shown under financial asset. Deferred tax has to be net off. Debit balance in P&L also has to be net off, right? That is one thing. Then coming to the equity and liabilities. So you have to write a narrative description. What all are wrong. Then coming to equity and liabilities sides, right? So you'll first have equity. Then reserves and surplus, you don't show as reserves and surplus. You show it as other equity. Correct? Then this ESOO is what we call employee stock option outstanding. Employee stock option outstanding, that also we have to show under other equity. Share application, money refundable. See, whenever there is an obligation to refund the money, then we say it is a financial liability. It is a financial liability. So financial liability here, this share application money refundable, we have to reclassify that as a financial liability. Then DTL will present it under non-current liabilities. Now we have to see whether DTL is higher or DTA is higher. Accordingly, we will do the net off and present it, right? Then trade payables will show under financial liabilities. So you have to give a narrative description of the part. Right? So very simple and straightforward, I would say rather.
So can I proceed happily for discussion about next interesting case study? Are you all ready, my dear friends? Come on, please reply, guys. Your participation is very, very important. Good. Thank you very much. Let me talk about the next interesting case study, guys. Next case study. Varsha Dutta is a postgraduate from IIM Guwahati. Then she set up a business of her own in 2020 in the field of construction material manufacturing to substantiate and support his father's construction business. So she started what business, my dear friends? Just a second. Construction material manufacturing, which is almost that, to support his father's business, which is almost 30 years old. Until now, she was able to manage accounting and taxation part of her business really good all by herself. But now, as the business is expanding, she hires services of a taxation consultant, CA Amit Garg, her friend, for accounting and taxation related issues, so as to make all the required compliances good. CA Amit has set up his own proprietorship firm and has been practicing in auditing and taxation since past 7 years. Amit and Varsha both met, where Amit tells her that times have changed and so have the ways of presenting accounts as per the financial reporting framework. He also tells her about income tax and GST aspects with respect to business. And after a brief deliberation, he asked Varsha to tell him brief about her business. Varsha tells him that her company, private limited company, specializes in manufacturing and trading of construction material. She asked her accountant to show Amit how they present various matters in their company balance sheet. And accountant lays down a draft balance sheet. Fine. That's more for your financial reporting purpose. Varsha tells Amit that her father's company, Car Private Limited, is a prime and regular purchase of material from her company. She finds it hard on how to deal with various accounting and taxation issues. Number 1, presenting inventory in financial statement. I'll not talk. Just recently, they have entered into contract to build an asset. Depending upon when the asset is completed, she asked Amit's help in determining transaction price. That is also not related to taxation. Next point. Issue 3. She tells Amit that her company is a GST registered. Wow. Now comes the taxation part. But now, with the expanding business, they find it hard to deal with GST matters and needs his services as a GST consultant. She provides her with some data relating to recent transactions to understand the GST impact and compliance. Their company supplies the following goods and services for construction of building and complexes. Excavators for required period at per hour rate. Manpower for operation of excavators at per day rate. Soil testing and seismic evaluation. Excavators are invariably hired out along with operators. Similarly, excavator operators are supplied only when the excavator is hired out. Obviously, if you don't take excavator, why will excavator operator will come into picture? So this is a clear-cut case of composite supply, where 2 or more supplies are naturally bundled, of one of which is a principal supply. Now, what is principal supply here? Principal supply is very clearly hiring of excavators, and operator manpower is only a incidental ancillary in nature. So principal supply, the main supply is excavator hiring only, my dear friends. That is 36 lakhs. Service charges for a manpower is 40,000. And separate activity, there is soil testing and seismic evaluation, which is 5 lakh rupees, which is altogether a separate activity, my dear friend. And I hope you all know very clearly that composite supply is taxable at the rate of principal supply. Next point. Varsha's accountant tells Amit that while filing income tax return last year, they faced issues and doubts with respect to eligibility of certain expenses and couldn't resolve them out. Similarly, this year as well, they faced the similar issues. Major 2 of them are as follows. Number 1, a bank guarantee is given by Varsha Private Limited towards disputed tax liabilities. Number 2, their company paid dollars equivalent to 25 lakhs as sales commission for the year ended 31st March 23 without deducting tax at source to Mr. Rodriguez, a citizen of UK and a non-resident who acted as an agent for booking orders. Payment is made without doing TDS. First of all, my dear friends, I'll tell you some important points here. Point number one. When payment is made to a resident, we have got TDS sections like 194H, I, J, A, C and all. But when payment is non-resident, TDS provisions are governed by section 195. And section 195 clearly says, when payment is made to non-resident, please do TDS only if that income of non-resident is taxable in India. If income of non-resident is not taxable in India, then please don't do TDS. And of course, I'm sure you guys clearly know that in case of interest, in case of royalty, in case of fees for technical services, they are treated as Indian income if they are related to business in India or sources in India. But any other business income other than interest, royalty and technical services, example like this sales commission and all, business income of non-resident will be taxable in India only and only if the non-resident has got business connection in India. And I hope you guys know very clearly that business connection means there is an agent who is maintaining stock. There is an agent who is concluding contract. There is an agent who is securing orders. And if there is no business connection, then the business income of non-resident is not taxable in India. And if it is not taxable in India, there is no requirement to do TDS. And when there is no requirement to do TDS, there is no question of disallowance. Very, very, very important point. I strongly believe that you got clarity on this point, my dear friends. Extremely important point. Kindly please confirm that you are clear with this point, everybody. Please. I told you something very important actually. Good, next point. Student is telling, can you explain once, sir? I'll write. While writing in the Excel, I'll explain to you once again. Don't worry. Even after that, it's not clear, you ask me. After a healthy discussion with Amit regarding various issues, Varsha is facing in her business. She feels satisfied that Amit can help her out in accounting and taxation aspects of business, leading to better compliances. She gets him appointed as auditor of the company for the current financial year. Further, the company offered him if he could also provide services of actuarial, investment advisory, investment banking, which will be duly approved by board of directors. Number 1, schedule 3 presentation, financial reporting. Second point, what would be the transaction price? That is also not related to your, what, my dear friends? That is also not related to your taxation part as such. Getting the point? Next. Third bit, that's related to your auditing. Fourth point, examine the taxability and liability of the guarantee furnished by Varsha Limited. So let me tell you very clearly, any guarantee furnished is not treated as actual payment, my dear friends. Interesting provision section 43B clearly says that there must be a payment made, my dear friends. If it is payment made, then only deduction is allowed. If it is guarantee, my dear friends, for that guarantee, deduction is not allowed. If there is a disputed tax liability, any tax, duty, cess, fee that is allowed as deduction only if they are actually paid on or before due date of return of income, as per provisions of section 43B, and furnishing of bank guarantee cannot be regarded as actual payment. In fact, that particular point is given by very, very popular Supreme Court ruling in the case of McDowell and Company Limited. Very, very popular ruling actually. As per section 43B, any tax, duty, cess, interest or fee payable under any law would be allowed as deduction only if they are actually paid on or before due date of return of income. as per section 139(1). And I hope you guys know very clearly what is the due date of return of income. The due date of return of income is generally 31st of July, 31st October in 3 cases. Number 1, companies. Number 2, other than companies subject to tax audit. Number 3, partner of the firm if the firm is subject to tax audits. And for transfer pricing associates, it is 30th of November. And very clearly, my dear friends, Supreme Court in the case of McDowell and Company Limited has held that Supreme Court in the which case, my dear friends, McDowell and Company Limited has held that furnishing of bank guarantee cannot be treated as actual payment. Now, the moment you say that word, furnishing of bank guarantee is not treated as actual payment, what will happen, my dear friends? That expense is not allowed as deduction, and that will be disallowed. Clear, my dear friends? Come on, what is the answer then? You have got 4 options there. Please tell me what is the correct option then. The correct answer is obviously, my dear friends, answer is option B. It is disallowed and it is not covered under section 43B. 43B wants actual payment but not bank guarantee. Next point. Examine the taxability otherwise of the payment made to Rodriguez by Varsha Private Limited under provisions of Income Tax Act. First of all, my dear friends, when payment is made to non-resident, my dear friends, if TDS is not done or done but not paid before due date of return of income, in that case, my dear friends, 100% is disallowed as per section 40A1. And when payment is made to resident, my dear friends, in that case, if TDS is not done or done but not paid before due date of return of income, 30% is disallowed as per section 40A1A. 40A1A. I'll highlight that point. Just 1 second, guys. Yeah, sorry. As per section 40A1, if payment is made to non-residents on which TDS is to be done, but TDS is not done during the previous year or done but not paid on or before due date of return of income, then 100% of such expenditure shall be disallowed. Shall be what, my dear friends? Disallowed. But the point here is, in the given case, commission is paid to non-resident, which is not taxable in India. And when it is not taxable in India, there is no requirement. There is no requirement to do what, my dear friends? TDS. And when there is no requirement to do TDS, there is no question of disallowance. I'm sure you got clarity on this point, my dear friends, because the question of disallowance will come only when TDS is required to be done, my dear friends. Here in this case, commission is paid to a non-resident and non-resident is sitting outside India. Income is accruing, income is received, both is outside India. It is very clearly a kind of a foreign income for non-resident. If it is foreign income, then it is not taxable in India. When it is not taxable in India, there is no question of doing TDS. When there is no question of doing TDS, there is no question of disallowances. Getting my point, everybody? So for this particular question, my dear friends, the answer should be option A, not to be disallowed under section 40A1. Are we getting clarity on this point, everybody? Come on, please reply, all of us. Please reply, my dear friends. Yes, thank you very much. Yeah. Comment on presentation of balance sheet. That's very fun. Next. Compute the GST payable for the given month, assuming the rate is as under. Hiring of excavators, 12%. Supply of manpower service and soil testing and evaluation service, 18%. But the point to be noted here is that for manpower service also we have to charge 12% only. But for soil testing and seismic evaluation, we will charge 18%. There is no doubt about it. Because that is very clearly a case of composite supply. Hiring out of excavators along with supply of operators is a composite supply, since they are naturally bundled. And let me tell you, my dear friends, as per section 8A of CGST Act, composite supply shall be taxable at the rate of principal supply. So in this particular case, my dear friends, let me write here hiring of excavators Come on, what is the value of the hiring of excavators, my dear friends? Hiring of excavator value is 36 lakh rupees, my dear friends. And on this 36 lakhs, I will charge 12% rate. Then supply of manpower. What is the value for supply of manpower? It is 40,000 rupees. For this also I'll apply 12% rate. Next point, my dear friends, soil testing and seismic evaluation. What is the value, my dear friends? The figure given is 5 lakh rupees. And for that, I'll apply 18% because that is not a composite supply. And that figure is 90,000 rupees, my dear friends. So very clearly, total GST liability would be 5,26,800 rupees, my dear friends. That is the story of the total GST liability that is required to be paid. So the whole question is all about the concept of composite supply. Very, 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 very simple and an easy question actually. There is no doubt about it. I hope you are clear with this point, everyone. Yes, very good. Thank you so much. Come on, my dear friends. That's the end of this very, very, very interesting case study. And I request your kind cooperation. Let's also discuss one more interesting case study today. And this case study doesn't take much time. The reason because most of the content is other than taxation content in this particular question.
Okay, let's move on. Next, we are saying case study number 37. 83. Okay, so this has got two MCQs. Let's read them quickly. Okay, so MCQ 2 and MCQ 4. Very easy. Okay, by which time the company Soft Bharti Private Limited should have its first board meeting. Okay, so this is first board meeting. When should the first board meeting be done in general? This is section 173. Section 173 talks about board meeting. Perfect, perfect. You guys are absolutely correct. It has to be done within 30 days of the date of incorporation. So let's look at the facts of the case and see when was Soft Bharti Limited, Private Limited incorporated. Okay, so the company named Soft Bharti Private Limited was incorporated on the 1st April. That's all we need. And thereafter, the first board meeting was done on 10th May 2022. Is this correct? Yeah, it's not correct, no? 1st April is incorporation within 30 days. That means till 1st of May, the company should hold its board meeting. Okay, but they have done it on 10th May. So this is incorrect, right? So we'll have to select the correct option. That means when should the board meeting be held? See here, the options are not perfect. Okay, the options are by 31st May. If you calculate from 1st April and you add 30 days, the last date comes to 1st May. But 1st May is not an option. Last option that they have given, the closest option is 30th April. Okay, so let's read the options, and if there is no correct option, we'll have to select the closest option. Okay. So by 31st May, private limited company is exempted from first board meeting by 30th April within 30 days of appointment of the auditor. Okay, so there's nothing like that. C is the correct answer here. Why? Because it's the closest. All right, because we don't have any other option. All right, let's move on. Case study number, MCQ 4. Let's read this. Whether the quorum required to conduct the board meeting of this Soft Bharti Private Limited has been met on 10th May. So 10th May, just now we have discussed, this is the first board meeting, right? So in the first board meeting, they want us to check whether quorum is present or not. So for that, we need to see how many total number of directors are there in this company. Then we also have to apply the provision as to quorum. Okay, that is given in our section 174. What is the provision? What does the provision say? How much is the quorum of the board meeting? Yeah, perfect. 174. 1/3 or 2. Perfect. Okay. So quorum of the board meeting is 1/3 of the total strength of directors or 2, whichever is higher. Any fraction has to be rounded off to 1. Now this, if there is, now when we calculate this, is it possible that some of the directors, they can attend the board meeting by video call also? Can they do it? Yes, no? Video call is allowed, no? Yes, it is allowed. Okay, video call is allowed, but except 5 businesses. For 5 businesses, video call is not allowed. Physical presence has to be there. Otherwise, even video call is allowed. What is that? Approval of annual financial statements, approval of board report, approval of the prospectus, audit committee meetings for considering the financial statements, and the approval of the matters relating to amalgamation, merger, demerger, acquisition, and takeover. For these 5 matters, video call presence is not allowed. Otherwise, even video conference is allowed as a mode of attending the board meeting. Got it? Now let's calculate based on this. So we'll need the facts. We'll have to check the quorum. Let's look at the case study now. Okay. So first, how many number of directors are there? See, there is one line given with respect to this. For this purpose, it was decided to form a company with 2 directors. And Deepak eventually becomes one of the directors. So there are 2 directors. One of the director is Deepak. This is a private company, so 2 directors are possible. And then there is one more director. Name is not given. Okay. Now let's read the company. The company was incorporated on 1st April and the first board meeting was held on 10th May. Then wherein the resolution for appointment of auditor was passed. So the business that we are conducting here is resolution for appointment of auditor. Appointment of auditor is being done. The auditor who is appointed is the same as ICTARA Limited. Now Deepak attended the board meeting through video conferencing as he was in his hometown in Rajasthan. Although another director was physically present at the board meeting. Okay, now for company secretary has got doubt relating to quorum. So what happens? This is a private company. This company has 2 directors, as we have just now discussed, Deepak and another one. They hold a board meeting. They discussed appointment of auditor, right? Now Deepak is present by video call and other director is physically present. So we have to calculate if quorum is present or not. Okay, so 1/3 or 2, whichever is higher. So here, what will be the quorum? Please tell me what is the quorum here. 2. Perfect. 2 is the quorum. Perfect. Right. Now 2 people are present, but one is present by video call. Is this allowed? It is allowed, except 5 businesses. Okay, so we just have to check if this is that business. So appointment of auditor is appointment of auditor can be done by video call also. It is not there is no prohibition, as we have just discussed 5 businesses. Appointment of auditor is not covered in any of these businesses that we have discussed. Okay, so therefore video call mode of attending the board meeting is possible. Okay, so can we say that the quorum is properly present in this meeting? Is the quorum present? Yes or no? Yes. Dheeraj says yes. Yes. Okay. So quorum is present. So accordingly, we'll have to select the correct option here. You guys have already answered. Okay. A option says quorum has been met. Quorum has not been met. Quorum is not met, but it can be ratified by the shareholders. Quorum is not met, but it can be ratified in the register of companies. No. So first option is correct. Quorum has been met. Okay. So this case study is done. Case study 37 is also done. Let's move on. I think we should be done. We should be done with one more case study for today.
Then moving on to the next one. Deepak case study. Deepak, who is a marketing person, right? So a person named Deepak is a marketing person who is working in a mid-sized corporate company, Iktara Limited in Noida. Deepak is married and he is so see again, a lot of this information is married, he's starting his own business, then he wants to do something else. Okay, all of those things are like extra information. I call it noise, or you can call it distractors, where it is hardly anything to do with the thing. So for example, they said at the one day his brother-in-law Akash was in Delhi, Deepak as his flight to his hometown was scheduled. So all of that is nonsense, to be frank, just to take your time. So here, if you look at the first and the last thing, see, unless there is the information which we don't have in other paragraphs, we may have to come back to this. But generally, the first intro paragraph doesn't give us much information, right? So lastly, they say Deepak has apprehension that if 100% exports are done, there may not be the need for GST registration if separate sale in domestic market are lower than 40 lakhs. So that is as far as GST is concerned. Then Akash on the perusal of Dujon first suggested Deepak to send free samples. So what happens when you send free samples under GST? That is this part. Then after having received the biometric machines, purchase department of Universal Bank was satisfied with the quality. And since it was being offered at a lower price than other bidders, Dujon called upon Deepak to send his first formal consignment of 1,000 biometric machines at 1,600. Okay, so this is the price. And one of the conditions was supplier should be registered as company as per the law of the land, and thereafter imports would be from India. So this is the deal. And here I was thinking GST, not only GST, here there are operational expenses of 360, variable expense of 1,000, selling and admin expenses of 2 lakhs, irrespective of quantum of unit sold. So this is some business proposal. Deepak made up his mind to resign from the company. So this is something which we also, when we started, we had done a lot of analysis, evaluation, and all of those things when we started IndigoLearn, right? So this is actually a personal journey as well. So we resigned from the company and came into full-time into teaching, something like that. First, he decided to meet the directors and then send a formal resignation letter. He approached directors. Audio is not clear. Is it better now? Deepika, is it better now? No. Okay. Anybody else facing audio issue? Clear. So Deepika, you can check at your end. Others have not faced the issue, so that okay, right. So Deepak made up his mind to resign from the company, so on and so forth. He approached and described his intention to resign so that he could start his new business and concentrate fully thereon. Since Deepak was very hardworking and trustworthy, the directors were reluctant to leave such kind of person. Directors instead offered him a proposal to form a new company under 55-45 shareholding. 55% will be done by Iktara and rest by Deepak. Okay, so this is the proposal, right? Fine. So we'll come back and see what kind of proposal is there. A consultant was hired and he decided to charge 30,000 for incorporation and do other statutory registration. This is your preliminary expenses. As per your accounting rules, as per Ind AS, you have to charge the entire expense when you incur. As per your income tax, which section is applicable for preliminary expenses? Which section will you apply for preliminary expenses? Anyone? 35, which one? Is it only 35? If I recall, it's 35D. Correct? Yeah. 35D, which allows you 1/5 of the expense to be, charged off every year. The company, namely Soft Bharati, was incorporated on 1st of April and thereafter first meeting was held. So this is a company law provision. For the year ended, they made donations amounting to 25,000 in cash to Seva Jagriti Sansthan. So what happens for cash donation? That is one thing. It is worthwhile to note that financial of Iktara Limited are prepared as per Ind AS since the same are applicable. Iktara acquired 60% of another company, Maya Private Limited. So acquisition is also there. Following are the draft results. What are the draft results? Revenue, other income, expenses, purchase, decrease in stock, employee benefit expense, depreciation, other expense, current tax, deferred tax, total tax expense, profit for the year. Okay. Then again here, this is wrong. It cannot be equity and liabilities. It has to start from assets. Okay. And then here also again you'll have other equity and all. So as we look at this, we will see. Current liability, this will be under financial liability. We don't have fixed asset, we have something called as PPE. And then trade receivables, you classify under financial liabilities. Financial asset, cash and cash equivalents also financial, current investment also financial assets. Additional information. Deferred tax of 6,000 is created due to the following temporary difference. Difference in depreciation amount as per income tax and accounting profit that is created 6,000 of DTL. There is only one fixed asset in the company whose closing balance as on 31st March of 23 is as follows. 1 lakh here, 80,000 here. So 1 lakh and 80,000, if you see, there is a difference of 20,000 and 30% is the tax rate, right? 30% is the tax rate. And this 30% on 20,000 gives you 6,000. So that is how the DTL has been calculated. The directors have recommended dividend of 15,000 for the year ended March 23, which has been deducted from reserves and surplus. Dividend payable has been grouped under other current liabilities. Now, see this topic, if you look at the analysis of financial statement chapter, some of the questions there, something similar to that. Now, here what they have done, dividend they have deducted. Now, dividend which has been recommended by board of directors, we don't account for it. When do we account for it? We account for it when the shareholders approve it. Now, when the shareholders have not yet approved, can I deduct that dividend from reserves? I cannot. So what I will do, I will add this back to reserves and I will remove this amount from the current liabilities. Okay. Then the company has defaulted in certain payments, the details of which are given below. Government statutory dues, statutory, 15,000. So this has been defaulted. Under section 43B, you'll face a disallowance. The amount has not been paid. Capital advances amounting to 50,000 has been grouped under other non-current assets. Other current assets, 51,000 comprise of interest receivable on debtors. Okay. Current investment of 30,000 are in shares of a company which was done with the purpose of trading. Current investments have been carried at cost in the financial statement. The fair value of current investment is 50,000. So if it is held for trading, we apply fair value. So we have to do it under fair valuation. Assume that increase in fair value to profit and loss is also taxable. Now here we get a hint that all these inconsistencies we have to consider while calculating the tax provision as well. Following transactions were omitted. Actual gain on employee benefit measurement. Now if there is an actual gains, we'll classify it under OCI. Please note financial statement have not been approved and you are required to ignore MAT calculation. Now this entire question is on financial reporting, some part of taxation. Okay, a very comprehensive one, which will give you a good amount of comfort for handling such questions in the examination. Right. So here let us see what is the MCQ part. At what minimum price Deepak should accept the offer of selling one machine to Universal Bank? Now, out of these four, none of the above should not be an option actually. Out of these four, what should be the minimum price? Okay. Now, for this, there are two approaches actually. One is come back to the question and see what is the cost breakup. So here is the cost related detail. Deepak inquired and researched for the same in the domestic market. And after due scrutiny and research, he decided to choose the manufacturer Biotechno Private Limited from Mumbai to be the one from whom he would supply the material. At first, procured 3 machines from company at market price and send the same sample to South Africa. As per estimates of Deepak and Akash, there would come fixed operational expenses of around 360. So, a fixed operating expenses of 3,60,000. Further, selling and administrative expenses of 2 lakhs. Irrespective of quantum of units sold. So that is what will happen. And variable expenses of 1,000 per unit. So variable expense of 1,000 per unit and they have a consignment of 1,000 biometric machines at 1,600 per machine. So 1,000 is the variable cost. For 1,000 machines, the cost, other cost, fixed cost is 560. So this divided by 1,000, if you do, you get 560 per machine as a fixed cost, 1,000 the variable cost. So even if you want to do it on a cost to cost basis, 1,000 plus 560, 1,560 should be the option. But there could be another way to look at it, that is fixed expenses anyways I will be incurring. So when the question asks for minimum price, you can also quote 1,000 if you are trying to establish the market, right? Now, it depends on the assumptions we take. I hope such kind of confusing questions do not appear in the examination, because the minimum price, if you say till the time I am recovering my variable cost, because fixed cost anyways I will be incurring, till the time I am recovering my variable cost, 1,000 looks appropriate. If I am looking at a total cost basis, 1,560 looks appropriate, right? But if you ask me, minimum price I would have taken 1,000 in the examination, but institute has taken, I think, 1,560. They have taken 1,560. Now they say, since selling price is greater than the cost, Deepak may accept the offer. Now normally, accept or reject offer you do on a variable cost basis only or marginal costing basis only, right? So that is one thing which you can have both the views. Then, which Ind AS does ICTARA Limited which Ind AS is ICTARA Limited required to apply for consolidation of Soft Bharati's Private Limited financial statements? Now, what does the question say? The question says they are applying Ind AS. When you apply Ind AS 110 becomes applicable. There is no confusion as that part as far as the consolidation is concerned. Now, whether the financial statements of Soft Bharati Private Limited are correctly presented as per the applicable FRFs. If not, prepare the revised financial statement of Private Limited after careful analysis of facts and information mentioned in the case study. We are also required to consider the income tax implications, because there are a lot of additional information given for the purpose of income tax. We have to recalculate that. Okay, so this will involve, one is correcting the financial statements, second is rectifying the tax related errors and doing a comprehensive representation, right? Now coming back, so what we need to do is, now especially in this case, we cannot leave any point which has financial or numbers there. Now so what you have to do, you have to scan through wherever you see financial numbers. Here we are talking about introduction. Here is nothing related to finance. Here they have given us some information about this cost and all of those things. Now these are what? These are expected. These are expected cost and all of that. So that is also not relevant. Then this is an acquisition part here. So what you have to do, you have to mark this. 30,000 is charged as an expense in the books. This 30,000 is preliminary expenses. So this will have a deferred tax and taxation consequence. Then Here there is again no information. Then here they made donations of 25,000 in cash. So what is the tax implication that we will see? Then they acquired 60 lakhs, fair value of identifiable asset is so much, and the fair value of 40% of ordinary shares is 55 lakhs. Carrying amount of Maya Private Limited net asset is 105 lakhs. So here in the business combination part, if at all we have to do something, here we will calculate goodwill and all. Now, Soft Bharati Private Limited. Now, who is Soft Bharati? This is a new company which was incorporated. Okay. And now in this, Iktara holds 55%. Now, additional information, deferred tax has been created. There is only one fixed asset. Okay. Then the dividend, we have to adjust it. Then government statute dues, this have a income tax implication. Capital advances, presentation implication. Other current assets, presentation implication. Current investment are now at 50,000. So what has happened is 30,000 of current investment at fair value has become 50,000. So here I'll have a 20,000 of income or other income. Following transaction omitted actuarial gain, this will go to OCI, right? So now what we have to do is, if we come back to the P&L one by one. Now what we have first, 10 lakhs of revenue. Is there any information on revenue? There is no information on revenue. So we can leave as it is. Other income, they have given 1 lakh. Now what happens is here, I have to add fair value gain. So what you can do is, after the class, you can look at the final presentation. Please understand the impact. Fair value gain on investment, I have to add 20,000. So this will become 1,20,000. This is 10 lakhs. Okay, 10 lakhs plus 1,20,000 will become 11,20,000. Then expenses. Is there any change in purchase of stock in trade? No, as it is 5 lakhs. Is there any change in increase and decrease in stock? Nothing has been given, so as it is 50,000. Employee benefit expenses. Now 175. Now they have given actual gain. Please understand, actual gain will not come in the P&L. It will come under OCI. So here also you may do a mistake by adding that gain here, but that is not required. This 1,75,000 will remain as it is. Then depreciation, again they have not given any further information, 30,000 as it is. Then other expenses, no further information, 90,000 as it is. Okay. So if I do all of this, 745, this remains 745. And because I've added 20,000 here, this 355 will now become 375,000 or 3,75,000, right? Now, current tax they have calculated, we have to revise this because a lot of information has been given. So as far as your case study are concerned, you will have to recalculate the income tax using the income tax provision and deferred taxation also, if at all there is a requirement to recalculate, because there is a 35D implication that also we need to consider. So first thing, calculate income tax. Second, defer tax. So both of these things have to be done, right? Now to calculate income tax, what we will do, we will take profit before tax 3,55,000 as given in the as we have calculated in this particular P&L. Sorry, not 355, 375. 350 was given, 375 we have calculated, right? Now from this 375, what you have to understand is, first I'll do here only net profit before tax, 3,75,000. Now if you go back here, this is the income tax implication where we said 30,000 has been debited to the income statement, whereas as per Income Tax Act we'll get only 1/5 in the current year. Means we have charged 30,000 here to arrive at the P&L. We will be allowed only 6,000, which means 24,000 will not be allowed. So add preliminary expenses disallowed under section 35D. In exam, don't write D by A. This is only for the class. Exam, write fully. How do we calculate that? 30,000 minus 30,000 divided by 5. That brings me to 24,000. This will increase my income. This will increase my income. Also understand the carrying amount of asset. There is no carrying amount of asset for preliminary expenses. So here if you calculate deferred tax impact, preliminary expenses, carrying amount, tax base. Carrying amount here is 0. Tax base is 24,000. Tax base is 24,000. Tax base has a higher asset. Carrying amount is 0. So 24 minus 0, you have a difference of 24,000. This will be a deferred tax asset because in future you will get deductions. Okay, that is the first part. Then cash donation to Seva Jagriti Sansthan. One thing is donation, so that is one thing which is disallowed because you have given it in cash. So that part also you'll add back. So this part 25,000. 25,000. Right. Then as far as depreciation is concerned, they have said as per books, it is 1 lakh, the fixed asset value. As per income tax, it is 80,000. As per books, it is 1 lakh. As per income tax, it is 80,000. Now there is a difference of 20,000. Now what is this? This is closing balance. Now we also need to calculate what is the depreciation charged during the period. What is the depreciation charge during the period? See, I'll erase these ones. One is the closing balance difference that we have understood. But then how much of depreciation has been charged during the given period, that also we need to consider, right? So difference in depreciation amount as per income tax and accounting profit is 6,000. That you have seen there is a difference of 20,000 here, and 30% of that brings us to the difference of 6,000, right? Now if you come to the balance sheet, fixed asset is 1 lakh. Closing balance as per the company's book is 1 lakh. That is given to us in the question, right? Now, how much depreciation we have charged? Here they have said you have charged depreciation of 30,000. So one lakh 30,000 is the depreciation. Here it is 80,000. Means what? Extra 20,000 of depreciation has been charged for income tax purpose. So when you calculate the thing, you can say less additional depreciation as per income tax. How much is the additional depreciation? Additional depreciation as per the income tax is 20,000. But for presentation purpose, what you can do is you can say disallow 30,000, allow 50,000. That is how we calculate, right? So that 20,000 will be the difference. Then this part you have considered. Government statute reduced 15,000 has not been paid. So that also we have to disallow. So add 43B 15,000, right? So 375 plus 25, 4 plus 24, 424, 424 plus 15, 439, 439 minus 20, 419. So 4,19,000 is the taxable income. Tax on which you have to pay at the rate of 30%. 419 into 30%, if I have to do 419 into 0.3, I get 1,257,000, 1,25,700. Cess and all you will not consider because they have just said tax rate is 30%. So income, though we are applying income tax provisions, we are saying because we don't know, it may be a 25% company also, but because they have said 30%, we will take 30% as it is. So the current tax is 125,700. Now the problem here, one more thing you have to understand is, the question has said current tax is calculated at 30% on PBT directly without doing any adjustment related to income tax. So that is why we have to do all the adjustment and calculated 1,25,000. 1,25,000. How much was the amount? 700. This will be the current tax. Now, deferred tax. As far as deferred tax is concerned, you have multiple things. One is property, plant, and equipment. What is the carrying amount? What is the tax base? Okay, carrying amount as per books we have seen it is 1 lakh. Tax base is 80,000. Difference is 20,000. Now, this 20,000 of difference will create a deferred tax liability because carrying amount of asset is higher. Other way to understand that is, we have claimed higher depreciation in the current year. Subsequently, we will claim lower depreciation. So this will result in a DTL 20,000, right? Then we have preliminary expenses. Carrying amount we have 0. Tax base is 24,000. This difference of 24,000 will create a DTA. So why DTA? Because in future, you will have to pay a lower tax because of this deduction. So it will create a DTA. Is that clear? Then we have donations. So not donations, statutory due. Now, statutory dues. Company has defaulted in certain payment, details of which are as follows. Government statutory dues, 15,000, which is grouped under other current liabilities. The amount has not been paid till date. Now, this, when you make the payment, now we don't know what kind of dues I have to set. If it is, for example, if it is employees' share of provident fund, then you will never get the deduction. Okay, never ever you will get the deduction. But if it is employer's provident fund, then you will get the deduction on payment basis, right? So, or if it is, let's say, GST liability payment, even once you make the payment, you'll get the deduction. So this 15,000, it depends, because they have not mentioned anything. We can assume that you will get the deduction on payment basis. So there is one more item where carrying amount is 0 and 15,000 is as per taxation. This 15,000 will create a deferred tax asset. Okay, so 15 plus 24, 39 minus 20, you have 19,000 net creation of DTA. If you multiply this by 30%, you get 5,700. Any questions here? Any questions here? Okay. Right. So we have calculated DT also. So then what will happen is, here in income tax, you will take the current tax as you have calculated, 1,25,700. Deferred tax asset, so it will be a negative number. Deferred tax asset will be a negative number. Sir, why negative number? Because it is an asset. Because it is an asset, it will show it as a negative number. Reduction of expenses. Right? So you will do minus, calculated, 5,700. Minus 5,700. Then there are items. Donation cash basis, no, permanent. You will not get in future also deduction. Right? Then we have actual gains which we have to show under OCI. We'll have OCI item, 1,000 of actual gain. And on this tax impact is 300, which you have to present separately. So now what we'll do is, after we've understood till PNL, let us look at the PNL solution in a neat format. That will help us understand, how do we present that in the final, answer. So this 10 as it is, 120 we have understood. This 20,000 is your fair value gain. Then this is as it is, this is as it is, this is as it is. Depreciation is the same, other expense is the same. Then current tax 125,700. This deferred tax 1200, they have not considered government statutory dues. But those statutory dues, unless it is something like, let's say, employees' provident fund contribution or something related to employee, which is disallowed under, I think, 36(4)(a), if I'm not wrong, right? That will be permanently disallowed. But otherwise, something like, let us say, something you have not paid to the government, subsequently when you pay, those covered under 43B, subsequently you will get the deduction. So DTA will be created. So this part is wrong here. Then under other comprehensive income, items that will not be classified to P&L, remeasurement of net defined benefit plans 1000, and income tax relating to those items 300. So this is the presentation 700 and the net amount of 251 200. Now, moving to the balance sheet. First, we'll start with assets. Then we'll have non-current assets, 1 lakh, property, plant and equipment. Then financial assets, long-term loans and advances. Now, what advances are this? If we come back here. This one, long-term loans and advances. This is a financial asset. Okay. Then deferred tax asset, on a net basis, you have to present it. So we had calculated 4,500, and the other comprehensive income component for actual gains or losses, that will also be a deferred tax component only, because that is something on which you will pay tax in the future. Okay, that will not be paid, you will not pay the tax now. So 4,500 minus 300 on that, this has to be 4,200. Sir, how will the balance sheet tally? The balance sheet will tally because your other equity number will also change, appropriately. So the balance sheet will automatically tally. Then other non-current assets, which are capital advances, 50,000. Now, please remember, other non-current assets, this capital advances, we don't show it as a financial asset because we will not get cash back. We will not get cash. We will not get financial asset. We'll get some other inventory or some other property, plant and equipment. So that is not a financial asset. Then under current assets, we have inventories as it is. Financial asset, investments, 50,000, the fair value. Trade receivables as it is, cash and cash equivalents. And other financial assets, which is interest receivable on loan, 51,000. Then under other equity, we'll have reserves and surplus and OCI related aspects. Then provisions. So what is there in the provision? Let us see. Long-term provisions they have given as 25,000. And here if you see, actual gain on employee benefit measurements, right? Now, if there is an actual gain, my liability will come down. If there is an actual gain, my liability will come down. The net liability will come down, right? So this 1,000 rupees will deduct from the liability side on the balance sheet. Right? Then trade payables, other financial liabilities, 15,000. Now, this is something which is, let's go back. You have other current liabilities of 45,000. Now, in this 45,000, we have dividend of 15,000. This dividend of 15,000 has to be removed because we are not liable to pay the dividend. So that 15,000 you will remove. Then you have government statutory dues. Government statutory dues. Now that government statutory dues, which is payable, that you will show it separately, 15,000 as a financial liability, and remaining liability of 15,000, you will show it under other current liabilities. So other financial liabilities, 15,000. Government dues, other current liabilities, 15,000. You will show it separately, not as part of financial liability. Right? Then current tax, what you have calculated, and deferred tax we have already considered. Right. Now, when you come to other equity calculation. Good morning, everyone. There was some interruption towards the end. So what I'll do is I'll take a few parts from yesterday, and then we'll continue with with the remaining part today. So video was continuously getting stuck yesterday. Right. So let me share the screen. So we're discussing about this where we had to correct the Ind AS financial statements, right? We were at this point and I lost the continuity at that point of time. So trade payables we've done, then we have other financial liabilities, right? Now, amongst other financial liabilities, again, if we come back to the question, you have 45,000 of liability, right? Now, in this other current liabilities of 45,000, we have 15,000 of dividend, which we have to adjust. So what we need to do is we have to reduce 15,000 here and we have to add that to our reserves and surplus. So whatever is the reserves and surplus amount, to that we have to add the particular amount. Okay. So that is one thing. And there is a statutory liability of 15,000, which is not a financial liability, that will be presented separately. So other financial liabilities 15,000 and government statutory dues. This is statutory spellings. I don't know how do they create it. This is 15,000. And once you see here, profit for the year 250,500 directly from the balance sheet. Dividends will not consider. Why don't we consider dividend? Because it has not been approved by the shareholder. So we will not deduct dividends. And that 15,000, what was deducted from this particular amount in the original balance sheet, that you will show it under reserves and surplus itself. Okay. Then that is it. And then current tax liabilities, what we have calculated, that will be presented here. Now, moving on, you will also show statement of changes in equity. So you can do a table format also. Okay, equity, share capital, other equity, all of those things in a single table. So I would suggest you do something like equity, share capital, other equity. If you have other comprehensive income, something like that, for other equity, you can give the breakup, other comprehensive income, reserves and surplus and all of those things. That breakup you can give, or you can present it in this format. So this is for equity, share capital, other equity. Right? Then proposed dividend is subject to approval of shareholders and hence will not be recognized as liability. That will not be done. So that part it is very clear. These notes not required. This is just the explanation of what are financial assets and financial liabilities. Then other current financial liabilities given 45,000. Dividend declared, we'll adjust it 15,000. Reclassification of statutory dues. Now, please understand, anything with the government, statutory dues are not our financial liabilities. So that we will present separately, right? As per Ind AS 10, events after reporting date, if dividends are declared after the reporting period, but before the financial statements are approved for issue, dividends are not recognized as liability at the end of the reporting period because no obligation exists. So these dividends are disclosed in the notes in accordance with Ind AS 1. So only that will be declared. You will not be recognizing it as a liability. Then 20,000 has been added due to increase in fair value because we are considering it to be a fair value to P&L. This calculation part we have already done, and this calculation of deferred tax also we have done. Here they have not considered that 43B part, that also you need to consider. Okay. Then the next question. Calculate the non-controlling interest in the books of Iktara Limited for investment made in Maya Private Limited by both the methods mentioned in Ind AS 1. Now, what are both the methods? Either fair value or proportion of net asset method, right? Now, Maya Limited is what they are referring to. So let us come back to the case. During the year, Iktara Limited has acquired 60% of ordinary shares of another company, Maya Private Limited, for 80 lakhs. So it is fine. Fair value of identifiable asset is 135 lakhs. This is fair value. The fair value of 40% of the ordinary shares owned by NCI is 55 lakhs. So NCI share using the fair value method is equal to 55 lakhs. Carrying amount of Maya Private Limited net asset is 105 lakhs. Now, if it is 105 lakhs into, we acquired how much? We acquired 60%. So into 40% is NCI. So 105 into 40%, 140% is 40. 40% of 5 is 2. So it is 42. So under fair value method, it is 55. And under the proportionate net asset method, it is 42. Very, very simple calculation. Nothing to be worried about it. So easily 2 marks or 3 marks, whatever marks they allot, that you can consider it to be yours. So paragraph number and all are not required. Ind AS 103 requires at the acquisition date components of non-controlling interest in the acquiry that are present ownership interest and entire. Again, there was some issue. Okay, so let me reshare this screen. I think to get something checked at my end. Just give me a moment. Is the screen visible? Is the screen visible? Okay. So now, instead of writing all of these, what you can simply do is you can take it from the notes and say non-controlling interest can be measured in the acquiry either at fair value or proportionate share in the recognized amounts of identifiable net assets. So first option, if it is measured at fair value, you have 55 that we have calculated, and proportionate share of identifiable net assets, if you do, in that case 54. Just a moment. I think I misread the question, or because net asset is given to be 105. Sorry, it's the carrying amount. So sometimes in a hurry, we can also do mistakes. Fair value of identifiable net asset is 135 lakhs. So if identifiable net asset is 135 lakhs, so this is incorrect. You have to go into 40%. 13 into 4, 52, and 5 into 4, 2. So 54 lakhs is the identifiable net asset. Now, if you look at the question, calculate the non-controlling interest in books of Iktara Limited for the investment made in Maya Private Limited by both the methods mentioned in Ind AS 103. So you are actually required to only calculate the amount. If they want us to write journal entries, they should specifically mention pass the necessary journal entries. But because they have given journal entries, let us have a look at it. In examination, they will give specific requirement and you can stick to that particular requirement itself. So fair value 55 and by the other method, it came out to be 54. Now, how do we recognize that? Net assets 135, 2 non-controlling interest 55, 2 cash or to bank, actually to bank 80. This is how you'll measure. In subsequent measurement, you will say to investment in Maya Private Limited because you will knock off the investment in the consolidated financial statement. This approach is generally when we are solving the examination question, so you can write directly to bank. In the other case, here it is matched. In the other case, what has happened is purchase consideration is 80, non-controlling interest is 54, so the total is 134. Assets is 135, so there is a capital reserve of 1. So here you can also write a note saying if there is a bargain purchase, the entity must reconsider fair value of net assets. Otherwise, you will recognize this one as a capital reserve. Right? A simple and a straightforward question.
In this particular case study, majority of the content is related to other than taxation. So my suggestion for this particular case study is directly let's look at the question and then decide our relevant paragraph for the purpose of taxation. They have given some financial statements in the question. So very clearly the question is more related to your financial reporting. And you can see there is something called deferred tax asset, deferred tax liability and all. Multiple choice question. At what minimum price Deepak should offer of selling machine to Universal Bank? Is that related to your taxation? Tell me, my dear friends, is that related to your taxation and all? That's related purely towards your costing related element. Why would that have an effect on taxation as such? Directors meeting. Then we talk about Ind AS. What whether quorum required, that is corporate law. Then Deepak thinks that export sales Wait a second. Deepak thinks that export sales are not included in definition of aggregate turnover since export sales are exempt from tax. Whether export sales should be added to the domestic sales while checking aggregate turnover? Come on, somebody please reply. As per GST law, for aggregate turnover purpose, do we include export sales? 101% answer is yes. The reason because definition of aggregate turnover, section 26 of CGST Act clearly specifies that aggregate turnover covers all taxable supplies, exempt supplies, interstate supplies, and exports on all India basis under same PAN. But it does not include the GST amount and does not include the value of inward supplies on which recipient is liable to pay tax under RCM. But export sales is always included along with domestic sales, my dear friends. Come on, tell me which option is most suitable option. Tell me. Should I talk about something called SAK nation and all, South Asia and all? Definitely answer is no. Answer is option D, my dear friends. Pretty simple answer. Export sales should be added along with domestic sales. Very, very simple and easy part. You're getting what I'm saying, right? That's it. Next. Sixth question. Whether the financial statements are correctly prepared as per financial reporting framework. If not, prepare the revised financial statement. Financial reporting. Calculate non-controlling interest in the books of IndigoLearn Ltd for investment made by the both method mentioned in Ind AS 103. So these also not related to your taxation, my dear friend. 103, I think you know that Ind AS 103, business combinations and all. That's it. That's clearly related to other than taxation. So very, very simple case study where not much of taxation is involved. Generally, what happens is a lot of case studies, we get too much of taxation content, but this case study is just one point of taxation. Got it, my dear friend? Yeah. Student asking, sir, one doubt. Yes, please ask, my dear friend. Well, sir, while calculating valuation for customer, if transportation is done in airways, we are talking from which point of view? Income tax or GST? 20% of expense, whichever is no customs you're talking about. Oh, you're talking about goods are imported by air. Oh, very good. I got your point. So if the goods are imported by air, we always calculate FOB, right? To FOB, we add something called insurance and freight. This freight figure, we can take actual cost or 20% of FOB, whichever is lower. That means your actual freight cannot be more than 20% of FOB. If it is more than that, then we'll take it only maximum 20% of FOB. That story will come in two cases. One case is where goods are imported by air. Second case is a case where freight charges are not ascertainable. Does that expense include demurrage charges? So demurrage charges are basically a part of transportation cost itself. But the only problem, we don't include them for this 20% limit because generally demurrage charges are incurred after CIF stage. CIF stage means goods are imported at the customs station and then they are incurred this cost. So when they are incurred after CIF stage, we will not include that for 20% limit. Light rate charges also same logic. Light rate charges, demurrage charges, both cases the logic is same. It is incurred after CIF stage. That's why we don't include them generally as separately in that 20% limit. Got it. Done. Thank you so much. Good, my dear friends. That's all for today's discussion. The balance will take for tomorrow, my dear friends. And one student was asking me, so which is the best book for carrying for direct and indirect taxes to the examination center? See, I can give you some, what do you call, some charts for TDS, some chart for PGBP, capital gains and all. But ultimately, we really cannot expect what kind of question can come, especially from a subject like taxation. So the best book to carry to the examination is always a direct tax ready reckoner or indirect tax ready reckoner, which you would have used in your office. And why do you want to buy that? Take from your office to take to the exam for a couple of days. It will be easy for you to search. Ready reckoner is the most best possible book than any book which is available in the market. It's very easy to trace and find out whichever section we are looking about it. Clear? That's it. So friends, thank you so very much. Take care. See you all tomorrow in the next session. Next session, we'll talk about some more interesting case study. And again, student is asking same question. Sir, can we expect repeated question? I told you it is possible, but it is not that the same exact may be repeated. There could be some modification which could be coming. But don't expect that same to same will come. But these things, what happens is that when you look at the concepts, now you got a good question. Can we expect repeated concept? That is possible. That is very much possible. Yeah. Thank you so very much, my dear friends. Take care. See you all in the next session. Shivateja signing off. Thank you so much. Bye-bye. Thank you.
Okay, fine. Let's go to the next case study. The next case study which we are going to see is case study number 38. We'll first have a look at the questions and then we'll go to the case study. The first question here is whether the understanding of Mr. Rahul is correct with respect to the appointment of chairperson of audit committee. Now, who has to be the chairperson of audit committee? An independent director. The chairperson of the audit committee should be an independent director. So we'll first have to read what Mr. Rahul thinks, and only then we can say that whether his understanding is correct or not. Question number 4 says, how should CA Om correct Mr. Rahul with respect to latter's understanding about the meetings of audit committee of the company? So what Rahul understands, let's see, and then we can see what should be told him to make him understand the correct provision. And the next one is, which of the following statements is correct with respect to the approval of annual remuneration of Miss Shweta? So we'll first go have a look at the case study and then come back here and solve the MCQs. So let's see what Rahul's understanding is. So Mr. Rahul is skeptical regarding the provisions of the Companies Act 2013 applicable with respect to constitution of audit committee. He accordingly discussed his understanding with CA Om and asked him to rectify in case he is not correct. So he has some doubts. So he discusses what he understands with Mr. Om, who is a chartered accountant, and asks Mr. Om to rectify him wherever he's wrong. He told CA Om that he is following understanding with respect to the provisions applicable for audit committee. So let's see what his understanding is. First point, it says that any senior member of the company having expertise of accounting and financial management can be appointed as the chairperson of audit committee. So no, this is not correct. Only an independent director can be appointed as a chairperson of the audit committee. So here we get the answer to our first MCQ that Mr. Rahul's understanding is not correct about who can be appointed as the chairperson of the audit committee. The audit committee of the company shall meet at least twice a year. So these are the two understandings of Mr. Rahul. One is that he thinks any senior member who is in requisite expertise can be appointed as chairperson of audit committee. And the second understanding which he has is that the audit committee shall meet at least twice in a year. Now, CA Om, he briefs Mr. Rahul about the provisions which are related to audit committee. He says that every listed company shall constitute qualified and independent audit committee in accordance with the terms of reference, subject to the following. What are the conditions? The first one is audit committee shall have minimum 3 directors as member. 2/3 shall be independent directors. However, if it is audit committee which has SR equity shares, then it should comprise only of independent directors. So this is something which we have understood. And all the members of the audit committee shall be financially literate, and at least one member shall have accounting or related financial management expertise. And then he explains what the term financially literate means. And also after that, CA Om continued discussing various other provisions of audit committee in detail with Rahul and cleared all the confusions of the latter with respect to such provisions applicable to the company. Further, an annual remuneration of Miss Shweta is 3.5 crore. So there's a lady, Miss Shweta, who receives annual remuneration of 3.5 crore. Annual remuneration payable to all the non-executive directors is 15 crores. This amount of 15 crores include the annual remuneration which is payable to Ms. Shweta also. The annual remuneration of Ms. Shweta has been recommended by the board of directors and has been approved by the shareholders in general meeting. However, no special resolution was passed for the same. So the total remuneration which is payable to all the non-executive directors is 15 crores, out of which 3.5 crores is paid to Ms. Shweta. And this 3.5 crores is approved by the board of directors and also the shareholders, has been recommended by the board of directors and has been approved by the shareholders in the general meeting. However, there's no special resolution which has been passed for this. So let's now first have a look at the relevant regulation of SEBI and then come back and answer all the 3 MCQs. So for the 3rd and 4th MCQ, we are going to use Regulation 18, and for the 5th MCQ, Regulation 17. So Regulation 18 of LODR regulation says that the chairperson of the audit committee shall be an independent director and he shall be present at AGM to answer the shareholders' query. So with this, we know that the answer to question number 3 is that whatever Rahul's understanding is not correct. Then Regulation 18, Subregulation 2 says that audit committee shall meet at least 4 times in a year. What was Rahul's thinking? He thought that the audit committee shall meet at least twice a year. However, the regulation says that the audit committee shall meet at least 4 times in a year. And then there is Regulation 17. Regulation 17 says that all fees, if any, paid to non-executive directors, including independent directors, shall be recommended by board of directors and shall require approval of shareholder in the general meeting. So the fees which is being paid to Ms. Shweta has been recommended by the board and has also been approved by the shareholders. So the fees which is being paid as per the regulations. However, if the fees which is paid to any non-executive director is more than 50% of the total remuneration which is paid to all the directors together, that is all the non-executive directors. So that is in our situation, if it is more than 50% of 15 crore, that is if the remuneration would have been more than 7.5 CR, then in that situation, a special resolution of shareholders would have been required. So in general case, it is only approval of shareholders in general meeting and recommendation of board of directors. However, in case the remuneration which is payable to any non-executive directors is more than 50% of the total remuneration which is paid to all the non-executive directors, then in that situation, a special resolution is required. And that is the reason why in the case study, there was a special mention that no special resolution has been passed for it. Okay. And if in the case study, the remuneration of Ms. Shweta, if it had been more than 7.5 crores, then in that situation, special resolution would have been required. Let's go back to the case study and let's answer the questions. But before that, have you understood the provisions? Have you understood the provisions? Yes. Okay. So third question says whether the understanding of Mr. Rahul is correct. So no, the understanding of Mr. Rahul is not correct, as only company secretary can be appointed chairperson. So no, this is not the correct option. So no, yeah, as chairperson has to be an independent director. So the correct option is option B. Talking about fourth one. So there's no need to correct Rahul, as his understanding about the meeting is correct. So no, his understanding about meetings is not correct. So it is not option A. CA Om should inform Rahul that the audit committee of the company shall meet at least 4 times in a year and not more than 180 days should lapse between 2 meetings. Let's go to another option. CA Om should inform Mr. Rahul that the audit committee of the company shall meet at least 6 times in a year and not more than 60 days should lapse between 2 meetings. So no, this is not the correct option. Let's go to the next one. CA Om should inform Mr. Rahul that the audit committee of the company shall meet at least 4 times in a year and not more than 120 days should lapse between the two meetings. So what do you think? Which option is correct? Is it option B or is it option D? Which option do you think is correct? Option B or option D? The meeting has to be conducted 4 times a year. But how many days gap do you think should be there? 180 days or 120 days? Option D, correct. So the correct answer here is option D. CA Om, he should inform that the meeting should have happen at least 4 times in a year and not more than 120 days should lapse between two meetings. Now moving on to question number 5. Which of the following statement is correct with respect to the approval of remuneration which is paid to Ms. Shweta? So the approval of annual is in conformity with the relevant provisions of Companies Act. So this is as per the provisions of the Act. Second point says that it is not as per the provisions as special resolution is required for the by the shareholders. Option C says it is not as per the provisions as the recommendation by board is not required. Option D says that it is not as per regulation as approval of registrar is required. So which option according to you is correct? It is obviously option A because this is not a situation wherein the annual special resolution is required because the remuneration is not more than 50% of the total remuneration which is being paid. So no special resolution is required. So the remuneration which is being paid approval is in conformity, is in accordance with the provisions of the Act. Have you understood this? Is this clear?
So the next case we'll take up is this case of Sudarshan Limited, a listed company engaged in the business of manufacture of LED products. The company has vast range of LED products. Okay, so these are all descriptive things. Company continues to cherish its ultimate passion, just extra information. And they appointed Mr. Rahul and Shweta as executive director and non-executive director. He's an MBA. So almost all the case studies, someone is an MBA from IIM. Furthermore, Ms. Shweta, a CFA, holds an experience of 8 years in the similar industry and so on and so forth. So that is given. Okay. So let us directly jump to the question. Now here, they have not given specifically issues. So, as we read the questions, we'll get to know. With respect to purchase of building and pre-installed office furniture, this is a liability to GST. Place of supply. Correct in respect of chairperson of audit committee again related to law. How should CA Om correct Mr. Rahul with respect to latest understanding about audit committee? Which of the following statements are correct with respect to approval of annual remuneration of Ms. Shweta? Right? Now coming to the other part. What all matters are discussed in the management discussion and analysis report? So that part again will cover under law. What should CA Om tell Mr. Rahul about latest query on GST implication with respect to place of supply? Again, place of supply. Discuss tax implication, TDS. So nothing to do with FR. I don't know. We marked it as an FR case study, but it doesn't have anything related to FR.
Hello, my dear students. Please confirm that I'm visible and audible both so that we can start the discussion. Yes? Done. Good. Thank you very much. Hello, sir. Hello. Yeah. So friends, today it's time to talk about 2-3 interesting case studies where we'll talk about some good elements in the case studies what we have got so that we get clarity upon a lot more interesting point. And today case studies are slightly peculiar case studies where we have got different points involved in that. So carefully we'll see that. It will take some time, but let's understand them in detail. Are we ready, my dear friends? Shall we start the discussion? Yes. Thank you so very much. Come on. Let me proceed. I hope the screen is visible. Please confirm, my dear friends. Yeah. Thank you very much. We are looking at an interesting case study. Please see that. Sudarshan Limited is a listed company engaged in the business of manufacture of LED products. So what is that manufacturing, my dear friends? They are in the business of manufacture of LED products. It is one of the most renowned and trusted LED manufacturers of India. The company has been manufacturing high-end, eco-friendly LED bulbs and lights that are cost-effective and also energy efficient. So ultimately, the whole point is that they are engaged in manufacture of LED products. The company has remained consistent in manufacturing long-lasting LED products. It is having its corporate office in Delhi, and the company has recently doubled its revenue under supervision of the owner-founder of the company, Mr. Raj Sudarshan, who is also the CEO of the company. And Raj graduated from Riverdale Country College in New York City. He started his company with a very less capital, and today the company's net worth has increased manyfold. So he started with a very nominal capital, but now the company's net worth has increased multifold, my dear friends. Then, at present, company enjoys good market share and reputation. The company has a vast range of LED products for indoor, outdoor, solar, architectural, and linear lighting. Next line they give. The company continues to cherish its ultimate passion for LED lighting innovation. It has a team consisting of skilled members who have decades of experience in lighting industry. Company values innovation, research, learning, and adapting to change. The company has a policy of giving priority to innovation and younger talent. And during the year, the company hired fresh talent at managerial as well as administrative position. So basically, there's a whole background what they're telling that company is into manufacturing of LED items, and the LED articles, LED lighting articles are useful for various industries. And the company gives priority to innovation and younger talent. Clear with this point? Good. Come on, guys, see the next point. During the month of April 2022, company appointed Mr. Rahul and Ms. Shweta as executive director and non-executive director of the company. And Rahul is an MBA from IIM Ahmedabad and has got 10 years industry experience. He is an exceptional finance professional, and his experience spans around various finance domains as regional CFO, finance controller. And he has been a part of various teams starting business from scratch in the new markets. Furthermore, Shweta is a chartered financial analyst, holds an experience of 8 years in similar industry. Apart from her vast experience in the finance field, Ms. Shweta is a philanthropist who also believes that focusing on creating a culture where workers are encouraged to stay with the company is the need of the hour. So these two people have been appointed as directors. One is executive director, one is non-executive director. Next slide. Rahul joined the company with the vision to expand the business of the company so as to include manufacturing of LED lights for cars and motorbikes also. For this purpose, company opens a new branch office in Faridabad, Haryana. It purchased a building for a branch office from RPS Builders, Faridabad. Come on, guys. For this purpose, what is it they are trying to do? Company opened a branch office in Faridabad, Haryana. It purchased a building for the branch office from RPS Builders from Faridabad. Next, RPS Builders has diversified asset classes of township, residential, commercial, shopping malls, as well as office spaces, my dear friends. It is one of the leading and trusted real estate companies. And RPS Builders is one of the fastest growing conglomerate in the field of real estate and infrastructure. It is committed to mark its excellence in the field of real estate since inception. Sudarshan Limited enters into separate contract with RPS Builders for purchase of pre-installed office furniture and fixtures in the building. So they are taking two things from RPS Builders. Number one, they have taken a building. And apart from that, they have also taken what, my dear friends? Pre-installed office furniture and fixtures. Next slide. During the year, company also entered into contract with RTS Limited Delhi to supply a machine which is required to be assembled to in one of its factories in Chennai. So during the year, company entered into contract with a Delhi company to supply a machine which is required to be assembled in one of the factory in Chennai. Next, Om Krishna and Associates are statutory auditors of Sudarshan Limited for 22-23. The said chartered accountant firm was established in 1987 with offices in New Delhi, Chennai, and Mumbai. With its head office in Delhi, the firm currently has diversified team led by talented partners and directors having vast professional experience. CA Om, one of the senior partners in the firm, is the engagement partner for this audit engagement. While interacting with CA Om, Rahul informed him that company is in discussion with a supplier in Korea for purchase of raw material required for manufacturing LED lights for the car. He further told CA Om that such import of raw material from Kerala will help the company to procure raw material at a very less cost as compared to the cost at which company is currently procuring. So when they import raw material from Kerala, their raw material cost will very much go down as compared to the current raw material cost. That is what they are trying to tell in this question. Got the point, everybody? Good. Fair enough. Next line you see. Mr. Rahul told CA Om that such raw material can be procured from China, Japan, and Korea. And the cost of importing raw material from Korea works out to be the least. And Rahul also told CA Om that company is planning to export its products as the demand for the products of their company is high in the foreign market. He asked CA Om to brief him about the GST implication with respect to place of supply for import and export, and also with respect to purchase of machine from RTS Limited as mentioned above. Further, Rahul also discussed the following prospective export transaction of the company with CA Om. What is the transaction they're discussing, my dear friends? Please see that. Sudarshan Limited will be entering into agreement for sale of its products with Brit Limited, a company based in Australia. And Brit Limited requires the goods to be delivered by Sudarshan Limited to Casper Limited, a company based in Kerala. So basically, Sudarshan Limited is entering into contract with an Australian company, and Australian company is telling the Sudarshan Limited to send the goods to Kerala. So technically, goods are not going out of India. Next. Rahul asked CEO to clarify whether the transaction will qualify as export of goods under GST. Come on, guys. Can somebody tell me the answer? Is it regarded as export of goods? Come on, friends. Is it regarded as export of goods? 100% answer is no, my dear friends. Because export of goods is only that case where goods are taken out of India to a place outside India. Then only we treat the transaction as export. If not, it is not regarded as export at all, my dear friends. This point is a very, very interesting point. And I strongly believe that you got clarity on this point, my dear friends. In order to call it as an export, the goods must leave out of India. Only then we call it as an export. Are we getting clarity, everyone? Come on, friends, please reply. Can I proceed? Good. Fair enough. Thank you very much. Come on, friends. Next point. In order to promote its overseas sales or export, Sudarshan Limited has launched an advertisement campaign of its product. Very good. Unless they do that advertisement and run the ads, how can they export and promote the products? For the purpose of online advertisement, company has utilized the services of Techno Inc., a Germany-based company. And during the financial year, they paid 2,35,000 to Techno Inc. for such services. Wonderful, my dear friends. Very, very interesting and important points. An absolutely important point, my dear friends. Can somebody please tell me what is that transaction that can come into picture in this particular scenario? Some students are telling 194J and all. But let me tell you, my dear friends, it's not just about 194J. You have to understand that we are talking about payment is made to a Germany-based company. When payment is made to Germany-based company for the purpose of advertisement service, my dear friend, there is an interesting concept called equalization levy. Did you hear that word in income tax, my dear friends? Equalization levy concept is that concept where when payment is made, my dear friends, payment is made by an Indian who is a resident in India to a non-resident who is providing service of online advertisement and all. In that case, my dear friends, there is a concept of equalization levy where 6% is deducted and paid to the government. And if they don't do that, that expenditure cannot be taken as deduction and 100% will be disallowed, my dear friends. And this concept of equalization levy will not apply in case where the consideration for the service does not exceed 1 lakh rupees. Are we getting this point, everybody? Good. Next point. Further, Rahul is also skeptical skeptical regarding the provisions of Companies Act applicable to the Constitution of Audit Committee. Fine. That is all about Companies Act. Companies Act, and that too about audit company. Student is asking, it is for individual transactions, sir. Is the doubt related to equalization levy? That 1 lakh you are asking about? See, 1 lakh point they told in the law, equalization levy will not apply if the aggregate consideration during the previous year does not exceed 1 lakh. So it is not 1 lakh limit per transaction. It is during the previous year. So whole aggregate limit it is. So in the whole year, if it does not exceed 1 lakh, then equalization levy will not apply. Aggregate consideration means aggregate during the previous year. Got it? So it basically means the aggregate consideration for the service received during the previous year that does not exceed 1 lakh rupees. Done. Next line. Next is all about audit committee, audit committee, audit committee. Further, the annual remuneration, directors, no special resolution. Disclosures in the management discussion analysis report. That's it. That's the story of this interesting points. Now let us see the multiple choice question first. Then we'll also look at the descriptive based question. Come on. With respect to purchase of building and the pre-installed office furniture and fixture, which of the following is correct regarding the GST liability? Tell me, my dear friends, what do you think is the correct answer? In which case GST liability will trigger, my dear friends? Come on, friends, what do you think is the answer? Good. Some students are telling perfect answer. Immovable properties, their answer is no. Furniture, fixtures, definitely answer is yes. So let me tell you, my dear friends. As per section 7(2)(a), read with schedule 3, there are certain transactions which are neither regarded as supply of goods nor regarded as supply of services. Come on, my dear friends, what is the line note? There are some transactions which are neither regarded as supply of goods nor regarded as supply of services. And one of the point is sale of land and building, except construction services. I hope you know that in case of sale of land and building, there is no question of GST. However, construction service GST will apply provided there is any amount of consideration received prior to issuance of occupancy certificate or completion certificate. I'll ask you one question. Think properly and tell me. So let us say there is one person who's constructing building. Shivateja approached that person for the purpose of construction of one, for the purpose of purchase of one flat. Let us say the flat value is 1 crore. How much is the flat value? 1 crore. 70 lakh rupees I paid prior to completion certificate and 30 lakh rupees I am paying after completion certificate. I repeat once again, 70 lakh I am paying prior to completion certificate, 30 lakhs I am paying after completion certificate. On what amount GST will apply? Some students are telling no GST on full amount. It's an absolutely long answer. Let me tell you the answer that GST will apply on entire 1 crore. The reason because law told very clearly that GST will not apply only and only in case where entire consideration is received. Entire consideration is received after issuance of completion certificate or occupancy certificate. Even if 1 rupee also is received prior to issuance of occupancy certificate, my dear friends, I repeat once again, even if 1 rupee also is received prior to issuance of occupancy certificate, then GST will apply on entire value. Then GST will apply on what value? Entire value. You got the answer, everybody? So in the given case, my dear friends, there will be no GST on building. However, GST will apply on supply of furniture and fixtures. That's it. Very, very interesting points. Student asking, you need to pay GST on 70 lakh on payment and rest 30 when you paid. That is obviously based on time of supply. No doubt about it. Yeah. Coming back to the case study. So for the first question, my dear friends, the answer will be option A. There will be no GST liability on purchase of building, while office furnitures and fixtures that will definitely be liable for GST. Next point. What will be the place of supply of pre-installed office furnitures and fixtures? Now tell me, my dear friends, office furnitures and fixtures, what will be the place of supply, my dear friends? Come on, speak out, my dear friends. Tell me the answer. Student is telling location of immovable property. Don't tell the word location of property. We are talking about furnitures and fixtures. For furnitures and fixtures, why are you telling the word location of immovable property? In the question, they didn't ask about building. They asked only about furnitures and fixtures. Let me tell you, my dear friends, as per section 10(1)(c), place of supply in case where there is no movement of goods shall be the location of goods at the time of delivery to the recipient. And in this case, location of goods at the time of delivery to the recipient is in Faridabad. That's it. Accordingly, my dear friends, place of supply in this case will be Faridabad, my dear friends. I hope we are getting clarity on this point. Sir, if there is movement of goods, the answer is different. Movement of goods, the provisions are given by section 10(1)(a), which says the place where movement of goods terminates for a delivery to the recipient. But this is a case where there is no movement of goods. That's it. Appointment of chairperson of audit committee, again audit committee, approval of remuneration, fine. What all matters are discussed in the management discussion analysis report? That is also clearly not related to your taxation matter. Clear, right? Next, 7th question. What should CA Om tell Rahul about the latest query about the GST implication with respect to place of supply? Also, what clarification should CA Om with respect to prospective export transaction to be entered by the company with Brit Limited? GST implication on place of supply. And the Brit Limited story they are asking. So Brit Limited very clearly that will not be considered because Brit Limited that will not be considered export because goods are not moving outside India. First of all, he has got a query with respect to how to determine place of supply in case of imports and exports. And very clearly, let me tell you, my dear friends, place of supply with respect to imports and exports is given by section 11 of IGST Act, which clearly says that in case of import, my dear friends, place of supply will be the location of the importer. Corporate office is in Delhi, but they want to get that machine into Chennai. When they want to get that machine into Chennai, my dear friends, we are basically going to tell place of supply will always be the location of the importer. And let me tell you, in case of export of goods, place of supply is always the place where goods have been exported. Otherwise, the location outside India. And with respect to machinery to be installed in Chennai, my dear friends, place of supply will always be the place where the goods are assembled or installed. Are we getting clarity on this point, everybody? Yeah. What is the doubt student is asking? 13(2). Why would 13(2) come into here, my dear friends? 13(2) is only in case of services. We are talking about the goods here. as per section 11A, place of supply in case of import of goods shall be the location of importer, and as per section 11B, place of supply in case of export of goods is the location outside India. Wherever we're exporting, that becomes the place of supply. You're getting what I'm saying, my dear friends? So in case of import of goods, what is the answer? Place of supply is the place of supply is the location of importer. Got it? For export of goods, what is place of supply? Place of supply is the place where goods are being exported. Next. And with respect to machinery installed in Chennai, place of supply would be Chennai as per section 10(1)(t). Since, let me write here, section 10(1)(t) specifies that in case where goods are assembled or installed, then the place of supply would be the place where goods are assembled or installed. And that is very clearly Chennai in this particular question, my dear friends. Are we getting clarity, everyone? Next, finally, the prospective export transaction is not regarded as export since the goods are not taken out of India. Because ultimately, in order to regard as export, my dear friends, the goods should definitely be taken outside India. The goods are in India only, my dear friends. In the question, we discussed that the goods are being sent to Kerala. Now, when the goods are not moving out of India, how can that be regarded as an export transaction? That's it. Coming back to the question. What else we have there? Discuss the tax implication or TDS implication on payment made to Techno Inc. by Sudarshan if Techno Inc. has no PE in India. Second case, if they have PE in India and services connected to the PE in India. Very, very interesting concept. Come on, listen very clearly, my dear friends. In case of payment by Sudarshan Limited to Techno Inc. To Techno Inc. Case 1. There is no PA in India. In such case, my dear friends, provisions of equalization levy will apply. Provisions of what, my dear friends? Equalization levy will apply. Very good, very good. Students are perfectly giving the answer. Equalization levy will apply at the rate of 6%. Such 6% should be deducted and paid to the government. So 6% should be what, my dear friends? It must be deducted and paid to the government. Very, very important point, my dear friends. Are we getting clarity, everybody, sir? Now, moreover, the interesting point is that equalization levy would apply only in case of service of online advertisement. Only in case of what, my dear friends? Service of what, sir? Online advertisement. Or provision of digital advertising space. This will apply only in case of online advertising or any provision for digital advertising space, my dear friends. and basically it is service related to online advertisement, then that case only it is covered. Online advertising space, provided aggregate amount during the financial year exceeds 1 lakh. I already told you this point. If it is less than 1 lakh, then this section only will not apply. This section only, what my dear friends, will not apply. Now, very interesting point. If equalization levy is not deducted, then 100% of such expenditure, 100% of such, what my dear friends, expenditure shall be disallowed. That is the story. I hope we got clarity on this point. So if equalization levy is not deducted, my dear friends, 100% of expenditure shall be disallowed. And in the given case, my dear friends, they clearly told in the question the figure is 2,35,000. So it is more than 1 lakh. On that 6% they have to deduct and pay to the government. And if they don't do that, my dear friends, 100% of expenditure shall be disallowed. Are we getting clarity, everyone? Next situation. Case 2. If Techno Inc. has P in India and service is connected to P. I repeat once again, Techno Inc. has got what, my dear friends? P in India and service is connected to P. Very clearly, my dear friends, in such case, the concept of equalization levy would not apply. However, payment would attract TDS under section 195. And if TDS is not done, then 100% of such expenditure, 100% of such expenditure would be disallowed. But you have to note the point very clearly that this is a case where equalization levy is not applicable, but what will apply is section 195 TDS will apply. Equalization levy story will come only when there is no P in India and service is not connected with P in India. Getting my point? So if 195 TDS is not done, then also 100% disallowance will come into picture. There is no doubt about it. But you have to understand the point very clearly here that in this particular case, equalization levy will not apply. So that is a very, very interesting point. What you should make of note of, my dear friends. I strongly believe that you got clarity on this point. Please confirm, my dear friends. Good, very good. Done. Thank you very much. And that's the story of this very, very interesting case study, my dear friends. So let us proceed to the next interesting case study, guys. I'll share the screen. Come on. Student is telling lengthy case study. Yeah, comparatively, this case study is slightly lengthy. If you have seen in the previous session what case studies we discussed, some of them are not so lengthy at all. They were very small in size and very comfortable. So sometimes it does so happen that some case studies will tend to be slightly lengthy. You cannot afford to expect that always every case study will be just 1-2 pages. There could definitely be some case studies which are slightly lengthy, my dear friends. We should be prepared for all kind of scenarios. Done.
Hello everyone. How are you all doing? How is your preparation going? So today we are going to try to do 5 case studies. If we are able to finish these 5 case studies sooner, then I'll end the session sooner. Okay. So it really depends on the speed at which we do these case studies. So what is your role? Your role is to give the answers. I'll explain you the provision and then you have to give the answer. I'll ask you. So be active on chat. Okay. All right. So let's start off. So my screen is visible. So we are doing the case study digest of November 23. Okay. Let's take some cases. So first we are going to be taking up case number 40. Okay. Okay, so case number 40, we have got two MCQs in this case study. It's MCQ 1 and MCQ 2. So let's read these. They are based on CSR. Okay, so CSR, what is the section of CSR? Corporate Social Responsibility. Dheeraj is saying 135. Perfect. So this is question is coming a lot on section 135 CSR. Okay, so let's read this question and let's try to answer this. So comment on the contention of Mrs. Kapoor as to the applicability of CSR provisions to ABC Foundation Limited, provided it fulfills the criteria of section 135 of the Companies Act. Okay, so we have to check the applicability of CSR provisions on ABC Foundation. All right, so we have to first see what is Mrs. Kapoor saying. So for that, we'll have to check the case study. So what is the case study saying? Let's read the case study. Okay. So ABC Foundation Limited is formed with charitable objects under Section 8. So that means here ABC Foundation Limited, this is, see, as the name says clearly, you can read ABC Foundation Limited. So this is a company. What kind of company is this? Is this a public company? See, it is mentioned that it is it is formed with charitable objects under Section 8. So this is a Section 8 company. Okay, so it is made with charitable purpose. Section 8 companies have got all provisions applicable in a different way. Not all, but like they cannot declare dividend. They have to take central government approval. They are created with central government permission. They have to follow the terms and conditions accordingly. All right. Okay, so ABC Foundation Limited is formed with charitable objects under section number 8 of the Companies Act. And as a result, Mrs. Kapoor believes that as all the activities of the company will be with the intent of charity, the CSR provisions are not applicable. So what is Mrs. Kapoor saying? She's saying that this is a Section 8 company. So it need not follow Section 135 because any which ways, whatever it is doing, it is with charitable purpose. Okay, so this is the fact which is related to your MCQ. Let's read the MCQ again. Comment on the contention of Mrs. Kapoor as to applicability of CSR provisions on ABC Foundation Limited, provided it fulfills the criteria of Section 135. That means its turnover, paid up share capital limit, all that is as per Section 135. So Section 135 is applicable on ABC Foundation, but because this is a Section 8 company, Mrs. Kapoor is saying that Section 135 should not be applicable. So what should we do? You will have to refer to Section 135. Now, if you read the entire Section 135, no, there is no exemption given to Section 8 companies. There is no exemption. Okay, so simply speaking, Section 135 is applicable on all the companies that that fulfill the prescribed limits that are given in Section 135. If they comply with those limits, then Section 135 is applicable. They will have to constitute a CSR committee. They will have to do CSR. Okay, now please tell me, is the contention of Mrs. Kapoor correct? That means Mrs. Kapoor is saying ABC Foundation need not follow Section 135. Is she saying correct? Is she right? Yes or no? Yes or no? Yes or no? Nobody is active. What is up? Okay. So no, she's not correct. Okay, even a Section 8 company will have to comply with Section 135. Okay, so accordingly, we'll have to select the correct option. Let's read the options. Option A reads, it is exempted from applicability of CSR provision if prior approval is given by the shareholders. That is not there. There's nothing like that given in our Companies Act. It is itself a Section 8 company formed under charitable object and need not follow CSR. Nothing like that. It is applicable to every company and therefore ABC Foundation as well has to comply. This seems like the right answer. C. It is not an independent organization and is governed by MSNV Private Limited. So CSR provisions are applicable. Again, this is not relevant for us. Okay, so C is the correct answer. You all are right. Perfect. So let's move on to next MCQ, which is MCQ 2. Okay, let's read it. Will the amount that was to be paid by MSNV Private Limited towards ABC Foundation qualify as CSR expenditure? Okay, from this question, we understand that there are two companies. One is MSNV Private Limited. The other one is ABC Foundation. This, we have just now understood that this is a Section 8 company. It is involved in charitable purpose. Now, MSNV Private Limited has paid some amount to this company. And we have to check whether this is CSR expenditure or not. All right. Now, whenever we do CSR expenditure, Section 135 says that CSR expenditure can be done by itself. The company can itself do it, or it can also take the help of any existing charitable trust. So here, basically, this private company is taking the help, or it is doing some charitable purpose with the help of another institution. So it's okay. It is allowed as per CSR expenditure. Okay. Now, but we have to check whether this expenditure is even considered as CSR expenditure, whether it will qualify under Section 135 or not. Okay, so we'll have to read the case for that. Let's go to the facts of the case. Accordingly, we are going to understand. Yeah, so this case study digest that we are discussing, it is published by ICI. Okay, this is November 23 case study digest. So here, okay, so I think they have already, the team has already shared the resources with you. So do check it out, okay? It is published by ICI. Anyways. Okay, so let's read the case study. We have to check whether MSNV Private Limited, the amount that it has given, will qualify as CSR expenditure or not. Okay, so the second paragraph is relevant for us. Let's read. MSME Private Limited manufactures consumable goods like bath soap, toothbrush, etc. As part of CSR policy, it has decided that for every pack of these goods sold, 0.80 rupees will go towards ABC Foundation, which will qualify as CSR spent under Schedule 7 of the Companies Act. Consequently, at the end of the year, company sold 250,000 units, and a total of 2 lakh rupees is recognized as CSR expenditure. However, this amount was not paid to ABC Foundation at the end of the financial year. So what this company is saying, many packets and many soaps, they have got this thing written that, for every purchase that you do, we will, for every bottle that is sold, we will contribute 1 rupee or 2 rupee to a charitable institute. So that is exactly what this MSNV is also doing. They are saying that for every unit that is sold, they will put 0.08 rupees to this ABC Foundation. So full year has passed, and now they have recognized that 250,000 units were sold. So 2 lakh rupees they have recognized as CSR expenditure. That means they have written down in its books of accounts that 2 lakh is CSR expenditure. But they have not actually paid the money to ABC Foundation. They have not given the money. Now, general common sense, do you think this will be considered as CSR expenditure under Section 135? Will this qualify? Yes or no? No, no, correct. This will not qualify. Because very simple, if you want to qualify this amount as CSR, you have to pay the amount. No, just like that, you cannot think that, we'll give this amount and, recognize it. And no, it has to be present value. It cannot be future value. It has to be paid. Okay. So this is very simple, common sense based. So let's see, we'll accordingly have to select the correct option. Will this amount be recognized as CSR expenditure or not? Let's read the options. A, yes, as it has been earmarked separately. Is this right? No. No, as it has not been actually spent. This seems like the right option. C, no, as this amount has not been specifically provided but contributed out of sale receipt only. It is again not relevant for us. Ultimately, the cash value that has been paid matters. Yes, it can be claimed as it is material amount. being contributed as a portion of the sales being made. No, again, the materiality does not matter. Okay, so payment matters and payment has not been done. Therefore, it will not qualify as CSR expenditure. Okay, so let's move on. This case study we have done.
So we'll move on to the case study number 40. MSNV Limited, Indian company, manufacturing of kitchen products. So this is the company. Then to support Kapoor's thought, Mr. Kapoor has incorporated and registered two charitable organizations, NGO and Section 8 companies. So related to Section 8, very important part. Then you have something about ABC Foundation, MSNV Limited, CSR policy, some other CSR activities. Consulted upon CA Lalita is also, this is the CA maybe, tax treatment of the following transactions. So there is a tax treatment part. Mr. and Mrs. Kapoor tells CA Lalita that the other charitable organization was registered under Section 12AA as a trust for exemptions and all, was not doing well and they plan to merge it with their company. Can they do so and can they not do so? All the assets became the assets and liabilities of the company, which is not entitled for registration under Section 12AB. Okay, so then you have transfer of assets. How do we value them? Yeah, first, comment on the contention of Mrs. Kapoor as to the applicability of CSR provision. Law. CSR expenditure, again law. Rent expenses with respect to Income Tax Act. Correct treatment of cost of new building in the books of account under the income tax law. So that's also under income tax law and capital gains. Then tax audit provisions, tax liability. So this also purely tax. So some of the case studies are purely tax-based case study where you see this, it's only law and tax. Now, one thing what you have to understand during the examination, when you choose, for example, if you're comfortable with charitable law provisions and transfer of assets and all of those things, then you can choose that. Now, an advantage what you will have is, especially for students who are writing only group 2 or who are preparing for group 2, what you need to consider is, because you will be anyways preparing for DT, IDT in most of the cases, DT and IDT related questions will be easier for you to handle because you would have written paper number 4, paper number 5 and paper number 6. Things will be fresh and you'll be able to score better there. As compared to someone who has written group 1 earlier or who has written who's writing group 1 now itself, that becomes slightly, lagging, or there will be a slight amount of delay, right? So,
next case study, guys. MSNV Private Limited is an Indian company which is into manufacturing of kitchen products, mainly utensils. And Kapoor, the CEO of the company, has started this company 21 years ago with the help of his wife. And today the company enjoys a good market share and reputation. What is that they are into, my dear friends? They are into manufacturing of kitchen products. It has involved itself not only into its objects, but also into philanthropic activities. Very good. It is Mrs. Kapoor who believes that what business takes from society should give back in the form of their social responsibility, howsoever they may. So nice and so sweet of them. So they're engaged in philanthropic activities also. That means basically some kind of charitable activities. To support Mrs. Kapoor's thoughts, Mr. Kapoor has got incorporated and registered two charitable organizations. And the first one is an NGO by the name Serving the Poor. And other one is a Section 8 company formed with a charitable object by the name ABC Foundation Limited. Although Kapoor is a man with vast business experience, but when it comes to case of charitable organization, he finds it hard to understand many matters. Obviously, charitable trust taxation is slightly complex. And I hope you guys already know this concept that 15% they can straight away take the exemption as such, which can be set apart for future purpose. But 85% minimum has to be applied for the purpose of charitable purpose only. And the 85% application could be for revenue purpose or it could be for charitable purpose. But it must be applied for the objectives of the trust. That is important. He finds it hard to understand many matters and therefore approached CA Lalita to help Mrs. Kapoor in working out the various issues involved in the structure, organization, and working of these two organizations. CA Lalita has entered into a contract with MSNV Private Limited to provide consultancy with respect to these two organizations which have been set up under CSR initiative of the company MSNV Private Limited. I'm sure in corporate law, you would have heard this word corporate social responsibility so many times. Section 135 of Companies Act deals with CSR concept. Next line is ABC Foundation Limited is formed with charitable objects under Section 8 of Companies Act. And as a result, Kapoor believes that as all the activities of the company will be with the intention of charity, CSR provisions are not applicable to it, as these activities are activities in normal course of business. And Mrs. Kapoor takes consultancy of CA Lalita in this matter and also further tells her that ABC Foundation Limited was to receive from donations from MSNV Private Limited during the year. Very good. MSNV manufacture consumable goods like bath soap, toothbrush, soap cases, etc. And as a part of its CSR policy, it has decided that for every pack of these goods sold, 0.8 will go to ABC Foundation Limited, which will qualify as CSR spend as per Schedule 7 to Companies Act. Consequently, at the year end, companies sold 2,50,000 as such packs, and 2 lakh was considered recognized as CSR expenditure. However, this amount was not paid to the foundation at the end of the financial year. Okay. MSNV carries out some other CSR activity from rented premises in Pune. The rent paid from premises is disclosed as CSR expenditure and subsequently also claimed deduction of the same under income tax. However, accountant opposes this move of the company, and Kapoor consults CA Lalita on the treatment of rent expense by the company and whether the contention of accountant is correct or not. Tell me, my dear friends, can we claim that rent expense as deduction? 100% answer is, if it is CSR expenditure, my dear friends, Section 37 of Income Tax Act clearly says any CSR expenditure is not incurred for the purpose of business. It is not allowed as deduction. But if the CSR expenditure is such expenditure which is covered in Section 30 to 36, then in that case, my dear friends, it can be taken as deduction. And in fact, let me tell you, my dear friends, Section 30 of Income Tax, PGBP section clearly says that expenses related to building like rent, rates, repairs, insurance and all, that can be taken as deduction as per Section 30. So what I'm trying to tell you is that CSR expenditure, which is of the nature covered in Section 30 to 36, then that can definitely be taken as deduction. So in this particular case, that rent expense is allowed as deduction. I hope you got the answer, my dear friends. Student asking how, sir? Sir, my dear friends, let me repeat once again for your benefit. Income Tax Act provision Section 37 clearly says that any CSR expenditure is not allowed as deduction if it is incurred for a purpose of business. Since it is not allowed as deduction, since it is not incurred for the purpose of business. This point is given by Section 37. And Section 37 will come into picture only for those expenditure which are not covered in 30 to 36. So if an expenditure is specifically covered in 30 to 36, that is definitely allowed as deduction. Example, 30 talks about expenses related to building. 31 talks about repairs and insurance for plant, machinery and furniture. 32 talks about depreciation. 33 ABA talks about your site restoration fund and tea, coffee, rubber development account. 35 is scientific research. 35 ABB telecom expenses. 35 AD specified business. 35D preliminary expenses. 35 DD expense or amalgamation or demerger. 35 DDA expenditure incurred towards VRS. 35E expenditure incurred towards extraction of minerals. 36 is other deduction. So if an expenditure is specifically covered in 30 to 36, that expenditure can be taken as deduction. Did you get the point? Please confirm, my dear friends. Student asking, but how can rent show as CSR? That is a mistake what they have done in the books. But the whole point is that CSR expenditure, which is of the nature of rent, that is always allowed as deduction. Here in this case, what is the problem is that they are carrying out some CSR activity from rented premises. And the rent paid, they are shown in the books as CSR expenditure. But income tax purpose, rent paid is allowed as deduction as per Section 30. So even though it's related to CSR, that is allowed as deduction because it's specifically covered in 30 to 36. Good. Next point. CA Lalita is also considered upon tax treatment of following transaction. Organization acquires a building to use for charitable purpose and office activity. Kapoor wants to claim the cost of building, while the accountant suggests that they can claim only depreciation thereon in the current year and subsequent year. How can they do that, my dear friends? they can happily claim the entire cost of building as application of income. Getting the point, everybody? Entire cost of building can be taken as application of income. And once you are taking entire cost, you should not again claim depreciation as such. Next. The accountant is having queries in computing the capital gain in case of capital asset transferred by ABC Foundation. So the trust has sold one asset and in computing the amount deemed as application out of such capital gain. So if you see very clearly in the question, what is that they have given, my dear friends? What is the original cost of asset, my dear friends? 10 lakh rupees. And the consideration for which it is transferred is 15 lakh rupees. 15 lakh rupees. So the gain, what will you get is 5 lakh rupees, my dear friends. The gain, what you get is 5 lakh rupees, my dear friends. Correct, right? And what is the cost of new asset? What we have taken? The cost of new asset, what we have taken is 15 lakh rupees. So nice of them. So technically, my dear friends, entire 5 lakh rupees is deemed to have been applied for charitable purpose. Entire 5 lakh is deemed to have been applied for a charitable purpose, because if the whole of the consideration is used for acquiring the new asset, my dear friends, entire capital gain would be deemed to apply for charitable purpose. Clear? Can I proceed, my dear friends? Please reply. Done. Thank you very much. Board of Directors wants to get the books of accounts, auditor and income tax law, and seek Lalita services for same at desired professional fee. Fine. Mr. and Mrs. Kapoor tells C.A. Lalita that the other charitable organization serving the poor was not doing well since 3 years, and they plan to merge it with their company MSNV. Oh my God! So this is a clear case where a charitable trust is getting merged with a company. So a charitable trust is ceasing to be a charitable trust. In that case, my dear friends, they will be required to pay something called exit tax. This exit tax provision is given by section 115 TD, which clearly says that in case where a charitable trust is merging with a non-charitable entity, otherwise which is not registered as charitable trust, in that case, they would be required to pay tax at the rate of MMR. And what they have to pay the tax is basically on the accreted income. Accreted income is the income which got accumulated till now. And the accreted income always means the market value of the assets minus the liabilities, whatever we have. On that figure, technically, on the net worth, we general terms to say it is net worth. On the accreted income, we will be required to pay tax at the rate of MMR. Very, very crazy point. On 1422. All the assets and liability of the erstwhile trust, should I asking, sir, MMR rate is what? Sir, MMR rate will be your 30%. Sir, MMR rate will be your 30% tax plus the surcharge plus the cess. And surcharge in this case, I'll apply only at the rate of 12%. Should I say 37%? 37% point I will not apply, because 37% is only in case of individuals and all. So I will not apply 37%. I'll apply only 12% surcharge. Yeah. Next line. All the assets and liability of the erstwhile trust became the assets and liabilities of MSNV Limited, which is not entitled for registration under 12AB of the Act. That means it is not a charitable trust. The trust appointed a registered valuer for valuation of assets and liabilities. Stamp duty value of the land held is 15 lakhs. However, if this land is sold in the open market, it would ordinarily fetch 18 lakhs. And the book value of the land is 20 lakh rupees. So the stamp duty value is 15 lakhs. Market value is 18 lakhs. The book value is 20 lakhs. Tell me, my dear friends, what is that value we are going to consider? We are definitely going to consider 18 lakhs. Book value is not relevant for us. For us, we are concerned only with market value. And that too, law clearly says the market value will be basically the stamp duty value or the market value, whichever is higher. And the question they clearly told, market value is nothing but 18 lakhs. Next slide. 70,000 equity shares in Inc. Limited traded in recognized stock exchange. That means quoted shares. Lowest price was 75, highest price was 85. And let me tell you, we'll always take average price. And the average price is 75, 85, average prices will definitely be 80 per share. Next point, 50,000 preference shares, and the shares will fetch for 44 lakh if they are sold in open market. Book value is 25 lakhs. We are not concerned with book value, but we'll take only the market value. Next point, corpus fund, that is not considered as a liability as such. Next, outside liabilities, that will be taken into account, 87 lakh rupees. Provision for taxation, that is also not considered, my dear friends, because it's a government liability, which is definitely has to be paid. Next point, liability in respect of payment of utility bills, 6 lakh rupees. So very clearly, this liability is towards payment of utility bills like electricity, water and all. Since it is liability towards payment of utility bills, my dear friends, we technically call it as a ascertained liability. What do we call it? Ascertained liability. That will also be included for the purpose of calculating total liabilities, my dear friends. What a brilliant question. More related to charitable trust. Make sense, right? Excellent. First one is Companies Act. Second one is again Companies Act. The third one, accountant contention with respect to rent expense. Correct my comment, my dear friends. What is the answer for this question? Tell me. 100% answer is incorrect, as the rent expense can be claimed as deduction under section 30 of Income Tax Act. As per section 37, CSR expenditure is not allowed as deduction since it is not incurred for the purpose of business. However, my dear friends, if the expenditure is of such nature which is specifically covered under section 30 to 36, then such expenditure is allowed as deduction. You getting the point, everybody, my dear friends? So accordingly, rent expense can be claimed as deduction as per section 30. Very, very interesting point. I strongly believe that you got clarity on this point, my dear friends. Done. Let's look at the next question. Yeah. Next point, my dear friends. Point number 4. What should be Lalita's advice with respect to correct treatment of cost of building purchased by ABC Foundation in the books of accounts under income tax law? Come on, my dear friends. What is correct technically? Please tell me. What is correct? I already told you, my dear friends, whenever we talk about application of income, the application of income could be for revenue purpose or capital purpose, my dear friends. So the entire cost of building can be taken as application of income. But if the entire cost of building is taken as application of income, we cannot take depreciation as application. But if you take depreciation, then what will happen? The cost of building cannot be taken. Getting the answer, everybody? Some students are telling answer is option D. Let me check. She should suggest going either way, the accountant's way or the Kapoor's way, but not both. Correct. Absolutely correct answer. Absolutely correct answer. Got the point, everybody? That's it. Next. What would be the amount of capital gain arising as a result of transfer of capital asset by ABC Foundation, and what proportion would be deemed as application of income towards charitable trust? So capital gain figure is definitely 0. Capital gain figure is definitely what, my dear friends? 0. Capital gain figure is definitely what, my dear friends? 0. And the entire 5 lakh is deemed as application of income toward charitable purpose. The answer will be option D, my dear friends. Don't think that answer is option A. Let me tell you very clearly, the answer is option D, guys. Very, very interesting situation. Let me write that point also here. Sir, the point is very clear why this provision has come into picture like that. If the entire net consideration is utilized for acquiring new assets. So what is that line, my dear friends? If the entire net consideration is utilized for acquiring what? New asset, my dear friends. Then the entire capital gains is deemed to have been applied for a charitable purpose. Got this line, my dear friends? However, if only part of net consideration is utilized for a charitable purpose, is utilized for acquiring new assets. Then, come on, my dear friends, what is the line I wrote? If only part of the net consideration is utilized for acquiring new assets, then the capital gains that is deemed to have been applied for charitable purpose shall be. What do you think, my dear friends? Come on. What do you think is deemed to have applied for charitable purpose? Shall be the excess of proceeds utilized. Shall be excess of what, my dear friends? Proceeds utilized. That means how much amount you have utilized for the purpose of acquiring new assets, and the cost of asset what you have transferred. That difference is only treated as if it is applied for the purpose of old cost. Student is telling old cost asset. Correct answer. Old cost asset only will take into account. In simple terms, how much you have utilized minus old asset cost. That is deemed to have been applied for a charitable purpose. Are we getting clarity on this question, everybody? And in this question, very clearly they told that original cost of asset is 10 lakhs and what value we transferred is 15 lakh rupees. So that means technically we got a gain of 5 lakh rupees. And whatever consideration we got 15 lakhs, entire net consideration we have applied, but we have taken for the purpose of purchase of what? We have used the entire 15 lakh for purchase of new assets. I hope we are getting clarity on this point, everyone. So if that is the case, when the entire consideration is used for acquiring new asset, my dear friends, then the entire capital gains is deemed to have been applied for a charitable purpose. Very, very interesting point. I'm sure this point makes sense for all of you, my dear friends. Case study is slightly bigger case study, but I'm sure it is making sense for you. Good. Descriptive case study. First point, explain about the income tax audit provision applicable to charitable trust. That will be your 15%, 85% story. And also they're asking about carrying out audit program. And next part they asked, you are required to calculate tax liability in the hands of serving the poor as a result of merger with MSNV Private Limited. Oh my God, that's about your exit tax. First of all, my dear friends, descriptive question. If I have to answer question number 6, my dear friends, first of all, it's very clear that trust has to apply at least 85% for the purpose of objects of the trust. And moreover, the important point is that they have to obtain approval as per section 12AB. Then only they can claim exemption, my dear friends. And moreover, they told in the law that if total income before exemption exceeds basic exemption limit, then they have to obtain what, my dear friends? Audit report from chartered accountant. In fact, there was a form called Form 10B, my dear friends. In that Form 10B, we are required to obtain audit report from chartered accountant, guys. Very, very important points. And the basic exemption limit is obviously 2,50,000. Getting the point, everybody? So audit planning is the story of an audit report. Guys, is the screen visible for all of you? Yeah. Next. Question number 7 is related to your exit tax, my dear friends. And this concept is given by section 115 TD, my dear friends. 115 TD. In case of merger of charitable trust with the company, tax is required to be paid on accreted income. What income, my dear friends? Tax is required to be paid on what income, guys? Come on. Tax is required to be paid on accreted income at MMR. And MMR will be 30% plus 12% surcharge plus 4% HEC. How much that effective rate comes to, my dear friends? 12% is 31.2%. So what I'll do is 31.2 into 104%. So effective rate is 32.448, my dear friends. Wait a second. I think I lost. 30 into 12%, no? 30 into 12% is 3.6. So which will be 33.6 into 104%, which is coming to 34.944%. That is the MMR, my dear friends. That is the rate at which tax is required to be paid on accreted income. And accreted income will be aggregate fair market value of assets minus total liabilities. Accreted income is what, my dear friends? Aggregate fair market value of the assets minus what, my dear friends? Total liabilities. I hope we are getting clarity. Now, what is the market assets we're going to take? We are going to take land. We are going to take what value? Land. On the land, we'll take the market value figure, which is 18 lakh rupees, or the stamp duty value 15 lakh, whichever is higher. Then quoted shares. We'll take average price, which is 80 per share. In the question, they told 75 and 85. Remember that, no, lowest price they told 75, highest price they told 85. So average price of what I take is 80. And in the question, they have clearly told that we have got 70,000 shares. Got it right? Apart from this, we have also got preference shares. And we have got totally 50,000 preference shares at market value. The market value of the question they told is 44 lakhs, my dear friends. So total, other words, in simple terms, aggregate fair market value of assets is coming to 1 crore 18 lakh rupees. And when I talk about liabilities, what is that I'm going to take? I will take outside liabilities, which is working out to 87 lakhs That is what they gave in the question, my dear friends. And corpus fund is not considered. Corpus fund is never considered, my dear friends. In the same logic, provision for taxation, this is also not considered. And liability for utility bills. And this is very clearly an ascertained liability. And since it is ascertained liability, my dear friends, that will be considered because at any given point of time, that ascertained liability has to be paid. And in the question, they gave figure as 6 lakh rupees. So total liabilities will come to 93 lakhs. And accreted income will be 1 crore 18 lakhs minus 93 lakhs. And the accreted income figure is coming to 25 lakhs, my dear friends. And on this 25 lakhs, the tax liability on accreted income will be 25 lakhs into that tax rate, which is nothing but MMR. So the answer is 8,73,600, my dear friends. That is the tax liability that is going to come on the accreted income. Very, very interesting case study. And I strongly believe that this case study is making sense for all of you, my dear friends. Make sense, guys? Come on, please reply. A very, very, very interesting case study, actually. Good. Excellent. Excellent. Good that you guys got very good clarity on this case study, my dear friends. A very, very interesting case study, very logical as well as very conceptual. Make sense, everyone? Good. I request your kind cooperation. Today, let's also cover one more interesting case study. Are you guys ready? Can we do that? Thank you so much for your kind cooperation.
Let's go to the last case study for the day. This is case study number 41. So this is question from insolvency and bankruptcy. So question number 2 says that Mr. Kailash Dave would have been ineligible to be appointed as an interim resolution professional of KPL if. So let's go to the case study and then we'll be able to answer this question. Here, para 3 is the relevant para which talks about the corporate insolvency resolution process. So it says that there was a corporate insolvency resolution process which was initiated against KPL by one of its operational creditor, Halcyon Private Limited. Mr. Kailash Dave was appointed as the interim resolution professional who is a partner in Dave and Company, a consulting firm which had transactions of falling amount with KPL. So KPL is the person against whom the corporate insolvency resolution process is initiated. So KPL will be termed as a corporate debtor. And this corporate debtor has had some transaction with the firm in which the interim resolution professional was a partner. And the transactions for the 5 financial years have been given to us. All the financial creditors of KPL were related parties and it had 14 operational creditors. The resolution plan of KPL contained a provision of combination as per Section 5 of the Competition Act and it was approved by the prescribed authorities. So before we go to the answer, let's understand the provision and then we'll go to the MCQ again. So this is about regulation of insolvency and bankruptcy. So as per regulation 3, An insolvency professional shall be eligible for appointment as resolution professional for a CIRP if he is not an employee or proprietor or partner of a legal or consulting firm that has had any transaction with a corporate debtor amounting to 5% or more of the gross turnover of such firm in the last 3 financial years. So here we'll have to do certain calculations. Let's see what the calculations are. So we'll have to look at the gross turnover of Dave and Company for the last 3 financial years. So it is 190 lakhs, 200 lakhs and 210 lakhs. So we'll do a quick calculation. 190 plus 200 plus 210. So it comes to 600 lakhs. What the provision says that the transactions which have happened between the firm and the corporate debtor should not be more than 5% of the gross turnover of this firm during the last 3 financial years. So 5% of 60 lakhs comes to 30 lakhs. Let's see what is the amount of transaction which has happened. One is 9 lakhs, then there's 10 lakhs, and the third financial year it is 9 lakhs again. So the total amount of transactions which have happened between the consultancy firm and the corporate debtor is amounting to 28 lakhs. Is this within the limit? Is the transaction within the limit? Is my screen visible now? So if you look at the gross turnover of Dave and Company for the last 3 financial years, it is 190 lakhs, 200 lakhs and 210 lakhs. The total of which comes to 600 lakhs. Now the provision says that, regulation says that the transaction which has happened between the corporate debtor and the consulting firm should not be more than 5% of the gross turnover of the consulting firm. So here 5% of 600 lakhs comes to 30 lakhs. However, the total amount of transaction which has happened is during the last 3 financial years between the consulting firm and the corporate debtor is valuing 10 lakhs, 9 lakhs and another 9 lakhs in the previous financial year, which comes to 28 lakhs. So which is well within the limit. So if had it been 2 lakh more, then Mr. Kailash Dave would have been ineligible for appointment. But since it is within the limit, then he is eligible for appointment. So here the question asks us, Mr. Kailash Dave would have been ineligible for appointment as interim resolution professional if, in which situation? Further, if Dave and Company would have entered into further transaction of 1 lakh during any last financial year, no, this is not the correct answer. Dave and Company would have entered into transaction of further amount of 2 lakhs during any of the last 3 financial years. So yes, the correct answer is option B. Moving on to the next question. Says which authority should have approved the resolution plan of KPL and in what sequence? So which authority should approve the resolution plan and in what sequence? Let's first have a look at the provision quickly and then we'll come back and answer it. It is a very small provision. So as per section 31, if the adjudicating authority is satisfied that the resolution plan has been approved by committee of creditors, then the adjudicating authority will approve the resolution plan. So the first approval authority is committee of creditors, then it goes to the adjudicating authority. However, if the resolution plan contains a provision of combination as per section 5 of the Competition Act, then in that situation, prior approval of Competition Commission of India also has to be obtained before the approval of Committee of Creditors. So the sequence here would be Competition Commission of India, Committee of Creditors, and then the adjudicating authority. So that is what the question is asking us here. So what would be the correct sequence? There's the Competition Commission of India, Committee of Creditors, and then the Adjudicating Authority. Yes, that is what the provision says. Clear? Have you understood this? Have you understood this provision? Yes? So this was the last question for the day, last part of the case study for the day. Since it is combination, then the approval of Competition Commission of India is also required. If there was no combination involved here, then it would have been Committee of Creditors and then the Adjudicating Authority. So any doubts, any questions anyone has? Does anyone have any doubts and questions? Last MCQ? Okay, we'll do the last MCQ again. So the last MCQ is asking us that which authorities would have approved the resolution plan of KPL and in what sequence. So which authorities approval is required? The regulation says is that the resolution plan has to be approved by the Committee of Creditors and then the adjudicating authority. However, in this situation, there's a mention of section 5 of the Competition Act in the resolution plan, and that is the reason why approval from the Competition Commission of India is also required. So the sequence here will be Competition Commission of India, then the Committee of Creditors, and then the Adjudicating Authority. Clear?
Next, we are moving to case study 41. 25. So only one MCQ is there in this, and most likely you will be able to solve this MCQ if you attended yesterday's session. So this is based on yesterday's discussion. Although we are going to study the provision again. Let's see. Okay. How many further audits of unlisted public companies can be held by Mr. Amrit? Okay. So here Mr. Amrit might be an auditor, and we want to calculate how many further audits he can take up. So this here we are talking about the ceiling limit of the maximum number of audits that can be taken. So yesterday we had discussed section number 141, clause 3, subsection 3, clause G. Okay, in this we had discussed that maximum, what is the maximum number of audits, statutory audit that an individual auditor can take? Generally 20. Perfect, 20, correct. Right, now it does not include some companies. It does not include one-person company. It does not include dormant company. Yes, small company is also not included. And one more, any private company which has paid up share capital of less than 100 crores is also not to be considered in this ceiling. Correct? So now this provision we have revised. Now based on this, we have to check the facts of the case, and accordingly we'll have to see how many companies, further companies can Mr. Amrit take. Okay. Okay. So let's read the question. Let's read the case facts. Okay. So Mr. Amrit Jaiswal was appointed as an engagement partner for conducting statutory audit of SBL. Now, Mr. Amrit has been holding statutory audit of 25 companies, including SBL, out of which 4 are one-person companies, 2 are dormant companies, 3 are private companies with paid up share capital of more than 100, and 1 private company which has paid up share capital of 70 crores. Which has not defaulted in filing annual accounts and financial financial record. Now, based on this data, can we calculate how many audits this person has taken under section 141? Okay, so see, Mr. Amit Jaiswal, he is the auditing partner. We have to calculate for him. So this data says that 25 companies he's doing the audit of 25 companies. Out of these, we don't have to count one-person company, so we'll deduct 4. 2 dormant companies will deduct 2. 3 private companies with paid up share capital more than 100 crores. So this is not to be touched. This is counted in the ceiling. 1 private company with paid up share capital 70 crores. This we don't count. So 1 we minus from here. Okay, so what is the total coming to? Yes, you all are right. Perfect. 18. And still 2 are left. Perfect. So according to this limit, 18 is the total count as per section 141. So total allowed number of audits is 20. So he can take 2 more audits. Got it? 2 more audits. So let's see the correct answer then. So how many further audits can unlisted public companies can Mr. Raman take? 2, 4. It depends upon the ceiling limit of audit of the firm 1. So here the more accurate answer will be A, 2. Okay, which is 20 minus 18. Done? Okay, very good. Let's move on. We're done with 2 case studies. We have to try to finish 5 total today. The sooner, the faster we end this session. Okay.
The next case we'll take up is case study number 41. First para. SBL is an unlisted public company located in Nagpur, involved in lubricant products, has factory on the outskirts. Crustain Private Limited is based in Bangalore. Okay. For the purpose of performing a special job of KPL, SBL has purchased a machinery of rupees 10 lakhs, which had a useful life of 5 years and nil residual value. They adopted straight line method of depreciation. Following information has been provided. So for financial year 23-24, estimated future cash flow 1.5, 3, 4, and 1, and the total valuation is 10 lakhs. Discount rate applicable is 10%, and fair value less cost to sell of the machinery as on 31st March is 7 lakhs. So one is value in use, can calculate by you discounting this by 10%. Second is 7 lakhs is the fair value less cost to sell. Now they purchased on 1st of April of 22. So 22-23 is gone. 22-23 is gone, right? And we are maybe we are standing as on 31st March of 23. Useful life of 5 years on a machinery of 10 lakhs divided by 5, you get 2 lakhs of depreciation. So 10 lakhs minus 2 lakhs, 8 lakhs is the carrying amount, and definitely it is 7 lakhs. So there is an impairment, but we also need to discount this by 10%, right? 10% means 1 divided by 1.1, 1 divided by 1.1 to the power of 2, like this we have to discount. So depending on the question, we'll work it out. But here definitely this is a question of impairment. There was a corporate insolvency resolution that is related to law. There arose an obligation on SBL during 22-23 to restore environmental damage in the area surrounding its factory. So this is something to do with your provisions. Expert advice indicated that the restoration had to be carried out in 2 distinct phases. First phase required expenditure of 10 lakhs to remove the contaminated soil. And the second phase, commencing from the end of the first phase, to replant the area with suitable trees and vegetation. Estimated cost of replanting 25 lakhs. The used cost of capital 10%, and the expenditure when incurred will attract a tax relief in the company's marginal tax rate of 30%. SBL had not recognized any provision for such cost. First phase will be commenced in few months and will be completed on 31st March of 24. When the first payment of 10 lakhs made, 10 lakhs will be made. Phase 2 will be paid 3 years later from the end of the first phase. Now, if you remember or recall, same question you have in India 37. Okay, they just have picked up that paragraph and they have imposed it here. Okay, so whatever you pay after 3 years, you have to discount that and bring it to the present value. Then their firm of chartered accountants was given an offer for appointment of statutory auditor, audit the Company Act related things. And here there are some errors, capital advances were put under capital work in progress. So this has to be put under other current assets or other non-current assets. This is, we have already discussed in the previous question also. Share application, both refundable and non-refundable, has been shown under equity. Refundable will show it under liability. Deferred tax asset and liabilities both were presented. You have to net off. Bank deposit with a maturity of 14 months where cash and cash equivalent. This is incorrect. Okay, so all of these things we are already aware of. First, e-way related aspect. Second, interim resolution professional. Third, authorities related part. 4th, tax audits. 5th, audits. So only audit. Then, with reference to information given in para 2, calculate the impairment loss, if any, to be provided in the books of SBL with respect to the machinery bought for performing the special job. Now, for calculating impairment, you have to calculate the recoverable amount. Recoverable amount is lower of fair value less cost to sell and value in use. So value in use, we have to calculate. This is given to be 7. Carrying amount is 8. Now 7 versus value in use, you have to calculate. We'll do that. And then what is the impairment, we'll calculate. With reference to information given under para 4, whether SBL needs to recognize provision for the cost with respect to contaminated soil. Yes, they have to recognize. What shall be the amount of provision to be provided on 31st of March? So you have to see what is the amount to be spent. You have to calculate the present value and you have to provide that. What shall be the correct presentation of the items for which Mr. Amrit has observed errors? This is also related to your FR and audit. We will discuss that. Then place of supply and constitution of committee of creditors. Right. So the first one, impairment related part. It's a very straightforward question. So you take the cash flows. This is 1 divided by 1.1. We know how to calculate present values. We've been doing for a long period of time. So when you calculate the present value, this multiplied by this, and this. In examination, to save time, what you can do is 1.5 into 0.909 is equal to M plus MR, 7.531. Fair value less cost to sell is 7 lakhs. Higher of these two, you will consider, not lower. Higher, which is higher? 7.53. Carrying amount is 8 minus 7.531, whatever you get, there is an impairment loss of 46,900. Very, very simple and straightforward question. Second one, provision is recognized when there is a present obligation, there is a probability that there will be a future economic outflow and reliable estimate. This you can directly pick up from the notes, no need to remember. Now here, there is a 10 lakh which you will pay after 1 year, discounted by 10%. It will be 10%, not 7%. The tax rate and all is given to confuse you. 10%, this is the present value. This you will pay after 3 years. Relevant present value you will calculate and 17.07. So here you can pick it up. This is 1 year. Then this is after 3 years, 0.6830. Same number we are using here. This is the value. That is the value at which the provision will be recognized. Now, what will happen subsequently? On this, you will add interest as a finance cost and continue to update the estimate. Okay. The provision is calculated using pre-tax cost of capital. That is one. Then, capital advances are not to be classified under CWIP. They are specifically to be disclosed under other non-current asset. This we have already discussed. If it is within 12 months, we may say current asset, but if it is beyond that, other non-current asset. Share application money to the extent non-refundable shall be shown under equity. This we know. Share application money refundable will be other financial liabilities. This we have discussed earlier also. Deferred tax asset and deferred tax liability both cannot be presented. You have to show it as a net amount. Bank deposits more than 12 months will be shown under other financial assets. So very, very simple and straightforward question. Right. So that's it. Then that's it for today. As per the plan, whatever we thought we'll cover it till yesterday, we have covered it. Monday onwards, it's tomorrow onwards, you'll have taxation. Till the time taxation is completed. Then we'll check with you in the group if you are okay for additional hour. Okay, so we can have, let us say, taxation and FR, because largely that is what is pending. So taxation 1 hour and maybe FR 1 hour, something like that we can plan so that we can finish. We don't drag it till the last day before the exams. We'll try to finish it much earlier. Audit notes will be provided on Monday or Tuesday. For the class completion schedule and the notes related to taxation, I'll talk to Chief Dejan and I'll update it to you by tomorrow. Okay, sure. Yeah, thank you. Chalo, thanks.
Let me look at the next interesting case study, my dear friends. Please, let's do that. Samyen.B Limited, SBL, is an unlisted public company located in Nagpur and is involved in the business of lubricant products. It has a factory in the outskirts of Nagpur city for producing such product. Next, KPL, based in Bangalore, has asked SBL for a special job that was required to complete within 1 week, and it has requested SBL to deliver the completed work order to its customer TKF, based in Bhopal city of Madhya Pradesh. So basically, KPL requested SBL to send it to TKF. This is a clear-cut case of bill to ship to model, because SBL will raise a bill on KPL and they'll send the goods to TKF. And in case of bill to ship to model, I hope you guys know what is the answer for place of supply. If the goods are supplied by supplier to the recipient on the instructions of the third person, place of supply will be principal place of business of such third person, which is nothing but Bangalore. And the distance from SBL's factory to location of TKF was 350 kilometers, and SBL made delivery accordingly through its transport vehicle by generating e-waybill. And guys, e-waybill, how many days it is valid? If it is 350 kilometers, already I told you in the previous session also, up to 200 kilometers, it is 1 day. And for every 200 kilometers or part thereof, 1 additional day will come. So it is 350 kilometers, there will be validity of 2 days. Over a dimensional cargo, it is 20 kilometers. Remember that? Got it. For the purpose of performing a special job of KPL, SBL purchased a machinery of 10 lakhs, which has useful life so and so. Cash flows. Okay. Next, what else again? There was a corporate insolvency resolution process. Fine. We are not concerned with that. There arose an obligation. We are not concerned with, I'm not concerned with taxation, I'm telling. Restore environmental damage. Cost of replanting. Fine. Next slide you see. Jaiswal & Co, firm of chartered accountants with 3 partners, was given an offer letter by SBL for appointment as statutory auditor as well as tax auditor, which was accepted by them after complying with the required formalities. They have got 180 tax audits to be conducted. 3 partners. I hope you know that every partner can do maximum 60 tax audits, including the tax audit of SBL, out of which 3 audits are to be conducted under section 44 ADA and 2 audits under 44 AE. I hope you guys already know this provision. Whatever tax audits are conducted under 44 AD, 44 ADA, 44 AE, that will not be taken into account for calculating the limit of 60 tax audits. So from the total point, from the total 180, we'll reduce this 5 tax audits. So they still have 175. So that means they're still having 175 tax audits. That means they can happily take 5 assignments more. You're getting what I'm saying? Good. Student is asking, sir, question mentioned that it's over-dimensional or other than over-dimensional. See, question is silent. If question is silent, we'll obviously assume as other than over-dimensional cargo only. If not, question will specifically tell over a dimensional cargo. In case of over dimensional cargo, and also for your knowledge, let me tell you, in case of multi-model shipment, where there is at least 1 leg which involves transport by ship, in those cases only there is 20-kilometer logic. If not, we'll always take 200 kilometers logic only. Next. Amrit Jaiswal was appointed as engagement partner for conducting statutory audit. He is holding statutory of 25 companies, including SBL, of which 4 OPC, 2 dormant. Fine. There was a change in the accountant, and the new accountant prepared financial statements. And there are some errors in the financial reporting. Simple question. From taxation point of view. Again, I'll repeat, from taxation point of view. With reference to information given under para 1, who could have generated e-waybill in case of work order to be delivered by SBL to TKL? So let me tell you, in case of bill to ship to model, my dear friends, the e-waybill could be generated by SBL or it could be generated by KPL, my dear friends. Any of the person can generate e-waybill. Getting my point, everybody? Next point. But only one e-waybill has to be generated. That's very clear. And for how many days e-waybill is valid? E-waybill is valid for a period of 2 days, my dear friends. So in this particular question, what will be the answer, my dear friends? Straight answer. In case of bill to ship to model, e-waybill can be generated by any person. But only one e-way bill should be generated. That's very important. It can be generated by any person, but we can generate only one e-way bill, my dear friends. That's mandatory, my dear friends. All of us getting the point, my dear friends? Further, since the distance is 350 kilometers, the validity of e-way bill will be 2 days. Because for every 200 kilometers, it is 1 day, my dear friends. And for every 200 or part thereof, extra 1 day will come. That's all is the story of this simple first MCQ. Second MCQ, interim resolution. That is all about your insolvency professional. IBC, your favorite. Next, they're talking about committee of creditors, resolution plan, application commission. Fine. How many further tax audits they can be accepted, my dear friends? Already I told the answer to you for this question, that out of total 180, whatever audits are conducted under section 44 AD, ADA and AE, that is not considered. So out of 180, 5 are reduced. Those 5 are reduced. So they can still take more 5 audits. Are we getting clarity on this point? Each partner can perform maximum 60 tax audits. Further, audits conducted as per section 44 AD, 44 ADA and 44 AE are not considered for calculating the limit of 60. Accordingly, 5 tax audits are reduced. That's it, my dear friends. I strongly believe that you got clarity on this point, my dear friends. So tax audits which are conducted under 44 AD, ADA and AE shall not be taken into account for computing that 60 limit, my dear friends. I believe that you are clear with this point, everyone. Done. Let me proceed. How many further audits of unlisted public companies can be held by Amrit? So that is also not related to taxation, my dear friends, that they're talking about your Companies Act provision. Companies Act, you know that, right? Tax audit limits are, Companies Audit also has got some limits. Student selling already discussed. Very good. Happy that already it is discussed. Next. First question is not related to taxation. Second question also is not taxation. 8th question. With reference to information given, determine place of supply in respect of transaction involved in work order delivered by SBL, my dear friends. Already I told you, work order delivered by SBL, the place of supply will be principal place of business of such third person, which is nothing but Karnataka, my dear friends. And supplier is in Maharashtra, recipient, place of supply is Karnataka. So in this transaction, what will come is IGST will come into picture. Come on, let me write the answer here. As per section 10(1)(b), POS, come on, my dear friends. Section 10(1)(b), place of supply would be principal place of business of such third person. Getting clarity, my dear friends? So, for transaction between whom, my dear friends? For transaction between KPL and SBL, POS would be Karnataka. and supplier is in Maharashtra, my dear friends, accordingly, IGST would be levied. There is no doubt about it, my dear friends. Getting my point, everyone? And moreover, for transaction between KPL, correct, my dear friends? KPL will definitely raise invoice on TKF. KPL will raise invoice on what, my dear friends? TKF. POS would be determined as per section 10(1)(a). You already learned this concept in GST also, my dear friends, that two transactions are involved, then two places of supply will come, my dear friends. And as per section 10(1)(a), POS would be the place where movement of goods terminates. Movement of goods terminates for delivery to the recipient. Place where movement of goods, what, my dear friends? Place where movement of goods terminates for delivery to the recipient. Come on, my dear friends, where the movement of goods terminates? Let me go back to the question. Yeah, to customer based in Bhopal city of Madhya Pradesh. I was just trying to recollect that Bhopal, Madhya Pradesh and all. That's why I was just looking at the question once again. So clear cut, my dear friends, the movement of goods terminated in Madhya Pradesh. That is Madhya Pradesh. And very clearly in this question, supplier is in Karnataka and POS is Madhya Pradesh. Hence, IGST would be levied. Because ultimately we know the concept that if location of supplier and the place of supply, both of them are in different state, what will happen is it is regarded as intrastate supply and IGST will be levied. And if both of them are location of supply, place of supply, both are in same state, it is regarded as intrastate supply and CGST and GST is levied. You already know that concept, right? Exactly. So going back to the question, let's see what else they asked. Eighth part, first bit we discussed. Second part, with difference information given under para 3, what would have been the constitution of committee of creditors? That is not the story related to your taxation. That's the story related to your insolvency and bankruptcy court. And that too more related to your insolvency process and all. Clear? That's it, my dear friends. That's the story of this very, very interesting case study. I strongly believe that you guys have got very good knowledge on this case study is what we discussed. Story is not over yet. Next session, we'll discuss much more interesting case studies on taxation, my dear friends. But today's discussion, that's all for today. Thank you so very much. Have a great, wonderful, balanced day. Shivateja signing off. Thank you so very much, my dear friends, for the wonderful participation and interaction. Thank you. And next lecture also, I'm only going to take, we are going to discuss very, very interesting case studies in taxation. Thank you so much. Take care. Bye-bye.
Okay. So this is with respect to Fashion India, and it's a pretty comprehensive case study covering DT, IDT, FR, law, and SCMP. So all the aspects have been covered. So you need to be slightly patient here when we are discussing the case in hand. Okay. Again, we'll follow a similar approach. First MCQ. So here, if you see the pattern, MCQs 1, 2, 3, 4, 5, 5 into 10 marks. And we expect it to be in similar lines, followed by 5 marks question each. Okay. So first MCQ, which one of the above 5 selling prices will be charged for the product in domestic market, and what will be the status of established selling price when it moves from the growth stage? So here this is about a price decision. Then, as per Ind AS 102 share-based payment, what should be the price and the date for recording the machinery purchase? So this is specifically for with respect to Ind AS 102. How do we account on which date and at what value? So this is with respect to FR. By which date FIL should have exported all the goods, and whether it is possible to refund outstanding on January 31st without intervention of authority as per FEMA. So this is from economic laws. As the investment proposal of Mr. S was approved only by 3 directors, present in the board meeting. So this also is true with law. Which of the following statement is not correct in relation to transaction entered between TEL and FIL? Okay, so now here it is more to do with the aspects related to your input tax credit. So if you see here, goods need to be exported and TL needs to provide copy of shipping bill of export or export to FIL along with proof of export. Then they talk about, LUT bond, IGST. So this is to do with indirect taxation. Compute the profit of FIL for tax purposes along with detailed notes, considering all the eligible deduction based on the facts mentioned. So this is to do with direct taxation. One of the marketing managers believe that the product can also be sold below the marginal cost. Is this view appropriate? So this is to do with costing. And historically, they have not exported through a merchant exporter. Explain the meaning of merchant exporter. Under what circumstances good can be supplied to merchant exporter at a concession rate of GST. So this is to do with ITT. Now, here if you see in the descriptive question, here if you see what it says, one is calculate profit, which is related to the question. Here, is the view appropriate to sell product below marginal cost? Situations where pricing below marginal cost can be adopted. This is more like a direct question. Same way here also, under what circumstances they can be supplied to merchant exporter at concession rate. This is also more like a direct question. Okay, so now let us come back to the case. See, this approach over a period of time, what will happen is you will start getting a sense of which paragraphs to focus on. Okay, and that will make your life slightly easier when it comes to your answering the questions. FI Limited, based in Chandigarh, globally leading textile manufacturing company since 40 years, driven by differentiation strategy, means we will provide different type of products rather than being a cost leader. As a leading textile company in India, FIL's key focus is on the domestic market with sustainable textiles and on building a strong B2C presence while continuing to grow its export business. So they want to be in India. So this is more to do with strategy. No question has been asked on strategy. So by this time, you should understand that this paragraph has things related to strategy only, and we need not focus excessively here. Okay, then due to competition in the market, company continuously reviews its product range and enhances its existing product by developing new models to meet the demands of its customer. New products are being developed. FIL R&D team developed a new product, Gladden, which has lifelong antimicrobial properties and odor prevention benefits and keep the linens fresh for a longer time. So this is again an operational aspect. But now here, if they have to twist the question, they can ask questions like, so basically what they mean, antimicrobial properties. So they are into textile business. Antimicrobial means that they will not attract or retain germs. And odor is bad smell. Bad smell also will be prevented. The new product was approved by the management in July 22 and was launched in December 22. Gladden is now about to enter the maturity stage of its life cycle. So here, if you look at the stages, you have initial phase, growth phase, maturity phase, and decline phase. So they are entering from growth to maturity. Research by marketing team indicates that demand of the product in the domestic market is price sensitive, and the likely market responses are as follows. So if you sell at 1550, you can sell 6,000 units, 1400, you can sell 8,500 units, 1325, you can sell 10,500 units, and so on. Now there is one question based on this pricing which you have to see. The variable cost per unit manufacturing Gladden is 850 and the attributable fixed cost is 250,000. So we know, or 250,000. We know fixed cost is not relevant in decision making. What is relevant is 850. The price charged by competitors is 1250. Now, if you look at the question says there are differentiators. Differentiators normally do not follow the market. Differentiators generally do not follow the market. They will follow or they will create their own pricing and accordingly they will sell it in the market. The production department believes that producing Gladden existing machinery cannot be used and a specific type of machinery is required. So they need new machine. The required machinery is being manufactured in India only by two companies, RFD and SCD. Upon evaluation, FIL concluded that RFD takes a period of 2 to 3 months and they would approach RFD for buying the machinery. Agreement to purchase the machinery was entered on August, with a clause that FIL have to settle the consideration of machinery purchase by issuing its equity shares. So there is a question on machinery purchase. Machinery purchase, what they will do? They will issue equity share. FIL agreed to the clause and order was confirmed. Machinery was supplied, wide invoice dated October 25 and delivered on November 1st. Agreed purchase consideration was 150 lakhs and the fair value of the machinery supplied was 160 lakhs. As agreed, FIL issued 1 lakh equity share of face value 100 each to RFD Limited. So this is a share-based payment transaction. So the moment you see share-based payment transaction, what should come to your mind is Ind AS 102. As per Ind AS 102, how we should issue the transaction, how we should account for it, we will discuss that. Right? Then this talks about one of the products Simmer introduced in the year 2016 is at the end of its life cycle and company's revenue from it is declining at a fast pace. If you look at the last line, FIL replied to the auditor that TEL neither supplied any export proof to them nor they have demanded it. So here, this is talking about something related to export proof. And if you, of course, we'll discuss this subsequently in taxation, but by reading at this, when export proof is required, and if you see here, a lot of discussion around, GST is there, all of that is there. This is something to do with taxation related aspects, your indirect taxation related aspects. So to answer the indirect taxes related question, this paragraph will be relevant. Then Mrs. Cotton Garments buyer from a US based company dealing in high-end garments was regularly getting customer queries about availability of laden in its retail stores. Okay, now here if you see, they are getting inquiries from a foreign company. Management contacted FIL of supply of 10,000 units. Price was agreed at 1,500, making the total contract value as 1.5 crores. As per the contract dated December 1st, as Cotton Garments was professionally managed, during the finalization of the purchase agreement, clause was inserted stating that if goods were not supplied within 3 months, FIL will pay interest at the rate of LIBOR plus 100 basis points. Please keep in mind, LIBOR is no longer relevant, so they're going to the question. It could be MIBOR or any other interbank rate. Okay. Now, moving further, they had given some advance. So the customer had given some advance, and based on that, the interest was agreed upon. FIL could supply only 2,000 units of laden on time and could not supply the remaining 8,000 units due to paucity of raw material. Paucity means shortage. Paucity means shortage. Management of FIL met the top leaders of Cotton Garments and explained the reasons for not being able to supply the remaining units and requested for waiver of interest. However, the management of Cotton Garments waived the interest with the condition that remaining advance be returned to them immediately. FIL requested a period till 31st January to which the buyer agreed. So this is related to some kind of interest compensation which the other party is expecting. Okay. Then FIL earned good profits by launching laden and so and so. The management decided to pay the interest of 3 years upfront on the debenture outstanding in the books of accounts with a balance maturity of 3 years. Total interest payment amounted to 600 lakhs. While preparing financial statement for the year ended 31st March, management treated 2/3 of interest as deferred revenue expenditure and recorded an expense of 200 lakhs only for the financial year 22-23. The statement of P&L of the company reflected a profit of 2,000 lakhs before adjustment of interest of 200 lakhs and charge of depreciation. So this will be required for you to calculate the taxable profit or taxable income as per DT provisions. They proposed an investment of 100 lakhs in equity shares of a reputed company as a part of company's investment plan, and then for which they have taken some approval. This is related to your law related aspect. Pretty comprehensive. A lot of information again is not relevant. Now let us go to the subject specific aspect. First one, which of the 5 selling prices should be charged for product in domestic market? So first is what should be the price? Second is what will be the status of established selling price when it moves from growth stage to maturity stage? Now always keep in mind or always remember, this is the phase: introductory phase, growth phase, maturity phase, and decline phase. Okay. Now, in the introductory phase, whenever a company is in the introductory phase, we will try to charge low prices because we want to capture more and more market. When we charge low price, this is also called as price skimming. This is called as price skimming. As it moves ahead, grows, we will increase the price. As it moves to the maturity phase, we will start reducing the price gradually. And as it moves towards the decline phase, we will generally exit from the market. Now, what they are saying is in the question, which price should be charged for the product in the domestic market, and what will be the status of established selling price when it moves from growth to maturity? Now, here, currently, is about to enter the maturity stage. Now, if you are about to enter the maturity stage, means the price must be moderated. You will not charge a very low price. You will not charge a very high price. And maturity means the quantity demanded is started to taper off. Okay. Second thing is this 1250 we should not consider because we are differentiators in the market. That can be a benchmark, but we are differentiators in the market. So we will charge some kind of premium. Right. Now, if you see here, it is price sensitive. So 1100 is out of question because market itself is charging at 1250. So 1100 we will not charge. 1260 is also not very relevant here because it is just slightly above the market. And here we are saying we are differentiators. So we should consider these 3 price points which are more relevant in our discussion. Okay. Second thing is we are looking at a maturity phase, and at maturity phase the demand starts tapering up. So this is a high phase, maturity, decline. And the third thing also you have to see is revenue maximization. So I'll just share an Excel sheet where we can calculate. Now here if you see 1550, 6000 demand. So 1550 into 6000, we get a revenue of 93 lakhs. 1400, 8500. 119. 1325, 10,500. We get 139. So at 1325, we get the highest revenue in these three price points. Of course, here the revenue is higher, but again, it is close to the market. So our ballpark number is 1325. If we come down, selling price to be adopted is 1325, and price is likely to be reduced gradually when the product moves from growth stage to maturity stage. So this is Let us assume for a moment we charge 1325. Second part of the sentence statement says we will reduce the pricing. We will reduce the pricing subsequently when it moves from growth to maturity phase. So that we have discussed just now. Initially, we'll charge a low price. In the growth, we will charge a higher price. As we move from growth to maturity, again the price starts dropping. So this part is valid. Second, selling price is to be put at 115.50. Price is likely to remain constant when the product moves from growth to maturity. Price will not remain constant. Towards maturity, price will start tapering off, or we will start bringing down. Then selling price is to be adopted is 1260, and price is likely to be in line with the price charged by competitors. This is not actually appropriate here because we are differentiators. Always remember, differentiators charge slightly higher than the market. Selling price is to be adopted is 1325, and price is unlikely to be reduced and likely to be constant when the product moves from growth to maturity. So from growth to maturity, price has to reduce. So which makes the first option, option A, as the most appropriate one. Then second one on Ind AS 102. As per Ind AS 102, share-based payment, what should be the price and the date for recording the machinery purchase? Now, if we come back, supplied while invoice dated October 25th and delivered on November 1st. So we can consider November 1st as the control date. And the fair value of the machinery is 160. Agreed purchase consideration was 150 and the fair value was 160. Shares were issued 100 each, face value of 100 each. Right now, the question is, should we consider 150, 160, 100 or 150? Now, 100 is definitely out of the question. The simple reason being, it cannot be 100 because 100 is just the face value. Correct? 100 is just the face value, so we cannot consider it to be 100. Now, the next is, should it be 150 or 160? That is the first question. And second question is, what should be the date? Two things are very, very important. Now, if you look at the principle given under Ind AS 102, an entity shall recognize the goods or services received or acquired in a share-based payment transaction when it obtains the goods or services. When it obtains the goods or services. So, when did we obtain the goods? We obtained the goods on 1st of November. So, 1st of November should be considered. And second principle, when there is a share-based payment transaction that we have to keep in mind is that when we have received that asset, we have received the asset, we have issued the equity. We have agreed for some consideration that is there. But then, so this October 25th is not valid because we have to take on 1st of November. So either 150 or 160, one of these two should be the number. Now, whether 150 or 160, see, we have received an asset worth 160. The fair value of consideration received or the fair value of asset received is 160. So 160 should be the value at which we should account for the asset. And the entry will be debit EPE, credit equity share capital 100, here 160, and credit security premium 60. Is this part clear? 1.2, is that clear? Okay. Then the next question is on refund of advance. Now, whether we need approval of RBI or not, or any authority or not, that is what we will discuss in FEMA. Now, here, one more thing where they have not tested any specific question with financial reporting. But here, if you see, management decided to pay interest of 3 years upfront on the debentures outstanding in the books. Okay. Now, if they do that, if they have paid some amount in advance, for accounting purpose, we follow effective interest rate as required by Ind AS 109. So the entire amount that has been paid, if you have paid upfront, entire amount will not be considered as an interest expense for the books. Here they have done a different treatment, that's a different thing. But as far as books of accounts are concerned, for India's purpose, you have to take opening balance multiplied by the effective interest rate to calculate the interest expenses. Okay, so that is with respect to that loan payment. Here, of course, you will require that for calculation of your taxable liability, taxable income, and all of that. Then, one of the marketing managers believes that a product can also be sold below marginal cost, whether his view is appropriate or not. Now, what is marginal cost? Marginal cost is nothing but the cost of producing additional unit. Cost of producing additional unit. Additional unit means, if for example, cost to produce 100 units is 1200, cost to produce 101 units is 1250, we say marginal cost is 50. Is this part clear? You have learned in economics also and costing also. The cost to produce one additional unit is called your marginal cost. Okay, so this is basically incremental cost. Incremental cost to produce certain item is called marginal cost. Okay, now the question is, one of the marketing managers believes that a product can also be sold below marginal cost. Is his view appropriate? Indicate the situations where such thing is justifiable. Now, where do we sell it below marginal cost? I'll give you an example. Jio, when it was initially launched, it was making losses. It was selling goods at below cost services. Why? To capture new market. Or if you look at a lot of new age startups like, let us say, Zepto, or let us say Flipkart, Amazon, to popularize their product, to popularize their services, what did they do? They gave heavy discounts. Till now, a lot of these companies are making losses. Why did they give heavy discount? To popularize their product, to capture market. So in that case, you can sell the products below your marginal cost. Okay, then a lot of time what happens is, if you see, I don't know whether you have seen it or not, if you go to the store next time, you definitely look at it. DMart, it says milk packet 5 rupees discount. Does any of your nearby shops give discount on milk packet? In fact, they will say refrigeration charges, cooling charges, extra 1 rupee they will charge. Correct? Yes or no? Okay. So now, why is DMart giving 5 rupees discount on milk? That becomes attractive. The moment you see, oh my God, they are giving 5 rupees discount on milk. Let us check it out. You enter into the store to buy milk, you end up buying other stuff also. So in those scenarios also, it may be better to sell below marginal cost, right? So there are some scenarios or situations where we can sell below marginal cost, where materials are perishable in nature, means they have a short life. So in that case, you can sell below marginal cost. Where the stocks have accumulated in large quantities and the market price have fallen. So we accumulated a lot of stock, but market price have fallen. When market price fall, instead of holding the product and incurring storage cost, we can sell the product at lower price and clear our stock. That is why you get this 80% off end of season sale or end of reason sale, whatever they call it. 80% off, 70% off, 50% off. Why are they giving that huge discount? Because they want to clear their old stock and get new stock. To popularize a new product, if I'm launching something in the market, we can do. In fact, when we launched, I don't know how many of you are aware of it, we launched 49 rupees per chapter of CA, inter and CA final auditing. 49 rupees per chapter, as low as 49 rupees. Why? We wanted to make it popular. Then, when such reduction enables the firm to boost the sales of other products having a larger profit margin. So, in this product, we are incurring losses, but in the other products, we are making profit. When that scenario emerges, also, you can, make profit. Now, This is a purely theory question which you should be able to pick up from the notes and write it in the examination, right? So that largely concludes the case study discussion of this part. Very interesting case study, because you have this particular taxability of profit and refund of advance. So both of these are specific aspects which you can which you will be discussing in the subsequent classes, that is tomorrow and day after. Those will be discussing those two aspects. Then the next one is from November 22. Any questions in this? Any question related to approach or how should we solve? Yeah, one more thing, what I would want you to, all of you to practice is start writing. Write the solutions. You can actually also, attempt these questions in theoretical in writing, because writing is also important in the examination. MCQs, so the way we should target is, see, 5 MCQs, 10 marks. Okay. And there are 4 case studies. So out of those 40 marks, we should be able to score at least 25 to 30 marks. That should be our target, so that in the balance part, it does not take us so much of time when it comes to solving the other aspects, where we require writing. Some of the concepts we may have forgotten, some of the concepts we may not have time to present, right? So that is what we have to keep in mind.
Let's move on to the next case study. Yogita ma'am will take you through the next case study.
Okay. So let's move on to the next case study. So now we are going to be taking up the suggested answer, or we can also say the question paper from November 23 examination. All right, so I'm going to share my screen. Okay. So see, this is a long case study. So we are, of course, not going to be reading through the entire case study, but we'll directly jump onto the question, because the goal of our sessions is, okay, so the goal of our sessions is that we are simply going to be reading the questions. Accordingly, we are going to think about the provision, what is applicable. Then accordingly, we are going to jump onto the facts of the case, and then we'll see what is the correct answer. Okay, so we have to try to make it as short as possible, because in the exam, you will have to solve this entire case study in 1 hour. All right, so let's see. So here we have got 1.4, which is our relevant question. So let's read this. So as the investment proposal of Mr. S was approved by only 3 directors out of 5 directors present in the board meeting, then we have got options. Company can go ahead with such investment plan as majority of the directors are present, etc. Now, see, directly jumping onto this question and reading these few lines, you have got absolutely zero context of what is exactly the case study, right? So what are we going to do? Okay, so first of all, yeah, so as we read this question, it says investment proposal of Mr. S was was approved by only 3 directors. So first we need to find who is this Mr. S. Clearly here we are talking about some sort of investment proposal which is approved by 3 directors out of 5 directors. So let's go into the question and try to figure out who is this Mr. S, what is he talking about. Okay, so I have already sorted it out for you. So we are going to simply read this part which is relevant. Okay, so as FIL is having surplus fund, one of its directors, Mr. S, Okay, so we don't have to know all the directors. Simply Mr. S is one of the directors. Mr. S, who is a director, proposed an investment of 100 lakhs in the equity shares of a reputed company as part of company's investment plan. Okay, so here what is happening? This company wants to invest in another company. All right, so now if you know the Companies Act, then is this covered somewhere? Investing into another body corporate, is this covered anywhere? Tell me, is this covered in any section if you can remember? Is the company having any power or having any limits to, invest in another company? What do you think? Okay, so we're gonna, okay, so I'll give you the answer. So it is covered in section 186. Okay, it talks about investment into other body corporates. Okay, so we'll definitely have to refer to that particular section. So whenever you're studying the Companies Act also, please make a list of, or you can also refer to the notes that we are providing. You'll have to have a list of all the sections. You need to know every chapter has how many sections, what are the content, so that you can immediately, this section will click into your mind, and then you can go and see the content of that section and accordingly answer. Okay, so this part of the question further says, for seeking approval for the said proposal, a board meeting was conducted and it was attended by 5 directors out of 7 directors. And the proposal was agreed by only 3 directors. All right, so in the meeting, 5 were present and 3 of them approved. Okay, so let's quickly go into section number 186 now to understand what is the scenario here, what is the provision saying. Then we'll come back to the question and see. Okay. Okay, so I hope my screen is visible. Okay, so we're going to see what section number 186 says. So I'm not going to go through the entire section, but if you simply look at the relevant provision, it says that, see, the company can give loan and guarantee and security to any other body corporate or acquire the securities of any other body corporate, but there is a limit. Okay, so see, if that amount of loan which is given to any other body corporate or the amount of investment in the securities is done in any other body corporate, it can be up to 60% of the paid up share capital, free reserves or security premium, or 100% of the free reserves and security premium. Up to this much amount, there's no problem. The board of directors can do it. If they want to go beyond this amount, then they will have to take special resolution in the general meeting, and it has to be a prior special resolution. Okay, now this is simply talking about the power of the board of directors here. But what about the resolution that is to be passed in the board meeting? So with respect to that, the section says that no matter what is the limit of investment being made by the company, no matter what is the loan given, guarantee given, security given, in the board meeting, there has to be a unanimous resolution that has to be passed. Only if a unanimous resolution, that means all the board of directors, they agree to invest in another body corporate or give loan or guarantee, then only it will be done. Otherwise, it will not be done. So in this particular question, what is happening? In this particular question, we know 5 directors have attended the meeting. Now, out of these 5 directors, 3 of the directors have agreed to giving this investment. So is this section complied with? What do you think? Can they go ahead and make this investment? See, this section says unanimous resolution has to be taken. Okay. Yes. So correct. All of you are saying correct. No, this is not right. Okay, so that means all the board of directors, they will have to agree, otherwise they cannot invest. So we'll have to accordingly select the correct answer. So let's look at the options. So the first option says the company can go ahead with such investment plan as majority of the directors are agreed. So is this correct? No, this is not right, because we need all the directors to agree. Second one says the company cannot invest amount of 100 lakh rupees in equity shares of the reputed company as all the 5 directors present in the meeting, they did not agree. So this seems like the right answer. Still, we're going to read the other 2 options also. The company cannot invest the amount of 100 lakh rupees in the equity shares of the reputed company as a total strength of 7 directors must attend. See, there is no such compulsion that all the directors have to attend. Whosoever is attending the board meeting, all of them have to agree. It doesn't matter if all the directors are not attending. Okay, we'll have to just check the people who are attending. Company cannot invest amount of 100 lakh rupees in the equity shares of reputed company as the investment plan did not receive the consent of 3/4 majority. Again, this is not correct. Okay, so the answer that is correct is B. I hope you all have understood. So now I'm going to hand over the case to Ashrisha ma'am.
Okay, so let's look at a question which is from economic law based on this case. So we'll practice the same thing, read the question, then go to the part of the case study. So the question here is based on FEMA. Let's see what the question says. It asks us by which date FIL should have exported all the goods and whether it is possible to refund advance outstanding on 31st January 2024 without intervention of any authority as per Foreign Exchange Management Act 1999. So here, after reading the question, we get a basic idea that this question is asking us that by which date should FIL should have exported all the goods and is it possible to refund the advance which is outstanding. So let's go to the case study and let's go and read the relevant part of the case study. Here, so the relevant part of the case study is here. Messrs. Cotton Garment Inc., which is the buyer, was regularly getting customer queries about availability of Gladden in its retail store. So senior management of Cotton Garments contacted FIL for supply of 10,000 units. So FIL has got an export order of 10,000 units. Price per unit was 1,500 rupees, making total contract value of 1.5 crore as per the contract dated 1st December 2022. So this contract was entered into between Messrs. Cotton Garment and FIL on 1st of December 2022. As Cotton Garments was professionally managed, during finalization of purchase agreement, a clause was inserted stating that if the goods were not supplied within 3 months, that is 1st of March 23, FIL will pay interest at the rate of LIBOR plus 100 basis points on the advance of 1 crore, which is given on 31st December 22. So here we get the first very important relevant point, and that is the advance was given on 31st of December 2022. The date of advance is 31st December 2022. FIL could only supply 2,000 units of Gladden. However, what happened later is that FIL could only supply 2,000 units and could not supply the remaining 8,000 units due to paucity of raw material. Now, management of FIL met the top leaders of Cotton Garment Inc. and explained the reasons for not being able to supply the remaining units, and they requested for a waiver of the interest. So we have seen that if they were not able to supply the goods in time, they would have to pay additional interest, that is LIBOR plus 100 basis point, at the rate of LIBOR plus 100 basis point. However, the management, they waived the interest with the condition that the remaining advance would be returned immediately. FIL requested for a period till 31st January 24, to which the buyer agreed. So here we've got certain information about the export contract which was made. So the first relevant date here is that the advance was received on 31st of December 22. The second relevant important point here is that the management could not supply the goods within the time which was agreed upon. And the third thing is that FIL has requested for a period up to 31st of January 2024. So let's first go to the relevant provision and then come back to the question and answer it. So the relevant provision here is Foreign Exchange Management Regulation, which talks about advance payment against exports. So it says when an exporter receives an advance payment from a buyer, the exporter shall be under an obligation and should ensure that the shipment of goods is made within 1 year from which date? From the date of receipt of advance payment. Which means in our situation, what is the date of receipt of advance payment? On which date was advance payment received? Anyone? 31st December. What was the year? 31st December 2022 was the date of receipt of advance payment. Now, by which date should the shipment of goods should have been done? That is, by which date should the export have been done, should have been made complete? 1 year, that is 31st December 23. So we have the answer to the first part of the question, which was asking us that by which date should the export be completed. So it should have been done by 31st of December 22. And then the other points in this particular provision say that rate of interest should not exceed LIBOR plus 100 basis points, and the documents covering the shipment should be routed through a authorized dealer. However, it also says that in case the exporter is unable to make the shipment, then no remittance towards refund of unutilized portion of advance payment shall be made after expiry of period of 1 year without prior approval of RBI. It says that if 1 year has lapsed, then without prior approval of RBI, you cannot refund the advance payment, which means that the refund of advance payment can be made up to 31st of January 2024, but that can be made with prior approval of Reserve Bank of India. So they have proposed a date of 31st January 24. So that 31st January 24 refund can be made up to that date, but with prior approval of the Reserve Bank of India. So let's look at the options. So the first option says should have exported goods till 31st December. So yes, this part is correct. But is the next part correct? It says no permission from any authorities needed. So this cannot be the correct option. Moving on to the next one. Says FIL should have exported all the goods by 31st December and no permission is required. So this is also not correct. The third option says FIL should have exported all the goods by 31st December and permission from Reserve Bank is needed to refund the advance amount on 31st of January. So yes, this is the correct option. Export date is 31st December 2023 and the refund has to happen with the permission of Reserve Bank on 31st of January 2024. Is this clear? Have you all understood this particular point? And I hand over this to Yogita ma'am for the next case study.
Let me proceed to the next interesting case study. Now it's time to talk about the next interesting case study, my dear friends, which is about Fashion India Limited. Let's talk about this case study also. This case study is slightly very interesting. When I read this case study, I myself felt very nice case study, very logical, very knowledgeable case study this is. And it's a true spirit of the law where they have asked some brilliant, interesting questions in this case. Make sense, everyone? So without delay, let me proceed. Fashion India Limited just a second. Yeah. Fashion India Limited, based in Chandigarh, is one of the global leading textile manufacturing company in India since last 40 years and is driven by differentiation strategy based on innovation, branding, sustainability. Okay, very good. You are a wonderful company that we understood. Excellent. Then what? As a leading textile company in India, their focus is on domestic market with sustainable textiles and on building a strong B2C presence. All this is story. If you observe carefully, everything of this is total story what they gave. Got the point, everyone? Wait a second. I'm not finding a tool to highlight. Okay, anyways, no problem. Due to the competition in the market, company continuously reviews its product range. Stuart is telling edit restricted by ICA. That could be the reason. Got it. Company continuously reviews its product range, enhances the product, new product is approved, something product has come into picture, it's a maturity state, and they have given selling price, sales demand, variable cost. So variable cost, overheads, all this is not related to tax at all. Yeah. Production department believes that for producing Gladden, existing machinery cannot be used. Now tax provision may come into picture, and specific type of machinery is required. The required machinery is being manufactured in India only by two companies, namely RFD and SCD, engaged in manufacturing all types of machinery according to count of customer. Upon evaluation, FIL concluded that as RFD takes a period of 2 to 3 months, they would approach RFD for buying the machinery. An agreement to purchase machinery was entered on 10th August 22 with a clause that FIL will have to settle consideration of machinery purchase by issuing equity shares. So instead of paying cash consideration, they are going to give equity shares. Otherwise, there is non-monetary consideration. Good. FIL agreed to the clause and order was confirmed. Machinery was supplied via invoice dated October 25, 2022 and delivered on November 1st, 2022. Invoice date is October 25, 2022 and it is delivered on November 1st, 2022. Agreed purchase consideration was 150 lakhs. This is most important for us because ultimately that is the consideration that has been agreed. How much is agreed? 150 lakhs. That is the purchase cost, actual cost of the asset. And the fair value of the machine was 160 lakhs. So what? Agreed consideration is only what is important for us. As agreed, FIL issued 1 lakh equity shares of 100 rupees each. So what? Ultimately, agreed consideration is 150 lakhs. That is our relevant criteria for us. Next. Yeah. One of the products, Slimmer, introduced in the year 2016, is at the end of its life cycle, and the company's revenue from it is declining at a very fast pace. So they have realized that one product revenue is coming down year by year. That too at a fast pace. Company's marketing team in Mumbai has been approached by Tulip Exports Limited. Wow! A merchandise exporter to buy 5 lakh units of his product Slimmer at a rate of 750 each. Historically, company did not venture into such type of business, and whenever goods were exported, the same was done directly and not through any merchant exporter. The moment the word merchant exporter comes here, your brain should activate the concept of merchant exporter. Now, what is the concept of merchant exporter? Simple logic, my dear friends. Let us say there is a person Shivateja. Okay, I am somebody who has manufactured the goods, right? Now, if I directly export, that's called export. Now, let us say there is one more person called Raviteja who is actually an exporter. Shivateja is supplying goods to Raviteja and then Raviteja is doing the export. Then technically this person Raviteja is called a merchant exporter who is just procuring the goods from manufacturer and then exporting to the foreign country. One of the clause of purchase imposed by TEL, that is Tulip Exports, is that product will be supplied by FIL at concessional rate of GST. Very good. There is a concept of concessional rate of GST when supply is made to merchant exporter. So when Shivateja is supplying to Raviteja, I will not charge GST at regular rate, but I will charge GST at concessional rate. But the moment I do that, lot of relevant conditions come into picture. That I will give an invoice. I'll mention GST and a merchant exporter. Merchant exporter has to export within 90 days from the date of invoice. Then in that shipping bill or bill of export, he has to mention Shivateja's GST number, Shivateja's invoice number, all that the merchant exporter has to mention. And post-export, merchant exporter should give me a copy of shipping bill or bill of export. Hiding the sensitive information, he has to give me the document. This proposal was discussed and approved by the management, and the legal team was entrusted to ensure that all legal complaints pertaining to offer of TL would be satisfactorily vetted. Vetted means what? It will be satisfactorily checked whether that legally it is okay or not. That will be checked. Next. Specified goods were supplied by invoice dated June 1st, 2023 and received by TEL in its warehouse for further packing on June 5, 2023. So they were supplied by invoice dated June 1st and TL received in warehouse for further packing on June 5th, my dear friends. Payment for goods was received as per the terms agreed on June 15th. So wonderful. During the statutory audit, the statutory auditor sought evidence of goods exported to TEL. And FIL replied to auditor that TEL neither supplied any export proof to them nor they have demanded it. That is absolutely wrong. It is a responsibility to ensure that they collect the copy of shipping bill or bill of exports. And in fact, it is a responsibility of TL to provide the copy of shipping bill or bill of exports along with the proof of export, my dear friends, to the actual supplier. Getting my point, everybody? So that to give in this case, the TL should give a copy and the proof to the actual supplier and also to the judicial officer of the supplier. It is mandatory, not an option. Next. Cotton garments from US, Cotton Garments Inc., buyer from US-based company, was regularly getting customer queries about availability of Gladden. Senior management contacted FIL for supply of 10,000 units. Price is given. Contract value is given. As Cotton Garment professionally managed, during finalization, LIBOR, these are all related to your FEMA and law. Nothing related to tax. FIL earned good profits by launching the product Gladden, and overall profitability was also good for financial year 22-23. As a result, management decided to pay interest of 3 years upfront on the debentures. Instead of paying year on year, they are directly paying for 3 years upfront with the balance maturity period of 3 years. Total interest payment is 600 lakhs. While preparing financial statements for the year ended 31st March 2023, management treated 2/3 interest as, what did the management do? The management have treated 2/3 interest as what, my dear friends? Deferred revenue expenditure. Management treated 2/3 interest as deferred revenue expenditure and record expense of 200 lakhs only for financial 22-23. That is okay as per accounting. But let me tell you, as per income tax, my dear friends, whenever there is a payment of interest on the debentures upfront, there is a wonderful Supreme Court ruling in the case of Taparia Tools, where they clearly told that upfront interest on debentures, entire amount can be taken as deduction because entire amount is paid now. Next. There is no concept of deferred revenue expenditure in income tax as such. The statement of P&L account of the company reflected profit of 2,000 lakhs before adjusting interest of 200 lakhs and charge of depreciation on new machine. We have taken that new machine. Remember that, no? We got one new machine for 150 lakh, which is the agreed purchase consideration. Next. Final profit for tax purpose is yet to be computed by the finance team. Okay. If they ask us, we'll compute. As FIL is having surplus funds, one of the directors, investment plan, board of directors meeting, all that is story of your corporate law. Next. Come on, MCQs. The first one is related to strategy. Second one is related to your FR. Third one is related to your FEMA. Fourth one is related to your corporate laws. Fifth one, this is interesting. Which of the following statement is not correct? They didn't ask which is correct. They asked which is not correct in relation to transaction entered between TEL and FIL. That is your story of merchant exports. Correct? No? First point. Goods needs to be exported by December 31st, 2023. That is absolutely false. Because in case of merchant export, my dear friends, there is a mandatory condition, that is the recipient should export the goods within 90 days from the date of issue of tax invoice. And the question, if you remember very clearly, the tax invoice was issued on June 1st. Then where is the question of December 31st? Absolutely false. And TL needs to provide a copy of shipping bill and bill of export. That is okay. But the first part itself is false. No? Next. TL should be registered with Export Promotion Council. That is absolutely true. And can export the goods only under LUT. Fantastic. That is absolutely true answer. Because in case where there is a concessional rate that is charged, then the registered recipient should export under the cover of LUT. What is LUT? They export goods without payment of tax, and whatever tax they paid on input, that they'll claim it as refund. Next. TEL needs to indicate GSTN of FIL and the tax invoice number of FIL. Very true. FIL will be eligible for refund of ITC on account of inverted duty structure. Very true. That is also correct answer. But what is inverted duty structure? Inverted duty structure is that structure where the tax rate on inputs is higher than the tax rate on output. Not the tax amount. It is the tax rate. If the tax rate on input is higher than the tax rate on output, we call it as inverted duty structure. And in case of inverted duty structure, definitely refund is allowed. So if you observe carefully, B point, C point, D point, all 3 points are correct. And they asked the question, what is not correct? So in the question, what is not correct is only the first point, which is nothing but option A, my dear friends. Getting my point, everybody? Yes, that is the story of which is not correct. Very, very interesting question. Beautiful. Next, what did they ask? First bit, compute the profit of FIL for tax purpose along with detailed notes considering all the deductions based on facts mentioned in case study. We'll do that. Second case is marginal cost, that is related to your costing. Third question is, historically, FIL had not exported to a merchant exporter. What is the meaning of merchant exporter, my dear friends? Merchant exporter is somebody who is engaged in trading activity and exporting the goods. Next, under what circumstance can goods be supplied to merchant exporter? Logic is very simple. The supplier should supply the goods to a registered supplier only under the cover of tax invoice, and registered recipient should export within 90 days. And the registered recipient should indicate the GSTN of the supplier and also should indicate the invoice number. And the interesting point is that they must be registered with Export Promotion Council, which is a mandatory condition. And the registered recipient, that is your TEL, should inform FIL to charge GST at concessional rate. And the goods may be directly sent to the port or may be received by the TEL in its warehouse. Anything is possible, my dear friends. You're getting what I'm saying, my dear friends? And finally, it is at utmost duty of the TEL in our example to give a copy of the shipping bill and or the copy of bill of export. Shipping bill in case of air or vessel, and in another case by road, it is bill of export. That bill of export along with GSTIN and the tax invoice, proof of export, all that should be submitted to FIL. And also the jurisdictional tax officer of FIL, which is mandatory, my dear friends. So these points have to be written. These points you can directly see from the book and write. I don't think you have to take effort to remember all these points, and they are very simple points as such, not difficult, my dear friends. And the basic point, in example, what I told, Shivateja is supplying to Raviteja, Raviteja is exporting. What is the story now? I should give invoice to Raviteja, I should mention GSTN of Raviteja. Raviteja should export within 90 days. Raviteja should mention my invoice number and also my GSTIN on the shipping bill or bill of export. And after export is over, he has to give me a shipping bill or bill of export copy. All that is a procedural formality. Next, what did they ask? Compute the profit of FIL for tax purpose. Come on. How do we compute the profit of FIL for tax purpose? See here. Yeah. Computation of net profits. First of all, what is the profit as per books, my dear friends, which is nothing but 2000 crores. From that, I'll reduce upfront interest on debentures. And the point I told you already, will not reduce 200, I'll reduce 600 because of a very clear-cut concept called Supreme Court ruling in the case of Taparia tools, where they clearly told that upfront interest on debentures that can be taken as deduction. And I'll also reduce, my dear friends, depreciation on the new machine. What is the value of new machine? 150 lakhs into 15% into 1/2. I'll do 1/2, only half I will take for a simple reason, because in the question they clearly told it is purchased in October and November, which is nothing but less than 180 days. I'm sure you guys know the concept that in first year of purchase, if asset is put to use for less than 180 days, we'll claim only half of normal depreciation. And this 180 days concept is only in first year of purchase. Second and subsequent year, if it is 1 day or 2 day, or if it is not used, still we claim full depreciation only. So this will be 150 into 15% into 1/2, which is 11.25. And I'll also reduce, my dear friends, additional depreciation. Why additional depreciation? Because assessee is engaged in manufacturing. Assessee is engaged in manufacturing. And it is a new plant and machinery. It is not a second-hand plant and machinery. And the rate of additional depreciation is 20. And this also I'll do half. Otherwise, I'll take only 10% because it is put to use for less than 180 days. And the balance 10% can be claimed in next year. 150 into 20% into 1/2. The balance 10%, my dear friends, that can be definitely claimed in next year, because additional depreciation, they told in the law, if the asset is put to use for less than 180 days, we'll claim additional depreciation only at the rate of 10%, and the balance can be claimed in next year. So my PGBP income will be whatever profit I got minus out of all these things, which is nothing but 1373.75. A very, very, very interesting discussion. Student is telling, sir, half your additional depreciation left also available be next year. Very true. That balance 10%, I can definitely claim next year. There is no doubt about it. That's it. That's the story of this interesting discussion of FIL case law, my dear friend. And I already discussed about the concept of this merchant exporter also. If that also you write in the examination, you will get your full scores. See, one point is very clear. Integrated business solutions paper is not something which is totally different and away from your CA curriculum as such. It is altogether direct tax, indirect tax, corporate laws, FEMA, your financial reporting, all combined at one platform. That's only your integrated business solutions. You're getting my point? That's only your integrated solutions, my dear friends. This is not something which is totally different and totally altogether different. It's not something like that. You will definitely be able to grasp some points for sure, but you need to have that ability to identify from where this provision is flowing. That is important. If you are not able to identify from where this provision is flowing, then the real difficulty comes into picture. But as such, it is not a difficult paper as such. Done. So that's the story of your FIL case study. Yeah. One student is telling, I think if we think IBS is tough, it will be very tough, but with a cool mind, we can approach and score good marks. Right, sir? Absolutely right. Bang on. But the whole point is, what is important here is that while reading the case study, you should be able to identify what is only relevant for you. See, by reading the case study, you should be in a position to extract what is important for you. And the difficulty comes only when the case study is too big. When they give 5-6 pages case study, your time will become a constraint. That is more challenging, nothing else. But it's not that you can't identify. You can definitely do it. And during the course of our discussion in the coming sessions and coming lectures, we are going to solve a lot of case studies. And while doing that, automatically what will happen is that your command over subject will improve and you will get that hold on how to answer the case study. That is what will make you do. That is our responsibility. Clear? Yes. Good.
Let us move to the next case study. This is about SAK. Right? SAK. Voice not proper again, is it? Why is that the case? Just hold on for a second. Is it better now? I try and change the location of the mic. Is it better? Please let me know. Okay. Fair enough. Coming back. SAK. Let us see what are all there in SAK. I'm directly jumping to the questions. I'll come back to the case study after a few minutes once we see what are all the questions. MCQs. In respect to the following Benami property. Benami property is your other loss. It has not got nothing to do with the AFM, so no, not a point. How many performance obligations? What will be the transaction price? This is, I think, FR. So FR, so not AFM. And depreciation also FR, right? Then where is the contention of bank directors of machinery cannot borrow further Companies Act. This is corporate law. What would be the loss incurred by Shyam on cancellation of a forward contract? Okay, so this question I think they have given incorrectly. I felt very bad actually. Okay, let us see. This is an AFM question. Then, with reference to information given in point 5 above, compute the market price of the bond, explain the Macaulay's duration and compute the duration of the bond. This also we will do. Then explain virtual asset as per income tax act. So this is got nothing to do with us. Right. So the relevant questions are 4.5 and 4.6. One is what explain the loss incurred by Shyam on cancellation of a forward contract, and explain the current market price of the bond and duration and compute the duration. Okay. So we need not actually go through everything. Right. So point number 7. Is this point number 7? Did they ask point number 7? So this is point number 7 only. Meanwhile, Shyam reached out to CFO. So how did I get into forward contract thing? Directly looking at the question itself. Spot forward. This is the only place where it is given. So I've gone there. Right. When you're reading the question also, you'll realize it. Meanwhile, Shyam reached out to CFO with a personal query. His son Rohan wanted to pursue PG in hotel management from a leading university A. So university's name is A in Switzerland. With his efforts, he was able to secure admission in another university called University B. Oh, so he wants A, but he already got B. And response from A is awaited. Oh, so A has not yet responded. Right. Okay. As per rules of University A, if he gets admission, he'll be required to deposit the first year fee by 1st December 2023. So he's required to deposit the fee by 1st December 23. Shyam got the forward contract from a bank, BAZ Bank, on September 1st. Oh, in order to pay fees, he's taking a forward contract. Okay, this is for what? When you're paying fees, what? Your foreign exchange is going out. Foreign exchange is going out. You are buying foreign exchange from a bank and sending the foreign exchange to the University A. Okay. Now, he got a forward contract from bank on September for a fee amount that is 8,000 Swiss francs. So fee is 8,000 Swiss francs of rupees 30 at the rate of rupees 30. What does it mean? Swiss franc, the code is CHF, the currency ticker code, like India, rupee is INR, US dollar is USD, British pound is GBP. For Swiss franc, it is CHF. CHF rate is 1 CHF is 30 rupees. Okay, that is what they said. And that is what he entered into on December 1st, 2023. On November 1st, 2023, Rohan got news that A university has not given admission. So he first got in A, he wanted A, but he already got in B. For A, they have to pay fees. So they entered into a forward contract for making fee payment for A, but they got to know that they got rejected by A. Right? Though he was disappointed, he was happy with B. Acha. So he was disappointed, so he's happy with B, so he will join B. Shyam now went to the bank and cancelled the forward contract on 1st November. When was the contract entered into? Contract was entered into on 1st September. For what? For a buying currency of CHF, Swiss franc, on which date? On 1st December. Why? Because 1st December he has to send the money. So 3-month forward. September full month, October full month, November full month. 3-month forward contract he entered into on which date? On 1st September at 30 rupees per Swiss franc. And now on 1st November, he's cancelling the forward contract. On 1st November, he's cancelling the forward contract. Now let us look at the key aspects. 1st November, some rates are given. Spot is 30.3, forward is 30.45. 1 month forward. Why 1 month forward? For December 1st. In December 1st, the spot is 30.35 and the forward is 30.55. Now we are on which date? We are on November 1st. So December 1st data is irrelevant. What have they asked? They have asked us to compute a loss on a forward contract. Can anyone tell me by looking at these rates, okay, what is wrong in this question? 30.45. Okay. No, but I'm asking something else. 30.45, correct or not correct, we'll discuss. What is wrong in this question that they have asked? Okay, I'll explain to you the aspects. First, let us go to this. I don't know how many of you have access to this compiler. I have a compiler which is available free on our website. Is where you can actually check for how a forward contract is cancelled. I'm actually taking you to that aspect. Okay, forward contract cancellation. If you cancel a forward contract, what will happen? If you cancel before due date, you can cancel. You will do something called as early cancellation. Now, what happens in early cancellation? Let me see. Cancellation on due date and early cancellation. What will happen on early cancellation? Bank will cancel the forward contract. I hope it is visible. Bank will cancel the forward contract at opposite rate of the original contract on the date that matches with the date of the delivery of the original forward contract, and loss or gain, if any, will be passed on to the customer. That is exchange delivery loss, whatever is there, that will be passed on to the customer. But what is the rate that is considered? Opposite rate of the original contract. When you mean opposite, if it was a buy, you will do now a sell and you will consider that. And that matches with the original date of the forward contract. So, coming back to our question, somebody said 30.45, no? That is exactly the thing. On November 1st, you approach the bank and the bank will have to cancel it. How will bank cancel? Bank will enter into an opposite contract for 1st December. Why will they enter into an opposite contract? See, initially bank agreed to sell to you 1 Swiss franc at 30 rupees per Swiss franc. They agreed to sell to you 8,000 Swiss francs. They agreed to sell. That is, you are buying. Now, bank will enter into an ulta contract, which is bank will agree to buy from you. Why are they willing to buy? Because you said cancel the contract. So they will enter into a contract on 1st November to buy 8,000 Swiss francs from you on 1st December. So the spot on 1st November is irrelevant. What is relevant is the 1 month forward on 1st November. What is 1 month after 1st November? 1st December. So, and the spot on 1st December is irrelevant because we are on 1st November. How will we know what is the rate on 1st December spot? We will only know today's forward rate for 1st December. So, the correct rate is 30.45. I hope people have understood this. If anyone has a doubt, please let me know. Okay, I presume no, there are no doubts because nobody is pinging. Yes, please repeat. Acha, okay. So, the question somebody is asked. So, I like people to ask doubts. Okay. What is they saying? For early cancellation, bank will cancel the forward contract. So, first of all, bank will cancel. They will cancel the forward contract at opposite rate. Meaning, if your initial contract was bank wanted to sell to you, now bank will say, I will buy from you. Okay. That is, they will do an ulta contract of the original contract of the date that matches. So, on November 1st, they will do a contract, ulta contract for 1st December. So, they will enter into a new forward contract for December, but in opposite side. So, initial contract was bank was selling to you, that is, you are buying from bank. So, now the new contract will be bank will be buying from you, that is, you are selling to the bank. So, you agreed to buy dollars at 30, buy Swiss franc at 30. Now, you will have to sell the Swiss franc to the bank at the revised rate on forward rate, revised forward rate on 1st of December. But when is that decided? On the 1st November. So, whatever is the rate on 1st November for a forward contract of 1st December, that is what is considered. So, that is 30.45. Okay. So, let us see. What is the issue in this particular question? SAK. Okay. Initially, customer agrees to buy 8,000. Okay. CHF. What should be the point of view to find out the exchange rate about what I sell and what I buy back? So here, good question. Here, they have not given bid and ask quotes. So if it is bid and ask, the bank, so if it is bid and ask, then you have to figure out. Bid is bank is buying, ask is bank is selling. So let us see. Customer agrees to buy, bank agrees to sell. See, 8,000 Swiss franc, 1 CHF is equal to 30 rupees. So the bank initially agrees to sell. Sell is ask. So initial transaction is ask. So second transaction should be bid. So if at all they give you bid and ask, the initial transaction will be sell rate, where bank is agreeing to sell the Swiss franc. Second transaction is bid rate, where bank is agreeing to buy the Swiss franc. So they have not given, so we will not consider that. So customer agrees to sell. Now, this is on 1st September. This is on 1st November. We are looking from bank point of view or not customer. Yes. So if from customer, it is exactly ulta. From customer point of view, initially you agreeing to buy. So if you are buying, then bank is selling. So ask is what is applicable. From second leg, which is November leg, you are basically selling. So which is bank is buying. So bank is buying means the bid rate, right? So bid and ask, so I don't know if you guys are confused. Bid and ask are always from bank's point of view. Bid and ask are never from customer point of view. Bid means bank buys. Sorry, we must consider. What is the question somebody is asking? You must consider rupee or other currency. So this is also a good question. So if you had attended my AFM class, I'm sorry if you're not attended, but I'm generally telling you what I explained in the class. So there is something called as a base currency and price currency. Okay. Here the exchange rate is INR per CHF. Right. I'll zoom in further. Here the exchange rate is INR per CHF. So base currency is CHF. Price currency, that is in what currency is it quoted, is INR. So in our case, base currency, when you say base currency, you are referring to one unit. Price currency, multiple units. So in our case, base currency is CHF. So the banker bids to buy the base currency. BBC, banker bids to buy the base currency. So in our case, CHF INR, that is the code, which is also called as number of INR per CHF, is 30. Right. Let us take it is 30.1 by 30.2. I'm just making up a number. Okay. Here, bid is 30.1. Ask is 30.2. The banker is bidding to buy the base currency. So he's bidding to buy. That is, he's bidding to buy 1 CHF at 30.1. He will sell you 1 CHF at 30.2. So always from bank's point of view, bid is when they buy. And what do they buy? The base currency. What is the base currency? For which one unit is being sold or bought. Right. So coming back, I hope you have understood. If anyone has any doubts, please hold on, because we have to complete this case. Right. So now what will happen to this guy? On 1st November, you will agree to sell 8,000 CHF. On which date? On 1st December. Initially, on December 1. Now also on December 1, you are entering into an ulta contract after 2 months for a same maturity date. So the rate applicable will be 30.45. Okay. So here bank agrees to sell. Here bank is buying. Okay. So far nobody has told me what is the mistake. I'm still waiting. If anybody has found out the mistake, let me know. After I solve it, don't tell me the mistake. No, not December 1. This is a forward contract. This is a forward contract maturity. That is right. That is not the mistake. Buy and sell price. No, that is also not the mistake. Same rate. No, that is also not the mistake. I'll tell you, wait, hold on. 30. No, that is not the mistake. So customer is agreeing to buy 8,000 franc at, see, 1 franc is 30 rupees. So 8,000 franc will be 1 into 30, which is 2.4 lakhs. Customer is selling 8,000 francs at 30.45. Right. So this is buy, this is sell. Okay. So buying is outflow. Selling is inflow. Correct. Bank is buying it higher. Correct. So what? So what? You are on the right path. 3,600. The customer is buying at 2,40,000 and selling at 2,43,600. So if this is the case, the customer is making a profit or loss? Gain to customer. Absolutely right. Customer is making a profit. What is the question? Let us come back to the question. What would be the loss incurred by Shyam on cancellation? If you are making a profit, why will you compensate the bank? No. There is no compensation to the bank. Compensation to the bank will happen only in case of cancellation after due date and all of that. Okay, all that keep aside. This is a very simple question. The question is wrong. What would be the loss incurred by Sham on cancellation? Baba, there is no loss, there is profit. You agree to buy something at 30, the rate has gone up to 30.45. Now you are selling it off at 30.45. You made a profit or loss? You made a profit. How is it a loss? This is unfortunate, no? The institute should not have asked a question like this. They should have said, what is the profit incurred by Sham? Or they should have said, what is the loss incurred by bank? I mean, it's also not loss, right? For bank, because bank also will do back to back. So bank will gain only margin. They will anyway not be under any loss. The question should have been, what is the profit? They have asked, what is the loss? If in exam they ask this kind of question, what are you supposed to do? If the number 3600 is correct, my suggestion, please tick the answer with 3000, whatever is the number that is there. See, if they give plus 3600 and minus 3600, then you are supposed to say, figure out that profit is 3600. If they give only 3600, please attempt the question. Okay, if you know that the question is wrong, my suggestion, attempt the question. Don't leave the question. If you leave the question, you will not get the mark. If you attempt the question, they will give you mark. Okay, so please attempt the question and write it as A 3600. Yes, ICA will compensate only if you attempt. If you don't attempt, they will not compensate. Okay, so please attempt. Even though the answer is wrong, please mark the wrong answer. Okay. Okay, this is the unfortunate thing. In the next question also, there is something, not the next case also, there is an issue like this. Okay. Now, with reference to information given in 0.5 above, compute the market price of the bond and explain Macaulay's duration, compute the duration. Let us see 0.5 above. What is point number 5? I have not even read the question. See, I have not read full case. I'm directly going to 0.5. This is the advantage. You should read the entire case only if it is relevant. You should glance through the case. I'm not saying don't glance at all. But if it is what is relevant aspect, go there. The company is planning to invest its surplus funds in bonds and provides the following information. Face value is 10,000 to be redeemed at par at maturity. So face value is 10,000. Coupon rate is 9%. Years to maturity is 7. Yield to maturity is 10. And they've given you 7 years ka present value factors. What is the price of the bond? That is what they've asked, right? Compute the current price of the market price of the bond. Explain Macaulay's duration. Compute the duration. So what is the price of the bond? Let me minimize this. Let us look at the key aspects. Face value 10,000. Coupon is 9%. Guys, I'm solving this on Excel. You are going to solve it using pen and paper and a calculator. Okay. So please note that part. It is easier for me because see, computation should not be the thing that you are learning from IBS classes. Computation you already know because you finished the preparation for 5 other subjects. Okay. So please don't come back to me and say, sir, you solved in Excel. I have to solve in exam in pen and paper. Yes, you have to solve. There is no value add for computation. There is value add for understanding. Okay, coupon. Then maturity in years. 7. YTM is 10%. And then they have given the present value factors. Okay. So what is the price of the bond? Price of the bond is simply the sum of present value of all the bond inflows. So year, coupon, and face value is 10,000. So coupon is 9%. And it is a yearly coupon or coupon rate per annum. So it is per annum. So it is paid only once a year. So coupon is how much? 9% of 10,000. People got this now. What is coupon value? Anyone didn't get it? Ask. If you got it, no need to say. Okay, if you have not got it, ask me. So coupon is 900 rupees. So it is 7-year bond. 1, 2, 3, 4, 5, 6, 7. 7 years. Each year coupon is paid. How much is the coupon paid? 900 rupees. Okay, so each year 900 rupees is the coupon, and 7th year it is redeemed at par. What is redemption value? 10,000 rupees. So plus 10,000. Okay, what are the present value factors that they have given? 0.909, 0.826, 0.751, then 683, 621, 564, 0.683, 0.621, 0.564, 683, 621, 513, 0.513. Okay, so present value of cash flows. Okay, all of you know how to do this. PV, present value factor, present value annuity factor, all of that. You know, you guys can solve. Please solve it in the proper form. I am only showing you the solution. Okay. 900 into 0.909. So you compute all the present value factors and sum them up. So present value into cash flow and sum them up. You get the price of the bond as 9510. Why is the bond price lower than the face value? Anyone? Why is bond price lower than face value? Because market interest rate yield is 10,000, which is much higher than your coupon. If the market rate is higher than the coupons get discounted at a much higher rate. So the present value is less than your face value of the bond. If the yield is exactly 9%, this will exactly be 10,000. Okay. So the first answer to the first part of the question is, what is the price of the bond, right? Compute the market price of the bond, right? Market price of the bond is 9,500. Then Macaulay duration. What is Macaulay duration? Anyone? Macaulay duration is YTM. YTM means yield to maturity. Yield to maturity means you're asking what is YTM, or you're saying Macaulay duration is YTM? 5 is. You're asking what is YTM, right? Both same. Macaulay duration and YTM are not same. Macaulay duration, YTM is market interest rate or yield to maturity. Okay. Macaulay duration. Simple formula. Sum of present value of time weighted cash flows. This is the simple formula. Sum of present value of time weighted cash flows. So it is the time that it takes for the bond money to come back in present value terms. It is the time that it is taken. So you have to keep this aside. So what you do is, how you compute? Very simple. Present value factor is already here. So present value into PVCF, or let me say present value factor into time into cash flow. That's all. It is summation of these three. What is this? Time is year. Year is 1. What is cash flow? Cash flow is 900. And present value factor is this. Right. So all of this you compute and you sum up. And it is not just the sum. Okay, there is one more point. I thought somebody will correct me. Nobody corrected. Macaulay duration is sum of present value, time weighted present value of cash flows divided by market price of the bond. So what is the market price? 9510. So 51773 divided by 9510, you get 5.4439. That's all. It is very, see, in Excel it is looking simple, but even when you do it in pen and paper, you're just multiplying year into coupon into present value factor. Or you can directly multiply present value factor into the year and you get the same answer. Right? You sum up all of these. If you sum up all and don't divide by the price of the bond, gone. This is market price is 9510. Macaulay duration is 5.44 years. Even if you don't write years, is okay, but you have to say 5.44 years. Okay, so this is the answer to this question. Now, let me come back to this particular thing. Okay, let us look at the responses or questions what they've given here. Now let us see 3,600. I think we already saw. They gave answer as 4.5, right? They already told answer as 4.5 as A, but it is incorrect. It is actually gain. Okay, market price of the bond. What is it? We got it as 9510. They didn't ask for modified duration. They only asked for Macaulay duration. Acha, they asked for compute duration. Explain Macaulay duration, compute the duration. So whenever they say duration, it is Macaulay duration. What is modified duration? Modified duration is, they have not asked it here, by the way. That is, they have not asked it, which is why I didn't tell. When they say duration, it is Macaulay duration. Modified duration is sensitivity of bond for a change in interest rate. And the formula for it is Macaulay duration divided by 1 plus YTM. If YTM is semi-annual, you do 1 plus YTM by number of compoundings. YTM by number of compoundings. Right. So in our case, it will be 5.443 divided by 1 plus, what is the yield here? 10%. 1.1, right? So it will be modified duration 4.94. That is not asked, but I've just shown it to you. Okay. So now explain Macaulay duration compute. You have to explain what is Macaulay duration. Macaulay duration is, let us see what they have given. They have also computed. Macaulay duration measures the number of years required to recover the true cost of a bond, considering the present value of all coupon and principal payment. This is very important. If you don't write this, you will not get marks. And duration of the bond, they have computed exactly like what I did. They got 5.444. The duration of the bond is 5.44 years. Okay. Then they have done something else. 5.44 years they have done. They have also done a formula. This is a complicated formula. I have explained this in class, but I suggest you don't remember this formula. Please do duration computation manually only. Don't use this formula. Even if you use this formula, you'll get same 5.43 years. It is an approximation, but this formula may be quick if you have a lot of numbers. Okay, if you have a lot of numbers, if it is a 30-year bond, then this formula is used. I am pretty sure they will not give you a 30-year bond duration. They will not ask you to find out. Okay, so, but it is a formula that exists. I would not suggest that you use it because it is generally difficult to remember. Okay, I've explained this in the classes. It is there in our formula sheet also, but don't use it. My suggestion, go with this logic. Very, very simple. Sigma PV into T into cash flow divided by price. Okay, so we have finished the second case study also. This is also done. This was November 23 case study, which is on this, what is it? SAS, BAK. What is that? SAK.
Good evening, everyone. Just give us a couple of minutes. Few more students are joining.
Good evening.
Yeah, so give us a minute or so, then we will be starting. Okay. So we are also waiting for one more faculty, Shivteja sir, for taxation. We have Yogita with us. She will be taking care of law.
Good evening, everyone. Good evening, Surajji.
Good evening, Yogita ma'am.
Good evening.
We also have Ashlesha with us for other laws. And just a minute. So the way we will be proceeding with today's session is we will be taking up one case study that is from the RTP, a pretty comprehensive one. And as we discuss the case studies, we will also be discussing some concepts which have been, been tested in the examination. And as we progress further, we will be sharing with you the notes and all which you can carry to the examination. So that is how the structure would be, for the classes. If you have any questions, if you have any doubt during the session, feel free to ask, and let us make it interactive. Okay, it is not that only the faculties are talking and you're just listening and just making notes. Make it interactive. Try to give your alternate solutions, suggestions, and a lot of focus we'll also be spending on a lot of time on managing time, because reading quickly, especially when there is dense English, that is very important. So that part also we'll be focusing upon. So quickly, before we start, what is your level of preparation in terms of other papers other than integrated business solution? What is the status? Like, how much have you completed and how much is left? Okay, if you can share some insights, we can pace the sessions accordingly. Okay, Sekandar says GST revision going on. Very good. And what about group 1? Preparing only group 2. How can we approach IPS if I'm going to give only group 2? Yes. So for that,
We will be providing, summary notes for the 4 subjects rather. And with the help of that, you can prepare and we can appear in the, IBS paper. And also note that as we conduct these sessions, you will get an idea as to what kind of questions are tested. And based on that, you will have a good hold on how to appear in the examination. And if you see, there is a, equal distributed weightage across different subjects. So as we do conduct these sessions over a period of the next 1 month, you will be ready to face the examination, even if you're only preparing for group 2. Okay, that is our promise. So I think we're good to start. I think we should start, right? Yogita, Aslesha. Shivteja would join a little late, but then I think we should start.
Sure.
Yes.
Okay, so just a moment. And for those of you who have cleared group 1 earlier, for you, again, a quick revision of key concepts based on the notes that you would be providing, that would be enough for preparation for the examination. So, yeah, so we are taking up case study. Yes, for strategic management also, for example, in today's case study, there are, topics from strategic management and also from strategic cost management and performance evaluation. So for strategic management also, what we'll be doing is we'll be giving you the common models which you need to be aware of for this examination, that is integrated business solution, right? So that also will be taken care of. Same way for law, for, let's say for FR, for AFM, for all the subjects, summary notes which you can carry for the examination over a course of, next 10 to 15 days, that will be provided to you. Okay, so today we'll take up, again, welcome everyone, those of you who have joined in late. And a quick introduction, I am Suraj. We have Yogita, and we have Aslesha for law. Shivteja would be joining in some time. He is stuck up in traffic. He'll be just, joining in, who will be taking up taxation for you. As all of you might be aware, I teach financial reporting, strategic management, and advanced accounting. Yogita, a quick introduction from your side also would be helpful for the students.
Hello everyone. So my name is Yogita Harjani. I am a CA and a CS with a couple of ranks in CS, and I'll be taking up your company law part relating in this entire paper.
Okay. And Aslesha?
Hello everyone, I am CS Lisa Atal, and for paper 6 IBS, I'll be taking up the other laws, the economic laws part for all of you all.
Right. So, okay. So now we'll take up the first case study today. This one we picked up from May 24 RTP. One peculiar thing about this case study is there is a lot of industry reference given. Okay. And they have given the similar industry references for tea industry and all of that in the, student's journal as well. Now, how should we approach and what are the things to be taken care of? Of course, a lot of these concepts you might be aware of, some of the concepts you might not be aware of, how to handle those situations. That is what, we would be taking up. Just a second. Okay, so first they write some. What about bringing books in the exam hall? See, as I told you, we would be giving you reference materials that you can print and take it to the examination hall. Apart from that, you can carry Bayrax, right? A lot of these kind of paper is more about application of the concept that you know, what we will be revising and retaining them. Okay, but just by carrying 6 or 8 books, it will not serve our purpose. So what we have done is we have tried to summarize these things, which will be helpful for you when you take it to the examination. Right. So sir, will be provided with the soft copies of notes and case studies? Yes, you will be provided. All the paid students, they will be given access to all the resources that we are discussing. And whoever have enrolled for the course, you will receive the digest, the after every case study, what are the concepts covered, and then the concept that you need to carry for the examination. Now let's jump into the case study. I hope my screen is visible.
Yes, it is.
Yeah, okay. So now this is about civil aviation industry. Of course, in the examination, you will not get, which topics are being tested. You have to figure out on your own. Now, this is based on civil aviation industry, and they have given a company's introduction. Okay. Now, we will not spend too much of time in the company introduction or industry unless the question has a specific requirement for that. I'm repeating once again. Make a note of it, even for your actual examination. There will be a lot of information given which may not be relevant. Okay, so they have given about the company, they have given about the outlook of the company, then they have mentioned about what is the Indian economy like, what is happening, growth, then what is happening to passenger traffic in India. So if you see, in each of the paragraph, they're talking about some specific aspect of the industry or the company or the Indian economy. So if you reading, just a second. I request everyone to please be on mute. Okay, other than the co-hosts, right? So if you see, every paragraph has something about the industry, the economy, the country, and all of that. When you are reading this in the examination, in the first go, don't waste time in reading all of this. You just figure out, okay, here we have about, the Indian economy. Here they are talking about the passenger traffic. Here they are talking about, what will happen in the future. Then the airlines, KG Airlines, about the company. Then this is the history of the company. Now, in most of the cases, history of the company also will not have much bearing on the questions asked. So as you see further, what is their business model? Then the mission, the vision, the purpose. Now tell me one thing, where did you learn mission, vision, and purpose? In which subject did you learn mission, vision, and purpose? Strategic management, which you would have learned 3 years back, and also, SCMP. Part of it you will also learn in AFM. Just a second. Okay, then they have mentioned about operational challenges. Then they have mentioned about aircraft spare parts availability, increase in cost of operations, margins. And then they have given some operational highlights, which you learn as a part of strategic cost management. Then they have mentioned about on-time performance. Then they have spoken about something about the turnaround. Then they have mentioned about the fare structure. Then they have mentioned about the strategy. Right. So like this, if you see, the case study is pretty long one. Okay. Then we have the board of directors. Then we have extracts from the management responsibility statement. So this is the case. Now, this type of case will be presented to you in the examination. And our approach should be, in the first go, not to spend time in reading and understanding the case in detail, but rather than figuring out what is there in the question. Okay, what is given in the question, that should be of our interest. So Shivteja has also joined in. Just a second. Hi, Shivteja.
Yeah, hi Suraj. Hi.
Yeah, so students are there. We can wish them as well.
Yeah. Hello, my dear students. Hi.
Yeah. Okay. So now we have we just brushed through the case study, and now we'll be looking at the respective question, and then we'll go back to the case study, including the concept. So respective faculty here, they would be talking about the concept, explaining the concept involved in that particular case. Okay. This being the first case study that we are discussing in a structured manner, we will be slightly slow, but over a period of time, we'll try to catch up speed, because in examination, we'll have 1 hour per case study, and we should ensure everything is complete in that 1 hour's time, right? Now, the first question says, request everyone not to use annotation or unmute themselves when we are conducting the session, right? The first one, aircrafts operated by KG Airlines, whether owned or leased, require periodic maintenance. These are high value costs. As of the reporting date, provisions need to be made for these expenses based on number of variable factors and assumptions, likely utilization of the aircraft, expected cost, and condition of the aircraft. Due to the complexity and subjectivity of this condition, auditors rely on management judgment in order to quantify the amount of provision to be made. This would be an example of which type of risk in statutory audit. Now, students, if you see this question, this has nothing to do with what is given in the case study. They have just given a scenario. We'll come to this question subsequently. They have just given a scenario and they have asked a question. This is an example of which type of risk in statutory audit. Those of you who remember the audit risk components, you would have figured out the answer by now. But nonetheless, we'll go back to the concept, revisit it, and solve this question. But the thing that you have to keep in mind in this particular question is that this question is not related to the case at all. Okay. Then, same way, this particular second question, the cashier committed a fraud, absconded with the proceeds. The accountant was unaware. During the audit, auditor failed to discover the fraud. Now, tell me one thing. Who is responsible for detecting the fraud, or who is responsible to put controls to detect the fraud? Is it the auditor or is it the management?
Management.
It is the management, right? So the management has to detect. But what has happened? The management was also not aware. That is, the chief accountant was not aware, and the auditor was also not aware. However, after completion of the audit, the chief accountant discovered the fraud, and investigation indicated that auditor did not exercise proper skill. Which of the following statements characterize the situation? Now, here also, if you see, this is an independent question that we need to answer, right? Then, the third question, they have decided to remove the expiration date from the frequent flyer miles. So there is something called as frequent flyer miles. We'll come back to that. It has done this to improve the customer satisfaction of its flyers using the Kano model. So it is one of the model. Using that model, which of the following attributes is correct? So this also we'll discuss, right? Then this one, which is related to directors, I would want Yogita to throw some light on this before we go back to the case study.
Yeah, so this is also related to directors, and this is also related to the LODR regulations. So, like, maybe Ashlesha should take it up here. Yeah.
Okay, it's with LODR. Sorry. Okay, I missed it. So, Ashlesha, if we can discuss this question.
Yes. So if you look at this question, let's read it. It says, assuming that Mr. Stephen is eligible to be appointed as a director, in line with the requirements, KG Airlines aimed to fill up the vacancy caused by resignation of Mr. KB Chakraborty by nominating Mr. Stephen as an independent director. So basically, in this situation, there's something happening. There's a director who has resigned, causing casual vacancy, and there's someone else who's being proposed to be appointed as an independent director. However, there's one more person, Mr. Ravi Kishan, a board director, objected, contending that Mr. Stephen lacks eligibility for the board position due to already occupancy of a position of independent director. So this person, he says that Mr. Stephen is not eligible because he already occupies a position as an independent director in 3 listed entities. So here 3 listed entities becomes your key term in the question. Evaluate whether Mr. Ravi's claim regarding Mr. Stephen's suitability for the position of independent director on the board is correct or not. So here you have options and you have to answer the question. So here when you read the question, one important point which we get here is that Mr. Stephen is already occupying a position of an independent director in 3 listed entities. Now, when you read these type of questions, generally a confusion comes up as to which provision to apply. Do we apply provisions of the Companies Act or do we apply SEBI regulations? So we'll discuss the concept in detail and then come back to the question so that it becomes easier for you to answer questions like this.
So one more thing, students. So especially in these kind of cases where there is law involved, right? Which is more about remembering the provision. So this is where the notes will be helpful to you, because you need to remember the provision, correctly interpret the provision, and select the correct answer. Correct, Ashlesha?
Correct.
Yeah. So that is where the notes that we will be providing, that would be helpful. Then they have asked a question on Porter's 5 forces model. This is again, your SM and SEMP based on thing. This again, if you do it independently, it has nothing to do with the case study. Okay. Then we have a balanced scorecard table for KG Airlines, that is from your strategic cost management perspective. Then Mr. KB resigned after working about 45 days as a director. So again, so we'll have to actually, now here is where we have to focus on directors. So 2 times the questions on directors have come. So this again we'll be discussing. And then to recognize ticket sales, determine the transaction price as per Ind AS 115, that is your financial reporting. Does KG Airlines have to pay GST? That is our, ID, indirect taxation, again GST. So once we have had, see, we have to spend some 15 minutes in reading all the questions. In examination, we will not have so much of time. Once we have a sense of what is being tested, then we should go back to the case and see what are the relevant points that we should be picking up. Are we clear? Any questions so far from the student side?
You guys can feel free to ask. Do not hesitate. Feel comfortable and ask.
Okay. So now let us go to the case. And we on purpose will not go through something in detail even in our classes, because our approach should be, how should we get the maximum out of the 1 hour time? Please allocate 1 hour per case study. So was there any question on civil aviation industry and company outlook? There was nothing, okay, except for some balance scorecard related question. This will not have great impact on the question that you'll be, answering. But after the class gets over, do read this case from beginning till end, so that if similar case comes in the examination or if additional questions come in the examination, we should be in a position to handle that. Okay. So for example, the industry is an external environment, the competitive environment. Okay. Something based on that can be tested, or something based on, let us say, an uncertainty, COVID-19 pandemic. So that is another aspect what they have mentioned here. So aviation industry has the power to change the economic landscape of a country. Connectivity is important for generation of economic growth, trade, tourism. Millions depend on this industry for their employment. In the recent past, the entire industry has been crippled. The year 2021 proved to be the most difficult period. Now, tell me one thing. In this entire paragraph, they have not given anything which we will need to answer our questions. Okay. Then, here is a quote and managing director, that person, when everything seems to be going against you, remember that the airplane takes against the wind and not with it. So this is a tagline. This was by, I guess, Henry Ford. And that is, Krishna Gupta is the managing director, and this quote is on his wall. So again, second paragraph is also not relevant. Like this, we should make a habit when we are reading the case study that there are some aspects which we need to ignore. Means, by looking at the first couple of sentences or first sentence itself, you'll figure out that this has nothing to do with our final answer, right? So it has taken years to bounce back to normal. So here the business has come back to normal. Then here Indian economy is now growing. Okay. So like this, if you see, each paragraph has some specifics. And now when we have to go to our question, case study for answering, we will do it accordingly. Sorry. Now, Coming to the airline specific, it was founded in so and so year. Then they have become a significant player. KG Partners hold 59% stake. Now, in this question, there is nothing related to control and all of that. But if they say KG Partners, they hold 59%. So there is a parent subsidiary relationship. There is a related party, aspect is there. Then Singapore company holds 41%. So a foreign company angle is there. Okay. Then they placed an order for 50 aircraft to commence operations from 2000. They received the first aircraft on 10th of August. The maiden flights connected New Delhi to Mumbai. By the close of 2022, they had 270 aircraft and 40 more were acquired in 23. So all of these are what? All of these are just factual information. We don't need to worry about this. Then it is a listed entity here. Yes.
Yeah. So just to add on, in this particular question, now that we have seen what questions were asked, we have a fair idea as to what kind of questions have been asked. But if you look at a holding subsidiary relationship or where there's percentage stake holding, there is a probable question that can come from transfer pricing, where they might ask something related to arm's length pricing. If you observe there, Singapore company holds 41%. So they might bring into picture about a concept of arm's length price, transfer pricing provisions into play. So what we are trying to put forward here is that when one particular point you look at, there is a probability that different points from different subject can come into the picture.
Right. Then there could also be things like, because there is a foreign company involvement, what is the place of effective management? That also can be tested. Right. Same way from laws and angle of law, what is the impact? Right. Whether it's a foreign company or not. So a lot of these things can be tested, and these are the things we have to be careful about when we are answering the case study. Then they have said this is a listed company. So this is an important thing here. Traded under the symbol of KGA. Now this is a listed entity. The moment it's a listed entity, Companies Act provisions will apply. The SEBI regulations will also be applicable, right? And the directors operate from its Gurgaon office. So they have told where are the directors situated. Then the overview of board of directors profile is provided in Annexure A. That is perfectly fine. Now, the growth trajectory holds significant potential. So again, the industry has potential, business has potential. These are extra stuffing, especially from management perspective. A lot of extra guidance given, which again, in this particular case, nothing much has been asked from it. But then here, if you see, they have mentioned the KG Airlines has redefined its mission, vision, and purpose, and they have given their mission as to provide connectivity with speed and reliability, making travel hassle-free and affordable for our guests. To be a leader in aviation by offering unmatched connectivity in and with, so I think it is with, and I think foreign also they would be mean, speed in and out of India with ease. So something is missed out here. And the purpose, be our guest, we connect you to the world. And the airline aims to build a loyal customer base by providing affordable rates, on-time performance, courteous and hassle-free service. These are reassurances airlines wishes to provide to its customer. So this is the content which will be useful when you go and attempt the balanced scorecard related question. Okay, that is more about the management aspect. Then they have talked about operational challenges in the airline industry, which does not have any relevance in this particular case and does not have any direct relevance with respect to taxation or law matter, because there is an operational aspect. Okay, so again, availability of spare parts, nothing specific has been given in this particular thing, but in examination you may get a question like recommend measures to improve spare parts availability. So that is where your costing principles, your reorder level, your economic order quantity, all of those things could be tested. Or they may ask you whether spare parts can be separately capitalized under Ind AS 16, or should you show them as inventory under Ind AS 2? That can also be tested. So those conceptual understanding you must have when you are attempting these kind of question, right? Then just a second. Then they are talking about margins under pressure. So this is again something to do with the management aspect. Okay. Then they have given specifically that maintaining profitability in the market-driven passenger ticket fare environment requires airlines to focus on cost efficiency. So this case study surprisingly has more orientation towards management and cost accounting or strategic cost management. But we have seen other case studies where law or taxation has a greater weightage. Then this operational highlight is a specific thing for this airline industry. Available seat kilometer. Now tell me, where have you heard about this similar term in, in some service industry, something like passenger round trip kilometer, passenger kilometer. So here you have load factor. Load factor means how much percentage has been occupied, cost per available seat, revenue for available seat kilometer. So now, one thing that you have to understand here is, don't get scared because of these new terminologies, because this is an industry specific parameter. On-time performance, number of unresolved customer complaints, all of these things you'll be able to understand if you understand the overall context. Okay. Then they have given, increase in flight cancellation because of mechanical faults, software glitches. So a lot of focus in this particular case is on operational aspect, right? Then they have explained things like what is on-time performance, what is turnaround time. Turnaround time is the time between aircraft landing and takeoff. The turnaround process is a joint effort of both ground team and flight team. So if at all you have not, traveled by flight, you would have seen that after the flight lands, a lot of, ground staff would come up and they will, fix they'll refuel the aircraft, they will, unload the baggage, they will deboard the passengers, new passenger would board in. All of that happens with the help of the ground team and the flight crew. Beside loading and unloading, aircrafts are cleaned, inspection is done, maintenance work is carried out, they are refueled during this time. Average turnaround time is roughly 1 hour. A fast turnaround time ensures the aircraft is available for the next travel leg quickly and improve the asset utilization. One more thing, friends. The longer the duration the flight stays at the airport, higher is the rental that they have to pay. Okay. Then, if you try to do a fast turnaround, it is critical not to compromise on the aircraft safety. Just because you have to turn around the flight faster, you should not miss out on the safety. You should ensure everything is checked properly. Tire pressures are checked, fuels are checked. So in fact, I had the luxury to be at airports for audits. So there are a lot of nitty-gritty things. There are a lot of things like there should not be water in the aviation turbine fuel. Even a droplet of water can cause a huge disaster. Then when a flight takes off, if it has to land immediately, the weight is so heavy or the wings are so heavy, it may not be safe for the aircraft to land immediately. So they have to discharge the fuel and then only they can land. So these kind of case studies also require some industry knowledge. So how to get industry knowledge? Read business magazines. Read business magazines, read business newspapers, where you get some insights of the specific industry. Otherwise, what will happen is all of these things will appear as if, some kind of some literature in Greek or literature in Latin, which are not able to understand. Okay. So make a habit, 10-15 minutes, read about some, industry, cement industry, infrastructure, this time, something can come on artificial intelligence also, right? Whatever is happening, to keep reading about them. That will help you to, grasp or understand these type of case studies. Then they have given analysis of delays in turnaround time. Now, you look at this, a lot of this is not even relevant in the MCQs. Some of these will be relevant for balanced scorecard. The number of passengers flown by KG Airlines have grown from 75 million to 90 million in 23. Until now, there have been only few airlines within the civil aviation industry in India. KG Airlines has managed to capture majority of the traffic in certain routes. However, with the expected potential for growth within the industry, there may be more airlines that may be able to operate in these routes. Now, let me ask you one question. Which airline is the leading airline in terms of market share today in India? Anyone? Any student would like to comment? Let's see who gets it closest. The leading airline in terms of market share in India. Okay, so one answer, SpiceJet, Air India, yes, IndigoLearn. IndigoLearn? By the way, most of our travel is by Indigo only. Okay, fine. So I have received 3 responses for Indigo, 1 for Air India, 1 for SpiceJet. Let me tell you, SpiceJet is almost in the verge of being shut down. The operations have gone down significantly. Okay. Anybody else wants to make a guess, informed guess, or without searching, by the way? Okay. So as of today, Deccan is non-existent. See, we must be aware of what is going on in the current market, which aircrafts are operating. So Deccan is no longer there. Kingfisher is no longer there. Does anyone know the company which owns the brand Indigo? Means the airline Indigo, the name of the company? So Indigo is owned by Interglobe Aviation. It's a listed entity. So currently the market leader is Indigo. Then it's followed by Air India, Vistara. Then, SpiceJet, Go Air and all of that. Air all have a smaller share. Okay. So that is the thing. So now, Shivteja, would you just take them through this GST angle for fare structure and all?
Yes. So now that we got a fair idea about the industry overview and other things, now comes the tax element. So if you observe carefully, they're talking about the fare structure in airline operation. A ticket worth 10,000 is sold at 5% discount per passenger, and the GST rate at 5% is collected on the sale. Now, the basic common sense that comes to our brain is that GST is always charged on the net figure after the discount. Now comes aviation security fee is 500 per passenger, and the user development fee is 250 per passenger. This is a very, very interesting line. That's because this aviation security fee or the user development fee is basically not charged by the airline company. It is basically charged by the airport operators. So, for example, as Suraj was rightly telling you that the airline company is supposed to pay rent to the airport operator. In a similar manner, airport authorities, they also collect user development fee and security fee from the passengers, but they'll not collect directly, they'll collect through airline company. So airline company, when they give a bill, in the bill, they charge this separately. Yeah. Airlines collect security fee from passenger when they book the tickets. This is passed on to the government, rightly said. This fee is used to fund the security arrangement at the airport around the country. User development fee or passenger service fee.
Sorry, sir.
Yeah.
I thought I would show them actual invoice.
Go ahead, please.
No, but I didn't get the Indigo invoice, means airline invoice. I'll figure out. I'll show them. You can continue.
Sure. This fee is used to fund the security arrangements at the airport around the country. User development fee or passenger service fee are levied by airline when passenger book the ticket. In fact, a lot of times students keep thinking and people keep thinking that when we buy a ticket for 5,000 rupees, 5,000 is complete towards ticket cost. But let me tell you, the base fare would hardly be around 2,000-3,000. Restaurant is all the taxes, passenger service fee and all. The moment you trigger this point, there is a probability that GST valuation rule question may come on the airlines. But to my surprise, that is not there as part of the question. But there is a probability that a question can come from valuation with respect to air travel agent. That possibility is always there. Next. They are They are then passed on to the airport operator, like government-owned Airport Authority of India. You would have seen a lot of times at the airport that there is a board mentioned as Airport Authority of India, or to other private operators who have the license to operate the airports. Wow, brilliant. The moment you listen till here, what is that you have to synopsis of this whole story? Synopsis is very simple. There is some passenger service fee or there is some user development fee, which the airport authority is collecting from the passenger through the airline company. That means airline company is collecting that amount on behalf of airport authority. It is as good as a very brilliant concept of GST known as pure agent. To tell you in simple terms, which a student simply understand is that, sir, I'm a practicing chartered accountant. Let's say a client comes to me asking me to file income tax return. I tell him the fees is 5,000. But he tells, sir, my tax is 10,000. I'll do one thing. I'll transfer 15,000 to your account. 10,000 you pay tax to government. Now 10,000 when I pay tax to government, that 10,000 I paid to government on behalf of my client. So on that 10,000, GST will not apply because I'm purely acting as a pure agent. We'll talk in detail about it. Next. In return for this collection service, airline is compensated at 5 per passenger from whom this fees is recovered. So that 5 rupees is nothing but the consideration for service provided by the airline company to the airport authority. On that consideration, definitely GST will apply. There's no doubt about it. Yeah. Moving ahead. That's about Indies. I think Suraj is a better person about it.
I think that is just a passing reference. So just because we have discussed, so something like this, this is how, if you can explain the...
Perfect. Thank you. Thank you, Suraj. Thank you. So if you see here, my dear friends, you can see here air travel and related charges. You can see the non-taxable.
So this is, value. Okay, this, can someone
travel to Sikkim or Manipur or Mizoram or Meghalaya, Nagaland? Bagdogra. So because in the GST exemption list, there is one point which says that in case where the arrival or departure is in Assam, Manipur, Meghalaya, Mizoram, Nagaland, Sikkim, Tripura, or Bagdogra located in West Bengal, there is no GST at all. That's why it is exempt. That's how
here you can see
there is no GST in this.
So this is flight from Bagdogra to Hyderabad. That is why there is no GST.
But I request students to look at the second point below that working. That is, airport charges includes ADF, UDF, and PSF. That is your user development fee, passenger service fee. Those are the charges which are collected by the airline companies from the passengers towards the, basically towards the airport authorities. So they just collect that money and they pass on to the airport authorities.
Okay, so
that's
continue.
You have to note that very, very clearly. Passenger service, user development fee, automatic direction finder, they're all those kind of fees which they collect.
So moving further, they are talking about strategy. Again, we have seen there is nothing specific on strategy, but yes, they have said they have want to operate as a low-cost, high-efficiency airline, and they have the following strategy: fleet management, building digital capabilities. So one thing, students, please be careful. In whichever CA final subject, wherever you have this digital aspect, like in financial reporting, they have added, in auditing, they have added, in GST, they have added something on digital. So digital, there is a lot of focus from institute, and I'm sure they'll be asking questions on this. Okay. So here they are saying they will digitalize the process to make them efficient, error-free, and all of those things. Then they're talking about ancillary services. Ancillary means apart from your flight services, food in the flight, beverage in the flight. In fact, some news article was mentioning that Indigo Airlines revenue from this food and beverage is more than some established food chains. Okay. Then customer loyalty, very, very important part when it comes to handling there. Again, we don't get much of content here for writing the or attempting the answers. But here again, they're talking about customer loyalty, how to retain the customer, how do we ensure that customer will be with us. So here, what they have told is the management has realized that value for money is driven by the redemption choices that the customer loyalty program offers. So there is a customer loyalty program which they are offering. Okay. At the time, attractive loyalty reward programs are the best way to build and retain customer bases. So if you see, even we provide you iCash, that's a reward. Okay. So a lot of companies provide loyalty programs so that you can redeem the points subsequently. Then this is about workforce management, HR, and here you can see high attrition rate of 15% is impacting operations. So that is one part. Then they have spoken about performance measurement system. This is to do with your strategic cost management. We have specific topics there where how the performance are measured and how they should ensure that the attrition comes down. This is covered in this particular aspect. Now, we have this breakup of board of directors. So if we can have doubts. Doubts, I think we can ask you towards the end of the session. That will be helpful. Okay. Now coming to board of directors, here is a list of board of directors. So if Yogita Rasmesha would like to take them through this board of directors.
Okay. So see this annexure relating to board of directors. Even if you don't want to read the entire list of board of directors, see, we just mainly have to look at who are the board of directors, what is their position. So we have got Jay Kumar, who's the chairman and the non-executive independent director. Right. Now then on the right side, we have got their qualification and their experience, which is given. So now qualification and experience is not very relevant for us. So if you want, for the time being, you can skip it. And later on, if suppose, let's say the question is specifically talking about that, we can go back and we already have specific qualifications for individual directors. So we can read them later. So you simply have to read the type of directors and the names. Okay. So we have got Anna Maria, which is non-executive independent director. Then we have got K. Shrikant, again non-executive independent director. Then Krishna Gupta, promoter and managing director. Then we have got Sridharan, non-executive director. Then we've got Harsh Mittal, non-executive director. And then we have got some more. So yeah, so we've got Marcus, who's again a non-executive director, KB Chakraborty, who's an independent director. Now here, see, there is a star. So now that means there's some important point given underneath. So KB was appointed as a casual vacancy director on 3rd September 2023. His appointment was subsequently approved by the members in the immediate next general meeting. Now this is a very specific point. So there must be a question on it. Okay, that should click in your mind. So see here, this person is an independent director and he was not normally appointed. He was not normally appointed in the general meeting. He was in fact appointed to fill up the casual vacancy. So some existing director must have vacated. Okay. And then based on that, this person is appointed. He's first appointed by the board of directors. Then subsequently, the approval has been taken in the general meeting. So that means this appointment is correct. Then we've got Ravi Kishan, who is a retired director. So most likely Ravi Kishan is the person who vacated. And then on his place, maybe this KB Chakraborty was appointed as the independent director. So this is basic detail. And what should click in your mind? See, a question can be asked, although it is not asked. Here we have been given independent directors. So you can probably calculate the total number of directors. See here, definitely it's talking about company law. You can calculate the total number of directors. Total number of directors here are 9. And number of independent directors, it has to be as per section 149, it has to be 1/3 or more. So here, at least 3 of them have to be independent director. Why? Because this is a listed company. That should just click in your mind. Okay, and here this provision is also complied by. So we have got 4 independent directors. All right, so this is some detail which is given here. We'll accordingly read the question and solve if any relevant part is there.
Okay, so that is so basically the thing is when we see the objective here of us, telling you that these type of questions can also come in the examination is to help you understand that if this type of question comes, how should we handle it? Okay, in this case they have not asked, but can they ask? Yes, they can definitely ask, and that can be one thing, or they can ask things around related party. Okay, which is related party, because here if you see Krishna Gupta, he is a group managing director of KG Partners. So group managing director of also KG Partners, and KG Partners has some stake, then there is someone who's there in Singapore. So that kind of related party aspect also we have to consider it. Okay.
And they
Then,
might also ask one point related to reverse charge mechanism in GST of
Yeah.
service given by director to the body corporate.
Correct.
So any probability is always there. So that 3 points we need to make note of.
Okay, then they have given the management responsibility statement. Now what we'll do is we will take up specific, first we will finish off law, taxation, and then we'll come back to, audit and other aspects, because today I don't think we'll have enough time to complete everything. So let us first focus on, so this 1.4, which MCQ number 1.4, which is on corporate and other law. I think it's Aslesha can take this up.
Yes, I will take this up. So before we go to the question, I'll just share my screen and quickly explain the regulation on which the question is based so that we are clear with the concept, and then we can come back to the question.
Are you able to share, Aslesha?
No, I am not able
Yeah,
to
now
share this.
you can share now.
Yeah. So the regulation which we'll use to answer this particular question is Regulation 17A of SEBI LODR regulations. Now, before I start with the regulation, if you remember when we read the question said that Mr. Stephen is already an independent director in 3 listed entities. Now, as soon as you read this, one point should come in your mind automatically, and that is, what is the maximum number of directorships actually available to that person? In how many companies can that person become a director? Now, when the maximum number of directorship point comes in, 2 rules or 2 provisions would come in your mind. One would be as per the section 165 of Companies Act, and second would be as per SEBI regulation. But here we are talking specifically about listed companies, and that is the reason why we will use Regulation 17A of SEBI LODR regulations and answer the question. So this regulation basically says that a person shall not be a director in more than 7 listed entities, and also not an independent director in more than 7 listed entities. However, there's one more point to it, which says that if a person is serving as a whole-time director or a managing director in any listed entity, he can serve as an independent director only in up to 3 listed entities. So here we get 2 limits. One is that a person can be appointed as an independent director in 7 listed entities, not more than 7. And also, if he is a whole-time director or managing director elsewhere, then the limit comes down to 3 listed entities. So let's go back to the question and let's answer the question.
Just a second.
Do I share my screen or are you
No,
sharing?
I'll say it.
Okay, so in this particular question, there was a vacancy which was being caused by by resignation of Mr. KB Chakrabarti. So if you remember, when we had read the question just now, there was an asterisk point which said that Mr. KB Chakrabarti was also appointed as a casual vacancy director. And now in this question, from this question, we understand that Mr. KB Chakrabarti has also resigned. Now, in his place, there's another person, Mr. Stephen, who is being contemplated as the next director, whose appointment is being proposed. But there's another person, Mr. Ravi Kishan, who says that Stephen lacks eligibility for board position because he already occupies position of independent director in 3 listed entities. But nowhere in the question we have come across a point which says that Stephen is a whole-time director or a managing director elsewhere, which means that Stephen is eligible to be appointed as a director in up to 7 listed entities. And here he has been already appointed or is holding position in only 3 listed entities, which means Stephen is actually eligible to be appointed as the director, which means the claim which is being made by Mr. Ravi here is not a correct claim, and Stephen is eligible to be appointed as an independent director, and he can fill in the casual vacancy which is being caused by Mr. KB Chakrabarti. Now, if you look at the options given, here you see the first option, it says the contention of Mr. Ravi Kishan is correct. So as we've already discussed, it cannot be option A at all because Mr. Ravi's contention is not correct. Now the other three options here mention that the other three options say no, no, and no. However, if you look at the limits there, option number B says that a person, Mr. Stephen, is eligible to be appointed in maximum 20 companies. So no, it cannot be 20 companies. Here the limit is 7 listed entities. So the option C also talks about maximum 10 public companies. So the correct option here is option D because it says that Mr. Stephen is eligible to be appointed in maximum 7 listed entities. So when you know the provision, it becomes easier for you to answer the questions. And also here, there could have been a different question wherein they would have told you that Mr. Stephen is a managing director in some other company and he is already an independent director in 3 listed entities. Then in that situation, Mr. Ravi's contention would have been correct and Mr. Stephen would not have been eligible to be appointed as a director if the situation would have been otherwise. But since here he is not holding any other position elsewhere, he's not a whole-time director or managing director elsewhere, the correct option here is option D, that Mr. Ravi's contention is not correct and Stephen is eligible to be appointed as an independent director in maximum 7 listed companies where he holds only 3. So the correct answer here is option D.
Okay, thank you.
Yeah.
Right. SM again, I will take it up subsequently. Then now coming to this particular question on 1.7, I think Yogita would be taking this up.
Yeah.
Yeah.
Okay, so let's first maybe read the question, then we'll understand the concepts applicable. Accordingly, we'll understand the answer. So this is a descriptive answer here. This is a descriptive question here. So let's read the question. So on 19th October 2023, Mr. KB resigned after working about 45 days as the director. Now this Mr. KB, who is this person? This person is someone who was appointed to fill up the casual vacancy of Mr. Ravi. So this is a person who's filling up casual vacancy and he has also resigned now after working 45 days. Now the board of directors wish to fill up the said vacancy by appointing Mr. Stephens, just like how we had discussed in the previous question, in the capacity of independent director in the forthcoming meeting of the board. The board meeting is scheduled on the 31st of December. Now the first question is, advise the board, keeping in view the provisions of the Companies Act with respect to appointment of Mr. Stephen. So all the provisions that you know about this appointment, you will have to write them down. Find the maximum time period within which the proposed appointment of Mr. Stephens can be made. All right. So again, you have to describe all the provisions that are applicable here. So you will have to first figure out what provisions are going to be applicable. So I want to share the screen now to discuss the provisions.
I will just sharing access. Can try sharing.
Yeah. Is it visible?
Yes. Can we slightly zoom the page?
Yeah. Yes.
Yeah.
Okay. 1 second. Okay. So here first we need to understand what is casual vacancy. So casual vacancy is covered in our section number 161. See, casual vacancy is when a director is appointed in the general meeting and he vacates before the term is completed. So in this case, we call it a casual vacancy. Now, casual vacancy has to be filled by the board of directors in the board meeting, and then later on, subsequently, it has to be approved in the next general meeting. So accordingly, we know this KB Chakraborty has been properly appointed in as per this provision to fill up the casual vacancy. All right. This person's, that means KB Chakraborty's term is up to the term of the director who has vacated. So see, we have not been given who has vacated, but most likely it's Mr. Ravi who has retired. Okay. Now see, if suppose a person who is appointed to fill up the casual vacancy, that person vacates the office, then is it also a casual vacancy? And the answer is no. See here, when we say casual vacancy, it means the director who was appointed in the general meeting, if he vacates, then we call it a casual vacancy. But if the person who has been appointed to fill the casual vacancy, they vacate, then that will not come under this provision. That means we have to suggest some other provision under which the appointment of the director can be made. So again, the relevant provision here is 161 only. Section 161 also talks about additional director. So we can suggest that maybe the board of directors can appoint an additional director. Okay. Now, additional director, how is the additional director appointed? The articles have to give the power to the board of directors for the appointment of the additional directors. Okay. Now, the additional director will be appointed and the term of the additional director will be up to the next AGM or the last date of holding the AGM, whichever is earlier. Okay, so maybe the company can appoint Mr. Stephen as an additional director. Another alternative is available here. See, we know Mr. Chakraborty was an independent director. Mr. Ravi was also an independent director. And Mr. Stephen is also being appointed as an independent director. So maybe we can use some of the provisions relating to independent director. So say independent director, it is covered in section number 149.
Yogita, can you be a bit louder? Student has asked slightly.
Hello?
Yeah, better.
Is this better?
Yeah, better.
Okay. So the second alternative is that, see, all the three directors, the first director, Mr. Ravi, or the one who filled the casual vacancy, that is Mr. Chakraborty, they both were independent directors. And also the upcoming director, Mr. Stephen, will also be appointed as the independent director. Right? So maybe we can use some provisions relating to independent director. So we have got Companies Appointment and Qualification of Directors Rules 2014, specifically rule number 4, which talks about intermittent vacancy of an independent director. So if suppose an independent director has vacated the office in between the term, then another independent director can be appointed by the board of directors. There is a time limit also prescribed here. The independent director must be appointed immediately in the next board meeting or within 3 months from the vacancy, whichever is late. Okay, so this time limit we have to mention. So using this provision or the above provision, section 161 additional director, using one of the provisions, the new director, Mr. Stephen, can be appointed. All right, but this cannot be called as casual vacancy. All right. Yeah, so that is the question. We can move on to the next questions.
Yeah. So now, see, especially when it is a descriptive question, what advantage you would have is, because you have some notes that you'll be carrying or some book that you will be carrying, you can refer to that and write the provision part at least in the examination. Okay, and then accordingly you will present your answer. Any doubt on this? And one more thing, what I wanted to ask all of you is, how many of you have not yet completed corporate and other law, corporate and economic laws as a part of your preparation or self-paced module or whatever it is? How many of you have no ideas about directors, how they are appointed, what are restrictions on intercompany loans, what are restrictions on independent directors, all of those things? So we have not okay, some have completed, some have basic ideas, some have not done at all. So what we will suggest is, the notes that you'll be providing, it has a summary, in summary format, the provisions that are most likely, that will be covered, what Yogita has prepared, that will be shared with you. And then you should ensure that you at least go through them and, have a couple of readings, so that in the examination, whenever a question is tested, you know where to pick the provision from. Okay. That is one thing you have to keep in mind, right? Then moving on to question 1.8. We will do 1.8 B and C today. That is the part related to GST. And then in tomorrow's session, we will continue with the remaining topics of audit, FR, and strategic cost management and strategic management. So Shivteja, if you can take this up further.
Yeah. So 1.8 question, if you see, to recognize the ticket sales on the flights KG Airlines operates, you are required to answer the following question. Let's see the B bit first. That is, does KG Airlines have to pay GST on the airport levies like user development fee, passenger service fee, etc., collected from the passenger? Briefly discuss. As I told you very clearly that airline company is collecting that passenger service fee or user development fee from the passenger on behalf of airport authorities. They are purely acting as a pure agent. And pure agent provisions are given by Rule 33 of CGST rules, which clearly specifies that as per Rule 33 of CGST rules, if amount is collected on behalf of another person where he does not hold any title, then we say that he is acting as a pure agent. And that amount GST will not apply. But there is one very, very important condition, that is KG Airlines have to show bifurcation for that user development fee and passenger service fee separately in the invoice, which is a mandatory condition. Yeah.
Okay. So just now we showed you, right, the invoice where the airport related charges are shown separately in the invoices. Then the second one.
Second bit says, does airlines have to pay GST on the collection charges of fine charged for the collection service provided by the airline to airport operator? You just get the logic here. That is, Indigo is collecting that user development fee or passenger service fee from the customer and making that to the airport authorities. Example, Airport Authority of India. Now, because Indigo is providing that service, Airport Authority of India is providing that service fee of 5 rupees per ticket. That is obviously an income for the airline company for the service provided to Airport Authority of India. And on that amount, GST will definitely apply. Yeah. Can I just share the screen for a minute?
Yeah, please. You can share.
Yeah. I'll also share the PDF also subsequently with you. This is about Rule 33 provision, which clearly says that expenditure or the cost, you can see that language, expenditure or the cost incurred by the supplier as a pure agent of the recipient shall be excluded from the value of supply. So in simple terms, whatever amount is collected by the airline company from the passenger is excluded from the value of supply when airline company is acting as a pure agent of recipient. And the payment is made by the pure agent on behalf of recipient of supply. And that has been separately indicated in the invoice issued by pure agent. Finally, supplies are procured by the pure agent from the third party, which is important condition. Yeah. Pure agent means somebody who enters into contractual agreement with recipient of supply to act as pure agent. Next, he does not hold any title to the goods or services so procured. Does not use for his own interest. You have to observe that whatever user development fee, passenger service fee is collected, it is not for the development of airline company. It is being directly paid to the Airport Authority of India and receives only the actual amount incurred to procure such goods or services. Indigo is not collecting extra money on that user development fee or passenger service fee. They are collecting only that amount which Airport Authority of India is levying. That's it. Finally, concept of the given question, user development fee and the passenger service fee collected by the airline company from the passenger would not be subject to GST in the hands of airline company, since it is collected by the airline company as a pure agent of the airport operators. But airline company should separately specify the amount of UDF and PSF in the invoice, which is mandatory, my dear friends. As I told you, if Shivateja is giving service to a client for filing of income tax return, if I collect the tax amount of the client and pay to the government in my invoice, I'll always show it separately because that is not my income. Why would I pay GST on that? Next. However, on the service fee or the collection charges, which is charged by the airline company from the airport authority, that would definitely be subjected to GST. So this is the synopsis of the whole story of the GST related content which they have tested in this particular question. In fact, they had so much option to talk about composite supply, mixed supply, providing food in the airline. They could have asked about director RCM. So many options were there. But they tested only on this particular parameter in this question. I'll anyways share that PDF with you also subsequently. Done.
So as Shivateja mentioned, right? So they can give you like, flight originates from this location and it reaches that destination. What is the place of supply, right? What is the time of supply? Those things are there. So now let's have a look at a couple of MCQs related to audit and then we'll conclude today's session and then we will resume tomorrow. Okay. So coming back. So as I told you, these two questions, what are given as a part of audit questions, those are not related to case directly. So sometimes you might get a bonus question like this where they have just used the term aircraft, but apart from that, there is nothing, in this particular question that is linked to the case study. I could have said instead of aircrafts operated by KG Airlines, I could have said aircrafts operated by Kingfisher Airlines, which is no longer there. But anyways, so aircrafts operated by KG Airlines, whether owned or leased, require periodic maintenance. These are high value cost. Now, this is an audit question. I can give you an FR angle to this. If this is a periodic maintenance, let us say it is a maintenance activity which has to be carried out once in 3 years, mandatorily required, then we could have tested based on, do we need to create a provision for this as per Ind AS 37? Or how do we capitalize this periodic maintenance cost as per Ind AS 16? Or should we expense it as and when incurred? So multiple angles are possible. If you remember, aircraft related, this preventive maintenance or, major maintenance activity, which has a validity of 3 years, 4 years, 5 years, they can be capitalized as a separate component. So those things also we should keep in mind, right? These are high value costs. As of the reporting date, provisions need to be made for these expenses based on number of variable factors and assumptions, likely utilization of the aircraft, expected cost of these high value maintenance on a future date, condition of the aircraft, etc. Due to the complexity and the subjectivity of this condition, auditors rely on management judgment in order to quantify the amount of provision to be made. Now, I have a question for all of you. What is the option available to the auditor in such a scenario? So we'll answer this question. But say for a moment, the question is saying auditor is relying on the management. Now, what is the option available with the auditor in such a scenario? So the management is giving some estimate. Auditor does not know whether that estimate is correct or not. Then what should the auditor do? Is it just enough that they obtain a management representation letter and they say that, yes, as per this management representation letter, this number is correct? Or what should the auditor do? Which essay comes to your mind? Perform alternative audit procedure. Okay, that is a valid answer. Use auditor's expert work. So, see, this question they have asked about risk. We could have linked it with auditor's expert also. Or should we use management expert? That could also be a case. So, we have to link these questions. We have to link these concepts. So same question from the same paragraph, I could have asked on Ind AS 37. I could have asked on Ind AS 16. Because it is leased, I could have brought in Ind AS 116 angle. So same way here, as you rightly said, perform alternate audit procedure or get your auditor's expert and then see whether the estimate is correct or not. But now here, the question is, what is the type of risk? So let me just share the screen. Now, the components of audit risk, what you understand in SA 200 series, audit risk has 3 components: the inherent risk, the control risk, and the detection risk. What is inherent risk? Inherent risk is the risk of the business. Inherent risk is the risk of the business. If there is no control put in place, what is the risk? Now, risk of what? The risk of material misstatement. Risk of material misstatement, which is inherent, which is because of the business, is called inherent risk. Then what is control risk? Control risk is the risk that because there is an inherent risk, for example, there is an inherent risk that something will be stolen. So we put some control lock. Whether that lock will perform properly or not, that is the that is as far as the control is concerned. Even after putting the lock, someone may steal money. That is the control risk. And even after this control risk fails and we could not detect, that is the detection risk. Okay. Now here the question says, this particular estimate relying on the management estimate is which type of risk? See, we are not talking about any control. Okay. We are also not talking about any detection because we are relying on what the management is giving us. It is not that there is a control put in place, control has failed to detect. We have done the audit and we have failed to detect. That is not the case. Contract risk is a risk related to operations risk, not related to audit. So the correct answer is inherent risk. That is the risk of the business. That is the risk that if there is no control in place, the financial statements may be misstated or materially misstated. Then, second one, the cashier committed fraud. So fraud means which standard comes to your mind? Which standard on audit? SA 240. 315 is your risk related part, but primarily 240. When we say fraud, fraud is under 240. 315 is risk of material misstatement, so that related aspect. Okay. Now, the cashier committed a fraud and absconded with the proceeds. He ran away. The chief accountant was unaware when the fraud occurred. During the audit, the auditor failed to discover the fraud. So, auditor did not discover. And we discussed earlier that it is management's responsibility. However, after completion of the audit, the chief accountant discovered the fraud and an investigation indicated that the auditor did not exercise proper skill. So, there is a negligence. Negligence on the part of the auditor. Now, the moment there is negligence, 3-4 light bulbs should strike on your head. Quality related aspects, professional ethics related aspect, liabilities of the auditor. And here they're saying after completion of the audit. So subsequent event also comes into picture because audit has been completed and then the fraud has been discovered. So subsequent event also comes into picture. Now here what they have asked is, they have said they did not exercise proper skill and care performing the work in a desultory and haphazard manner. Now, here is where the problem arises. How many of you have heard this word desultory before this? Anyone? Or how many of you have not heard of this term? Not heard, right? Now, here is where your smartness is required. Even if you have not heard of this word desultory, you have heard of this word haphazard. And when these two words come together, that desultory also is something to do with haphazard. That is lack of proper planning. Okay, so if at all you hear a new word, because see, a lot of this case study would have been picked up from some other places or would have been created by professors who use a very high level English language. Even if you are not able to understand one word, with this word you should be able to manage. Now, auditor did not do planning properly. So standard or standards related to fraud comes into picture, audit planning comes into picture, material misstatement comes into picture, multiple things. But what is the question asking? Which of the following statements accurately characterize the situation? First, auditor exhibited due diligence and careful conduct. This is exactly opposite of what is given in the case. So that is not right. Second, clause 7 of part 1 of second schedule. Now, of course, if you have been preparing for audit, you will remember this. Otherwise, in our audit notes, we will have the aspects related to which part. So their question is saying clause 7 of part 1. So part 1 means related to practice, right? Clause 7 of part 1. So if we can come down, I think the numbering is not appropriate here. I'm sorry for that. So clause 7 of part 1 of second schedule. So I was referring to first schedule. So clause 7 of part 1 of second schedule. Does not exercise due diligence or is grossly negligent in the conduct of professional duties. Now, let me tell you, this particular clause you will apply in most of the negligence cases, even when you are appearing for financial reporting paper. We have one chapter on professional ethics and professional duty. There also, if due diligence is not exercised, this clause is attracted. So, is this clause attracted? Yes. SA 240, is it relevant? Yes, because it is related to fraud. Then, auditor failed to plan and perform. That is also we have understood with the with professional skepticism that is done. Then, chartered accountant in practice will be deemed guilty of professional misconduct based on clause 7 of part 2 of the second schedule. So they're saying part 2 clause 7. Now, what is part 2 clause 7? There is no clause 7 in part. Okay. So basically, just to confuse you. So appropriate one is 2 and 3. So we have options A, B, C, D. So the most appropriate option is both 2 and 3, which is option number C. Okay, so I think we will conclude today's session here. The same case study will continue tomorrow, where we'll be discussing about the management related aspects as a part of this case study. We can save GST while just touching one of the state like Bagdogra, Kerala to West Bengal, Canada, no GST will be there. See, you have to halt over there and then take the next flight.
It should
That
be a
is more
separate
costly.
booking.
Sorry?
Yeah,
Yes,
it should be a separate booking altogether.
correct. And that will be more costlier if you do separate bookings.
Yeah. And Suraj, one student asked me a question about number of days. I think you can answer that.
Number of days for the classes.
Yeah.
Okay, just understand. Any other questions? So see, we are planning to cover, all of these in about 50 to 60 hours of classes. That will be about 30 to 40 days of time. We're planning to cover about 40 to 50 case studies, right? And over a period of time, see today all of the faculties have come, together to discuss. Subsequently, we may feel that, for some case studies, subject specific case studies we will be discussing, or only the relevant subject specific part will be covered. So that is how we'll be planning it over a period of time. For paid students, recorded backup will be available. Then, in the examination, you have to answer 4 case studies out of 5 in a 4-hour paper. So 1 hour per case study. For all of you, reading speed is very, very important. Okay, very, very important unless you practice reading speed, especially when complex English language is given. So that is from our side. OMR sheet, I don't think they'll be providing for MCQs because each case will have MCQs as well as descriptive question. So MCQs will not be, OMR will not be provided. Okay. Yogita, Aslesha, Shivtaja would like to add something for today's session. And students, if you have any other doubt or any other thing. So sample of the books to be provided. So one sample, see, these are just extracts. Okay. We'll be giving more of, you'll get more summaries of this. So this is a part of, audit risk. Then, I'll just show you some other part, which I just. So something, like this for Porter 5, very brief, because please understand, we don't need to have elaborate, but we need to know the models. So for example, the Kano model. So the image of the model, the description of the model. So all relevant strategic management models that are applicable for the examination, all the strategic cost management models, okay, that are relevant for the examination, the summary of sections for law, summary of the index, standards, professional ethics, right? And so one thing what you have to understand is there may be, let us say, topics like, in audit, they have recently added ESG audit related aspects and all, but then those may not be widely tested. So we will provide you, but it may not be in too much of depth, because you should also be able to carry that for the examination. Just because we give you 500 pages note for each subject, what will you do with that in the examination? So our notes will cover 70-80% of the content that you may require for the examination. The remaining content you would already be aware of some concepts. Okay, some of the concepts you can figure out by looking at the MCQs. So to make your work easy, that is our whole approach. A batch will be completed in April. Some concepts हिंदी में बता सकते हैं. So शिल्पी, अगर आपको कोई specific point में doubt है तो आप पूछ सकते हो, हम उसको आपको हिंदी में समझा सकते हैं. ICI expects us to write. No, this is not summary. For example, if you see this Porter's 5.4 says this is sufficient. If you write this in the examination, it will be 2 pages. It appears 1 page because it is in Word format.
Document.
If you are writing in the exam, in 1 line, you can fit only 5 words or 6 words, which basically means this 1 page will still become 2 page. So I'm not saying we'll just give you side bullets or something like that. And see, once you have the key points, you should be slightly smart enough to elaborate those. So the choice is, should I carry 5,000 pages, 10 books, or should I carry summarized notes which I can elaborate in the examination? And then that is what will help you in the process. Timings will be same. Case study to be discussed in advance. Yes, sure. That's it. Actually, we wanted to try that, but we were not sure, whether students would want that to be discussed, study that in advance. For each case study, we will give you. For each case study, like today's case studies related notes, we'll combine that and we'll provide you separately. That is for your reference and revision. And then separate notes for exam purpose that anyways we are providing. Yes. So we have taken your feedback. So tomorrow we'll continue with this case study itself, more on the management side. And then this, from Monday onwards, whatever we are discussing, we'll give you in the WhatsApp group. We'll post that today case study. We'll be discussing this case study. Okay. All paid students are already a part of WhatsApp group. If you have not been added, please send a message to our support number. We'll add it. I will get it added. Okay. Anything, Ashlesha, Yogita, Shivteja would like to add?
Yeah.
Nothing specific from my side.
Sounds good. So support number, I think.
I'm sending.
Yeah.
These are support numbers.
I think Suraj already answered that.
Total class hours, we are targeting about 50 to 60 hours. Okay. In fact, if you see, when multiple faculties are taking, so that is a good number. So it will not be subject. So that's what. So we may subsequently combine 4 or 5 case studies of a subject, and we'll discuss that. Along with that, we'll discuss the concepts also, so that it becomes a revision.
Sorry. Should I answer that?
Yeah, please.
If it has to be subject-wise revision, see, for example, a subject like direct tax, if I have to summarize everything, direct tax summary itself will take about 60 to 70 hours.
Correct.
Indirect tax summary itself will take 50 to 60 hours. So technically, that subject-wise summary is practically very difficult. That logic, you have to get that. But whatever is related to the case study content, that will anyways cover for sure.
That will cover, and some important topics which we feel that, okay, these are the topics which has a high chance. For example, directors. So when, let's say Yogita is discussing or Ashlesha discussing their case study, that point of time, it automatically gets revised.
Sure.
Okay. So that is one thing you have to keep in mind. Yeah.
Yeah. And I think just to add on one last point is that subject-wise revision will be provided. See, that is something which we will definitely give a support through our forums, through our platforms. Any queries you get with respect to any subject, which is an integral part of integrated financial solutions, will be more than happy to answer your query.
Yeah.
Yeah.
There was this one question that someone had asked in between, that they have already completed first group, like they have passed first group and they're giving second group and they wanted advice. So see, even if first group you have completed, for this paper you still need to revise the concepts of all the subjects, so that actually you can save time in exams and you can quickly go to those particular concepts. Yeah, so that is one thing I wanted to add to that student. Yeah.
Sure. Thanks. Okay, and we'll also be sharing with you, the weightage analysis of based on past papers and the institute what they have released on RTP and all of that. And see, as we complete some, let us say 7-8 case studies, then you will have confidence. You'll have your confidence being built up, and then we can subsequently have group discussions when you would also be discussing some case studies, which will give you a hold of how you can approach the case studies in the examination. See, subject-wise revision. Subject-wise revision, Gopi, just now Shivti just also explained. If you have to revise everything, even if I have to do a basic revision, 40 to 50 hours per subject is needed. So that itself will make it some 400 hours of content when we will complete that. So our expectation is, with your existing preparation, you should be aware of the relevant concepts. We will be emphasizing on those concepts which have a higher chance of being tested as a part of integrated business solution. For example, they will not test in detail about, let us say, lease modification. Okay. Right. They may not test in detail about what is the definition of a particular thing. So, for example, in 115, they may not test in detail about, let us say, the let us service concession agreement. So those things will eliminate, and then with our notes, with the discussion in the class, you will be able to have a grip of it. Faiz, let me check if you have message yesterday. Someone should have replied by today. Okay, it is the handled WhatsApp number. Can you just wait for a day? Tomorrow morning, I'll ensure that it is responded to. So thanks a lot for joining in.
Thank you.
Yeah. Good night.
Thank you. Good night.